Good Monday morning. This is Yahoo Finance Live. I'm Brian Sozzi alongside our resident market master, Jared Blickery. Julie Hyman is on assignment, but we'll be back tomorrow. Let's get a check of the futures here to kick off this week. Seeing some minor green on the screen as traders position for another wave of earnings in a key inflation reading. Dow, S&P 500, Nasdaq futures nicely in the positive for now. But indeed, a lot's on the docket for today, so let's get to it. Merger Monday lives up to its name. Low-fare players Spirit Airlines and Frontier said today they will merge in a cash and stock deal valued at $6.6 billion. The duo is promising shareholders $500 million in synergies post-deal. Here's to hoping those skimpy Spirit seats get more comfortable should regulators sign off on this one. And cycling higher, Peloton is the top trending ticker on the Yahoo Finance platform as the stock is surging on deal rumors. Story from the Wall Street Journal late Friday says Amazon and Nike could be suitors for the struggling fitness gear maker. Jared and I will break all of this down. And all in on NFTs, GameStop is teaming up with NFT marketplace Immutable X as it tries to pivot away from relying on trafficless retail stores. We'll chat with Immutable X co-founder Robbie Ferguson. But investors will have a ton to chew on this week besides what I just mentioned. Let's get over to Yahoo Finance's Emily McCormick with a preview. Emily.
Well, Brian, a lot to keep an eye on this week on the earnings front. But even today, want to start with Merger Monday, which is already keeping investors on their toes. Now, just this morning, as you were breaking down, Brian, Frontier Airlines and Spirit Airlines have announced that they're merging into one. Now, currently, they're the two biggest budget airlines domestically. And after this deal closes, it will become the fifth largest airline in the U.S. Now, the deal is valued at about $6.6 billion. And after it's closed, Frontier will control a slight majority of the combined airline at 51.5%. Now, Spirit investors are each set to receive 1.9126 shares of Frontier plus $2.13 in cash for every Spirit share they hold, which comes out to an about 19% premium over where Spirit shares had closed last week. Now, the combined company is set to have annual revenue of about $5.3 billion, and it will offer more than 1,000 daily flights to over 145 destinations across 19 countries. So that news came alongside Spirit Airlines' latest quarterly earnings results from this morning, which also showed a narrower than expected quarterly loss per share. And that stock is currently up about 12.5% as we speak this morning. But do keep an eye on that deal since it is likely to face some antitrust scrutiny out of Washington. But elsewhere on the earnings front, also want to highlight some of the other major names that we have on the schedule in the coming days. That includes Take-Two Interactive tonight, Peloton and Lyft reporting results tomorrow, and Uber and Disney on Wednesday. Now, zooming in really quickly on Peloton, of course, this earnings report comes amid reports that it's attracting potential buyers from the likes of Amazon and Nike, among potentially some others as well. That stock is still up about 29% this morning, really extending those gains from after those reports were first emerging early on over the weekend, late in the day on Friday. And then in terms of Disney earnings, also want to quickly highlight those as well, because all eyes are going to be on Disney Plus streaming performance after Netflix's disappointing streaming growth and guidance from its own quarterly results just a few weeks ago. So any updates about whether Disney Plus is continuing its momentum will be closely watched, along with any updates about how performance and in-person traffic is doing at its theme park. So definitely a lot to watch on the earnings front this week, guys.
And there's also a lot to watch on the econ front. Specifically, I'm looking at CPI. We're set for that in a couple days. And I'm looking at the headline print, 7.3%. That's what the street is expecting. That would be ticking up from 7%. And I don't have to tell you this, Emily, that is the highest number that we've seen in young Brian Chung's lifetime. So what are the details behind this?
Well, that's right, Jared. So this would be the fastest increase on an annual basis that we'd see for the CPI since 1982 if it comes in as expected, taking out that 4-decade high that we saw back in December as well. And on a month-over-month basis, the CPI would also likely match December's 0.5% increase. And then even excluding those more volatile food and energy prices, CPI is expected to rise by 5.9% on an annual basis, which would also represent the biggest jump in that core measure since 1982. So this inflation data is really going to be in focus, especially after that stronger than expected payrolls report that we got out in the January jobs report, really affirming this narrative for the Federal Reserve that the U.S. economy has recovered sufficiently to perhaps warrant a quicker move away from accommodative monetary policy and towards tightening. So all of this is going to help inform investors as to whether we should be expecting 5 interest rate hikes, perhaps more or less, depending on how this data evolves, but certainly a lot to be keeping an eye on both the earnings and economic data fronts, guys.
Emily McCormick, thanks so much. All right, Jared, let's get back on
Yeah.
the markets here. In the morning brief newsletter this morning, I wrote about, I shed light on the Russell 2000. Now, Goldman Sachs out with a note of its own this morning, highlighting some weakness in the Russell 2000, year to date down 10.5%. And they're posing the question, does this weakness here, which really goes back a year, but Goldman highlighting it here this morning, does this suggest a new leg down in the broader markets under the thesis that if the U.S. economy is struggling here or slowing down, it will be those domestic companies inside the Russell 2000 that will tend to get hit first, and then those larger cap companies?
Very good points, all of them. I'd also add that we are in an interest rate environment that is rising right now. And you take a look at what the Fed is planning to do. How does that impact a lot of these smaller companies? Well, if you take the Russell 2000, you look at its constituents, something like 17, 18% financials, and financials are doing very well right now, as we know. So are energy stocks, and that's because the yield curve is, well, it has been rising and sometimes expanding as well. However, recently, the 2-year, the shorter end of the curve, has been coming up to meet the longer end of the curve, meaning that that's a recession indicator. So I think it's time to start talking about that. It's not imminent. The Fed is raising rates into strength right now, but we need to keep in mind that we have had almost zero. We've had basically zero or very low rates for 12 years now, 13 years, and that has affected companies' balance sheet. We have a lot of companies that simply depend on basically the Fed's largesse and basically low interest rates to be able to supply the funds that they need to pay their interest expenses. So you take a look at, for instance, a chart of zombie companies that have risen over the years. Something like 20% of the constituents of the Russell 3000 now do not make enough money to cover their interest expense. This is going to be a huge factor for a lot of companies going forward. It's been a long time since we've had materially higher rates and higher inflation. So this is a new market environment, and I think there's going to be a lot of surprises for investors in the coming year or two.
And one of the luxuries, Jared, of having you here early is that you could do some technical analysis, and really that outlook for higher rates continues to, I would say, to put pressure on the big cap tech trade. I'm looking right at Meta here in the pre-market. I still do not see buyers stepping up aggressively to buy this dip. Let's keep in mind, look what we saw after Netflix. That stock got blown up about a week and a half ago after its earnings. You saw Bill Ackman come out here, buy shares of the company on the dip. You saw Reed Hastings, Netflix co-founder, come out here, buy shares on the dip. You're just not seeing that type of news flow in Meta here.
No, I don't think you're going to see it for a little bit. Let me just pull up the Wi-Fi Interactive, because you can go back to 2018. That's when they had their last huge major stumble, and that was a big earnings flub for them. And it's hard to see on this chart right here, but this was a big deal. That was something. That was the record that they just broke for, I believe, a one-day loss. So you take a look at what happened afterwards. It was a slow, steady bleed downwards. It's going to take a while for this stock to repair itself. I think Facebook will get back to its record highs, but it's going to take a while. Look at what happened in 2018. It took several years of consolidating and basically testing this range here before it could head higher. So I think Facebook is dead. Meta Platforms is dead money for a little while, Brian.
What may not be dead money, believe it or not, Jared, is gold. Someone asked me this morning on Twitter, my outlook for gold. Don't really have one because we're not making predictions here at Yahoo Finance, but it looks like gold is finally starting to catch a little bit of a bid here.
Yeah, let's pull up the Wi-Fi Interactive, because this is a pure technical play right here. And I do like the consolidation that's happening in the gold futures. This is a 5-year chart that you're looking at. And let me just draw this pennant formation here. When you have a market coiling like this, it tends to break out. Now, it doesn't have to go up. It could break to the downside as well. But usually it continues in the long-term direction. As you can see, that is up. So I do believe gold is poised here for a big breakout and probably going to be to the upside.
Jared, is that the Hindenburg omen on that chart?
No, this is the Hindenburg omen right here. Let's see if I can draw this. I've done this before, Brian. Don't quote me. We're getting it in here. We got to. Here's where everybody lives. All right, that's as good as it gets.
Jared, you're best in class. Good to have you here this morning. All right, before we head to break, let's check out shares of Spotify, as CEO Daniel Ek sent a letter apologizing to employees, but also said he will not cancel Joe Rogan. Seeing shares of Spotify under pressure here this morning, really continuing a longer-term downtrend in Spotify shares. We'll talk more about the latest controversy over at Spotify in just a couple minutes. But coming up, will the January lows for the markets hold? UBS strategist Stuart Kaiser is here with his take next.
Welcome back. It has been a year of gut-wrenching volatility in the markets, and investors want to know, is the bottom in just yet? Here to help us answer that very question is UBS's head of equity derivatives research, Stuart Kaiser. Stuart, thank you for joining us here. Always good to see you. I'm looking at the market action. The market is pricing in more and more rate hikes, it seems, every week, and we have inflation as this bogeyman. Then we have some earnings mishaps. So you think Facebook. All in all, the Nasdaq was off about 20%, 19% plus from its highs, but it's recovered a bit. And you're not ready to call the bottom yet. Why is that?
Yeah, we're not. And good morning, Jared. I think our view is that the first few weeks of this year, were driven much more by macro concerns, higher interest rates, pricing the Fed, inflation, and things of that nature. And, since then, we've had a window of opportunity here where earnings, kind of took over. And obviously, Facebook was a big sell-off, but a lot of the other tech companies reported really strong earnings and kind of allowed the market to recover. Now that that's over, we've had about 70% of S&P earnings and about 80% of tech earnings have now reported. We do think the focus kind of shifts back to the macro side of the ledger with inflation this week. And, to your point, there's been a lot of macro uncertainty. The ECB, the Bank of England, both tightening alongside the Fed now, as well as, a series of high inflation prints that we expect over the next few months. So you put that all together, we don't think the bumpy ride is over. Whether we retest the lows, I think is obviously open for debate. But our view is the all clear is not in yet, and the markets will continue to be volatile as we move through the month of February.
Stuart, you mentioned Meta. What do you think the aftermath is after a report like that?
It depends stock by stock, right? Some companies will quickly respond to a sell-off like that, through buybacks and things like that, or, through reassuring guidance to try to support the stock. I think if you look bigger picture from a macro perspective, when you get these kinds of like volatile market shocks, it usually does take the market a period of time to recover from them. The previous, not last week, but the previous week to that, You had 5 consecutive days of intraday volatility that would have ranked in the top 5% since 1982. And when we looked at the history of those types of situations, it took 1 to 3 months for the market to completely recover. So, whether that applies directly to the single stock level, I think it depends on a case by case basis. But I think what that does tell you big picture is when you get that kind of shock, there's usually a reason for it. And it does take investors a bit of time to get comfortable kind of reinvesting.
Well, and then what kind of all clear signals are you looking for? You mentioned that phrase before. If we're expecting that it's going to take maybe 1 to 3 months for the market to recover, how do we know when we arrive at that point?
I think that's the $1 million question. From our perspective, it would be, frankly, the market's just simply behaving in a more rational fashion, right? We've had very volatile markets, both close to close and intraday. We had a steeply inverted VIX term structure. And frankly, from a fundamental perspective, we believe we're in a period where the forward outlook for growth is decelerating. And inflation has not yet reached its peak, and we don't think it's going to peak, for a few months. So I think, look, some clarity on the inflation outlook would certainly help. Some clarity on the policy outlook obviously would certainly help. The Fed seemed to intentionally want to leave a lot of things on the table to give themselves flexibility, but flexibility from the market's perspective means a wide range of outcomes. So, I think frankly here we need to see the data continue to improve, inflation to kind of stabilize, and then this is a little bit qualitative, but just more clarity on where policy is going to go for the next few months, because those forecasts, both from the street and from the Fed themselves, have been quite fluid over the recent history.
If I told you, Stuart, that later this week when we get that CPI results, it will again come in hotter than expected, that would mark 9 out of the past 11 times that will in fact have happened, maybe over 7% increase year over year on the headline. What do you think the market reaction would be?
Okay, I think if we get another above consensus print, the market's not going to respond positively to that, because they're going to have to ratchet up the hawkish pricing of the Fed yet again. And to your point, 7% last month. The market is looking for something 7.25 or higher this month, and we think you may get a similar print next month. So I think that's the biggest challenge with inflation, frankly, is we've had a lot of very strong prints. We've been beating consensus, and frankly, the end is sort of not clear in terms of A, when we're going to see the peak, but B, when we're going to be confident enough to call the peak. Like, you're not going to believe me if I say inflation peaked in March. You're going to want to see a couple data points after that. So again, another above consensus number, and we're actually a little bit below consensus for this week, to be clear, but I think another above consensus number, the market would react negatively to that, because you would just have to increase hawkish Fed pricing, and it would either delay the time we get to the peak or perhaps increase what people think the peak is going to be. And I don't think either of those things are particularly positive for equity markets.
Stuart, I'm going to shift gears here. We're lapping the whole GameStop Reddit phenomenon 1 year in here. And in your position, studying equity derivatives, stock options and whatnot, I'm just wondering how the character of the retail trader has evolved over the last year, if you're still seeing those flows from some of those retail investors in the same trading manner that they were a year ago.
It's a great question, Jared. Look, about 2 weeks ago, when tech earnings were about to kick off, we did see a bit of an increase in retail participation in options markets. But to be honest, that increased participation was coming off what would have been the lowest levels we had seen in 12 to 18 months. So we have seen a little bit of a pickup during earnings, but we are still, again, at the lowest levels that we saw during 2021 or slightly a bit above them. So for whatever reason, and there's a lot of people that speculate why retail gets involved versus doesn't get involved, but that participation has declined meaningfully. And I think it is interesting that it didn't really rebound too much during earnings, especially when those popular tech stocks were reporting earnings, right? And that's a time you might have expected retail to get more engaged from an options perspective. But I think the quick headline here is it's up a bit relative to where it has been, but still at what you would call like 12-month lows.
All right, we have to leave it there, but really great stuff from you. Glad you stopped by here. Stuart Kaiser, UBS Head of Equity Derivatives Research. Well, a quick look at stock futures right now, revealing not a whole lot going on. You can see everything just barely in the green. Nasdaq futures leading slightly, up a whopping 12 basis points. Coming up, we're going to get to some of the biggest market movers this morning, plus the opening bell.
Peloton shares are the top trending ticker on the Yahoo Finance platform this morning, Jared. And it comes after that, I would say, news dump on Friday from the Wall Street Journal saying that reportedly Amazon and Nike have expressed interest in Peloton here. But it's unclear who, if that is in fact true. None of this has been confirmed. Peloton is not out here talking at all ahead of their earnings report later this week. But this continues to be a very fascinating situation. Later in the show, we'll talk to Dan Ives over at Wedbush. He's making the case that Apple should, in fact, buy Peloton. But again, the decision, I think, ultimately boils down to John Foley, the CEO and founder over there at Peloton, that he has that dual class structure that really will help him just keep control of the company if he wants it here. So it's up to him to make this deal to any company that might be kicking the tires.
I mean, this is your story. This has you written all over it. I know you track this quite fervently here. The Peloton is off 85% from its all-time high. You take a look. Let's take a look at the Wi-Fi Interactive. Look at this chart right here. This has been a slow and steady bleed for a couple of months here, but then we have these precipitous drops. This is just gut-wrenching for investors. This is a company that has lost its way, got just overhyped, I think, as part of the pandemic, and that was inevitable. There are always going to be a lot of companies that get the hot money and they can't simply execute with it, but they have to get new leadership and control. I mean, at this point, he's lost control. I'm sorry, you got to give up the company. You got to give up some controller. It's just the way it is, and I don't see why any activist investor would settle for anything less than that, Sazi.
Well, and I'm glad you mentioned that, because you do have that activist investor in here with Blackwell's, who late last month sent really a scathing letter to Peloton here, just demanding that the company is sold, or just some form of options here are looked at to extract value for a brand that was quite hot during the pandemic and does have a very loyal following base. But again, it's almost hard to see who would step up here and pay close to $15 billion, as Dan Ives would suggest, for Peloton at a time when it's producing whopping losses. Its manufacturing footprint is an absolute mess. Its margins are under pressure here, and there has been a rise in competitors in this connected fitness gear. So anyone looking at a Peloton, sure, they have to appreciate the brand strength, loyal following base, but also just have a true belief in themselves that they can come in here and turn this company around within 24 months. Chief, top of the list here, you have to get the manufacturing correct for Peloton.
Yeah, and they went all out. They leased an incredibly expensive studio. I believe it was in Chelsea. They spent a lot of money. Cash flow is an issue. They have to get that under control. There are so many execution flaws in this story. It's difficult to imagine anything other than a complete overhaul of the company, including the leadership, including the control of the company. So, I mean, I can go back to this stock chart on the Wi-Fi Interactive one more time. Here's a max chart. We're going to get that up for you. Looks pretty much the same because they did IPO in 2019, but this big head and shoulders top, this is ugly, very ugly right here. And it portends a downside of close to zero. I mean, 2460 from what, 170 and change, something like that. This stock can definitely go lower right now, just based on technicals alone.
Slumping shoulders on a chart and in life, Jared, never a good thing. But switching gears here, let's look at Hasbro. A little bit of a better story here over at Hasbro, reporting earnings here, smashed estimates on the top and bottom lines. Looking at their gross margin, operating margin, and EPS beat estimates here, really in large part because of strength from their Wizards of the Coast. Now, their incoming CEO, Chris Cox, he led that Wizards business. He will take over CEO officially on February 25th. But you do have to look at the guidance here, Jared, here. And I think that's why you're not seeing the stock react as much as you would think when you come out here and just blow away analyst estimates here. Hasbro looking for low single-digit growth rates this year in sales and operating profits. That is a little bit different in terms of growth rates from what Hasbro has been driving the past few years.
Yeah, and I'm trying to get a chart of Hasbro on the Wi-Fi Interactive here. Not coming up for me. I did want to plot some of the technicals, but I agree with you. They're Here we go. Thank you for that. Here's a 3-month chart of Hasbro. A lot of these companies, this was another high flyer I recall from the early days of the recovery in the pandemic from those March 2000 or 2020 lows. But these stocks, a lot of them have simply gone sideways, and you can see that breakdown into red territory in late January. This is a stock that just needs a catalyst right now, and I would leave it to you, Brian, to name that catalyst. So, all right, so time to move on now to the airlines because we have a deal, and my two favorite airlines, Spirit and Frontier. Okay, that's a little bit of a joke there. They are actually gearing up to join forces, and we do have some notes on that. We're going to be watching. You can see Spirit Airlines up 14% there in the pre-market. I'm just wondering, Brian, what your thoughts are on this particular merger. Well, it looks like we lost Brian, so we don't have Brian, so I'm just going to keep talking here. Unfortunately, I am suffering from my own tech problems, so my computers are crawling. But just getting a check on the pre-market sector action, we do have industrials up about 0.5%, consumer discretionary up about 0.4%, and then communication services, which houses Alphabet and also Facebook, that is up about 0.4%. To the downside, we're just looking at energy, that is the biggest laggard, that is down 0.5%, and then materials, that is off about 0.1%. But I also like to look at some of the other indicators, some of my leaders, my so-called canaries. And this morning we have a few interesting sectors catching my eye. Cannabis, the MJ Harvest ETF, that is up 1.5%. Also looking at risk parity, that's jumping. Private equity and the ARC components as well. If you take a look at some of those components and what they have done over the past year, it's been kind of a disappointment for a lot of those. I was reading a note earlier today, specifically, we were talking about with Sazi earlier about all these zombie companies. But here's a fact. This comes from Deutsche Bank. They're in the ARC components, 25 of them, and there are 40 stock holdings total. They had higher net interest expense than their operating profits in their latest filing. So that means a lot of these companies are simply zombie companies. And it looks like we're gearing up for the opening bell here on Wall Street. And here it is. All right, there's the opening bell, and we're looking at a little bit of a rally on Wall Street. We have the Russell 2000 leading the way just a tad higher. That's up about 0.5%. Looks like the Dow is starting off the day slightly in the green, up about 0.8%. There we go. And you can also see the S&P 500 up a whopping 7 points, and the Nasdaq leading the way higher, up 1.5 points. So I think investors will take that. Nasdaq has definitely been under a lot of pressure lately. Looking inside some of the sector movements here, we are seeing industrials up, and we're also seeing consumer discretionary and energy. Well, I mentioned that energy still trading to the downside here. And I believe we have Sazi back. So let me get you in here and get your thoughts on some of this airline talk that we've been talking about, the merger between Frontier and Spirit.
Well, it was a nice way into this airline stuff with Budweiser ringing in the opening bell. Clearly, a lot of people still enjoy drinking on these airlines. Of course, this deal catching a lot of headlines here this morning here. They're promising $500 million in synergies. If I've learned anything from covering big mergers like this, once these executives get in here and look to find ways to cut costs, boost the stock price, I wouldn't be surprised if there's more synergies than that, Jared, over time. All right, well, we'll leave it there. All good, Jared. All right, coming up, will Spotify sever ties with Joe Rogan? We'll dive into that next. Spotify CEO Daniel Ek is apologizing to employees for the Joe Rogan backlash, saying, though, he won't silence the controversial star podcaster. Yahoo Finance tech editor Dan Halley is here with more. Dan.
That's right, Brian. They're basically explaining that, look, we're going to allow this podcast to continue on and Joe Rogan to continue on, but they're not going to fully cancel him. Now, at last count, there's more than 70 episodes of the Joe Rogan Experience that have been removed from Spotify. That is with the cooperation of Joe Rogan himself. Over the weekend, we saw that Daniel Ek of Spotify, the CEO, came out with a statement of his own, basically about Joe Rogan. And this is in regards to India Ari, who had, obviously the artist, who had pulled her own music and podcast from the platform after releasing a video showing Joe Rogan using a racial slur multiple times throughout his history on his podcast. This is the statement from Daniel Ek, though. He said, "I do not believe the answer is silencing Joe. We should have clear lines around content and take action when they are crossed, but canceling voices is a slippery slope. Looking at the issue more broadly, it's critical thinking and open debate that powers real and necessary progress." And again, that's in regards to Joe Rogan using that racial slur, as well as the COVID disinformation and misinformation that has been spread on his podcast by some of his guests. He has come out and apologized in both instances. Obviously, the Joe Rogan Experience, incredibly important to Spotify, basically the keystone of its podcasting empire. They spent $100 million getting him to be exclusive in their licensing deal. They also purchased Gimlet back in the day, basically trying to build out their entire podcast product there. But Joe Rogan continues to be super important to Spotify, and they're making it very clear that they're not going to get rid of him at all.
Dan, what's interesting, in the Morning Brief newsletter this morning, I looked at the stock price when they originally signed Rogan, May 19, 2020. That is when the blog post went up. The stock price today pretty much is at the same level as it was when they signed Rogan. I understand, they're all about free speech, et cetera, et cetera. But at one point, does Ek just, stand up here and just cut ties, just given the stock price is not performing, the company is still producing losses? Just from a pure business standpoint, you do get the sense Rogan's podcast probably hasn't been worth this headache.
I think, as far as user growth goes, the stock price obviously is going to fluctuate regardless of, to a degree, of what's going on with this controversy here. I think if we see larger artists pull out, Neil Young, huge name, Joni Mitchell, huge name, India Ari, huge name. Are they really going to move the needle as far as losing users, though? I don't think that's the case. I think if they lost somebody like a Taylor Swift, BTS, if some of these huge global names started pulling out, then we might start to see Spotify make some moves about potentially taking Joe Rogan off the air. But they spent $100 million on him. They have their own headquarters in Los Angeles that's basically dedicated to podcasts at this point. They've seen growth. In their last earnings, they talked about growth in the podcast area year over year, though they don't explain exactly how many users are there for podcasts, how many users are there for actually music. And I don't know if they're able to really pull those two apart overall. But I don't think they're ever really going to get rid of Joe Rogan unless there's some. Look, this is about as big as controversy gets. Until there's something worse, I don't know what that would be. I don't think they get rid of him. Or, as I said, unless we start to see huge current global artists go out and start saying they're going to pull their music, would we see some kind of movement on Spotify's part about actually taking Joe Rogan off the air?
Point well taken. Yahoo Finance tech editor Dan Halley, thanks so much. All right, staying on tech, here's your Yahoo Finance stat of the day, $20.1 billion. That is how much Meta spent in the fourth quarter to repurchase its own stock. And all of it appears to be money that has gone up in smoke. Meta lost an astounding $251 billion in market value on February 3rd after serving up a lackluster quarter and first quarter outlook. All right, GameStop is footing $100 million to create an NFT marketplace. And coming up, we'll discuss the move with the co-founder it's teaming up with. GameStop has tapped blockchain platform Immutable X to help build out its NFT marketplace. Marketplace is expected to help GameStop diversify away from its core retail store operations and tap into the growing popularity of NFTs. Joining us for more on the tie-up is Immutable X co-founder Robbie Ferguson. Robbie, good to see you here. Thanks for hopping on the show. Help investors understand first what you do and what you will be helping GameStop do.
Absolutely. So Immutable's been in the space since 2017. We released the first ever multiplayer game on a blockchain. And what we build is NFT technology for businesses to allow them to create and trade NFTs on the most popular blockchain platform, Ethereum, without paying any transaction fees known as gas fees, while making sure their carbon impact is completely net neutral and making it incredibly scalable and easy for these businesses to use. And so essentially what we're doing for GameStop is we are the back end of their marketplace, which means that we will be running all of their trades on top of our software. We'll be creating their NFTs and we will be helping to onboard hundreds or thousands of game studios who'll be using our $100 million joint fund to come and build on this technology platform. We obviously work with lots of marketplaces, but GameStop is going to be a major, major entrant to this space.
And Robbie, can you talk to us a little bit about your cryptocurrency? I believe there's going to be a pool, a fund of about $100 million, at least that's the goal, to be distributed to developers. How is your token involved in this new marketplace that you're creating?
Yeah, of course. So it's not the goal. It absolutely is there. And what we're doing is we are dedicating and earmarking $100 million of our Immutable X token, which is dedicated to community incentives that can be given away to games developers who apply to GameStop's NFT platform. So what will happen is we will help onboard them and build an NFT business for them for their game. And they will distribute their items via GameStop's marketplace. All the while it's being powered by Immutable X's APIs. And the really, really powerful thing about our software is you can sell an item anywhere. So say inside a Fortnite game, and that item can be bought from inside GameStop's marketplace because of the way that our order book operates as a shared backend to every single trading venue we power.
When do you see this launching?
Soon. So I think in the 8K, you'll see a time limit, but we see a much more aggressive launch with them.
And how do you see, looking out, so once it does launch, looking out, let's say a year after this marketplace is established, how do you think it will help drive value to a GameStop?
I mean, it's huge. Like out of every single industry that has ever emerged in the world, look at the total addressable market of NFTs. It's insane. Nothing has ever emerged so fast, going from $100 million in gross marketplace volume in 2020 to over $23 billion in 2021. And we're talking about one of the largest total addressable markets in history of the world. You have $100 billion worth of in-game items bought by gamers every single year. So not Call of Duty copies, but the skins inside Call of Duty or the coins inside Candy Crush, and gamers know none of it. So GameStop is really positioning themselves here as the NFT marketplace that can come in and be this default gaming platform for everyone to trade their digital assets in the same way that someone like Steam or even the App Store is in the incumbent space in the Web 2 equivalent.
And Robbie, this is almost the 1-year anniversary of GameStop, the original phenomenon with Wall Street bets that went on. I think we were having a congressional hearing about this time last year about the whole matter. We're about to, but we know the story here. And I'm just wondering, because when GameStop kind of pivoted, and I know you're not inside the company, they became kind of a black box, and Brian Cohen joined to a lot of fame and fanfare. I'm just wondering if you had any discussions with him personally and how involved the board is in this merger.
We had discussions with every level of the executive at GameStop and in quite detail. And I think we've been able to shed a lot more light on what GameStop's strategy is through the podcasts and press releases we've done over the last few days. Obviously, the NFT marketplace is going to be a core part of GameStop strategy going forward. We're thrilled to be a part of that. And we're also thrilled to bring all of Immutable's gaming content that we're working with to that marketplace.
What's his vision for the company, Robbie? Any sense, when you were putting your company out there, alongside your company's name, your company's rep with a GameStop, which, let's be honest, it has a checkered history here. If you talk to him on where he sees the company out for the next decade.
Become the default gaming aggregator, become the one-stop shop or the ultimate destination by which everyone can come and trade their in-game owned items.
All right, we'll leave it there. Immutable X co-founder Robbie Ferguson, congrats on this tie-up. Look forward to following the progress. All right, there's one number you need to watch for in Disney's earnings out later this week. We'll tell you what it is coming up.
Welcome back. Disney earnings set to hit the wires this Wednesday after the bell. And Brian, I know you got your eye on one number in particular. I'm pretty sure it has to do with their streaming service, Disney Plus.
Gee, Jared, how'd you guess? You're in fact correct. And I'm looking at this number, Jared, because let's keep in mind what happened with Netflix about a week and a half ago when it reported earnings. The stock was slammed by 25% because it came out with a disappointing quarter and a disappointing outlook for subscribers. So Disney, when they report on February 9th, the one number to watch is Disney Plus net additions of subscribers. The street is looking for 7 million. Disney came out in the preceding quarter with 2 million net additions to Disney Plus. That was horrifically disappointing. And as luck would have it, Disney shares are down 17% since it came out with that miss on subscribers back in November of last year here. So you can see that chart on here. Now, the team over at Evercore, they are noting an increase in downloads in recent months for Disney Plus. It's important that the research like that ultimately filtered into the company's quarter, and they do come out with somewhere around 7 million in net adds, or you could see a negative reaction in Disney shares. Let's keep in mind here, when Disney launched Disney Plus a couple of years ago, that was the main driver of the stock price, especially during the pandemic when the parks were closed. So the company was coming out consistently, hyping the growth of Disney Plus. Will that growth really hit a brick wall in November? So again, all eyes on this Disney Plus number here. If Disney doesn't beat it, the stock can fall again.
Yeah, I have to agree with you, Sazi. I think, too, we're just about at peak streaming. I don't know that these companies are going to be able to maintain their breakneck growth strategies. Internationally, there's still a lot of ground to be plowed, but those markets don't pay as well, and they don't command the higher prices that a lot of these Disney Plus subscribers are paying here in the US. That's a problem for Netflix. They've been ramping up their international content, and they've had success with that, but you got to wonder, at what point do we finally see the consolidation that everyone has been expecting over the last few years, where some of these companies just become targets? I want to go to the Wi-Fi Interactive here because I have our streaming heat map up. And this is kind of an apples to oranges comparison. A lot of these companies are simply huge. Apple and Alphabet and Amazon, all these companies have streaming services. But if you sort by performance here, I'm going to go to a 1-year view. And there we go. Some standouts. Fubo TV down 78%. Roku, basically a pure streaming play, that's down 63%. We were talking about the carnage that we saw with Netflix. A lot of these stocks were high flyers, as you said, Brian, in the pandemic. Here's 2020. This was the launch that was basically facilitated by the pandemic. People interested in streaming, interested in that content. But you can see those shares have come back to earth, Brian.
Yeah, that's putting it mildly. And Jared, I like what you said about peak streaming. There's just so much content out there. You have to wonder how many more subscriptions do households need? But this could be bad news. If you are in fact correct about this being peak streaming here, just looking at the stock prices, some of the slowing growth rates out of the likes of Netflix, even Disney Plus, it's Discovery, which is about to digest the beast that is Warner Media from AT&T. Look, CNN Plus is supposed to launch at some point soon, their own streaming push here, and any signs of peak streaming is just not what Discovery needs after they have paid top dollar for that Warner Media asset.
Yeah, and Jeff Zucker stepping down from CNN, that could have potential implications at the Department of Justice for any kind of merger. They're already, I forgot the company, but they are in the process of merging with another company. So everything kind of coming back to roost there. All right, I want to get a quick check of the market here before we go to break. And on the Wi-Fi Interactive, I'm seeing a little bit of a rally here in the Nasdaq, though, but not in the Dow. We see the Nasdaq up about 0.9%, Russell 2000 here up 0.4%, and the S&P 500 up 29 basis points. All right, let's take a look at the sector action, and we can see in the forefront is consumer discretionary that houses Amazon and also tech. So the mega caps benefiting from a little bump here. Also real estate and industrials just barely green. To the downside, we have utilities, materials, and staples, as well as communication services. Those are in the red. Energy kind of flirting with the unchanged line. Want to get a look at the travel sector as well, and we can see Carnival Cruise Lines up 4%, Norwegian Cruise Lines up 6%, and the airlines doing pretty well too. American Airlines up 4%, United up 3%. Guess what? Saving the best for last, Spirit. Spirit is up 13.5%. All right, I do want to get also a quick check of Bitcoin because we saw some very positive price action over the weekend. This is since midnight UTC. Here's a 5-day view, and we got liftoff Friday, and guess what? We got another liftoff earlier this morning. So things looking fairly nicely for Bitcoin right here. Here, I want to take a 1-year view, and this is the record high that I'm drawing this line at right now. You can see we just broke to the upside, so that is the first positive sign. We probably will come back and test, but we don't want to take out these lows here. So that is what we're watching in Bitcoin. It looks like we got a little bit more time, so I just want to check out the banking sector stocks. And we can see Bank of America up 0.5%. Not a whole lot of action in the sector. Morgan Stanley up 0.5%. HSBC up 0.75%. All right, coming up next, we got a brand new hour of trading on the first day of this week. Coming up. stocks mixed to start the trading week, and we have another hour to kick off here as the world revs up for 5G connected smart cities. The Jacobs Engineering CEO, he stops by to talk their latest acquisition, Streetlight, how AI is going to shave minutes off your daily commute, and Peloton, geared up for a potential Amazon buyout with the stock sitting near all-time lows and off 85% from its record high. Dan Ives of Wedbush Securities will tell us why it's Apple and not Amazon that should buy the beleaguered fitness gear maker. And Bengals versus the Rams were just a week away from the Super Bowl, and crypto advertisers are clamoring for screen time on one of the world's busiest marketing blitzes. Echoes of 1999, anyone? I'm Jared Blickery, along with Yahoo Finance's Brian Sazi, here for another hour. And we also want to take into consideration what the market is doing right now. And for that, we're going to bring in Yahoo Finance's Ines Ferre. Ines, I was getting a little bit excited there. What are you watching in the market this morning? Because I'm seeing the Nasdaq up, the Dow down, just another mixed week here.
That's right. We're watching the Nasdaq right now, up 0.8%, Jared, with consumer discretionary leading those gains. And inside consumer discretionary is Amazon. So let's take a look at the Nasdaq 100 on our Wi-Fi interactive board. You can see Amazon up almost 3%. We've also got some of the other mega caps that are a little bit higher, and you're looking at Apple, Alphabet that's in the green, Microsoft relatively flat. We're also watching Tesla up more than 1.5%. In fact, let's take a look at the electric vehicle space. We can see some gains here in the EV space. Rivian up 3%. You're also taking a look at Lucid that's up more than 1% as well. Checking out the travel space, take a look at this. A lot of green on our travel chart with the airlines leading higher. Of course, you've got the Spirit Frontier deal that was announced. And I also want to look at the trending tickers because we have been watching BABA as the #2 trending ticker on our Yahoo Finance page, down more than 5% right now. And this is after a Citi note highlighting an SEC filing for ADR's registration. And that would be a sign, perhaps, according to these analysts, that SoftBank may be intending to sell part of its stake. And this would, of course, weaken sentiment when it comes to BABA, which has been really beaten down. Now, I did look at what analysts are rating Alibaba after we've seen this big decline in shares since last year and all the regulation that's going on in China. Analysts are pretty bullish on this stock still. You've got 54 of them that are tracked by Bloomberg that have a buy rating, 6 hold and 1 sell, with an average price target of $190. And then I also just want to mention Snowflake up more than 9%. This is after Morgan Stanley upgraded the stock to overweight, citing a pullback in share prices and also the company executing ahead of plans. And then finally, just mentioning Bitcoin up more than 5%. Bitcoin seeing a 5 straight day of gains. Its longest winning streak since September. You've got Shiba Inu also there that's up 31% right now. Jared?
All right, I'll take it from here. Thanks so much, Inez. Okay, the underperforming team at Kohl's is digging in their heels against activist investor McCallum, rejecting 2 recently reported takeout offers and adopting a poison pill. McCallum is returning fire, saying they are disappointed and shocked by Kohl's hasty rejection of buyout interest. Joining us now is McCallum managing partner Jonathan Duskin. Jonathan, always nice to get some time with you. So you have had the weekend to stew on this one, which really came to a head on Friday afternoon. How do you plan to respond here?
Well, we put a rather brief note out on Friday. I think you just referenced, Brian, and it's very disappointing. This is 2 elements of it. First, that after really 2 scant weeks, they rejected these offers. Right? It's hard to imagine they really gave them any attention. It's hard to imagine you could get a non-disclosure agreement signed in a week, no less evaluate 2 offers. They didn't give them access to management. I doubt they had access to a data room. They really didn't do anything to engage with these potential buyers and are doing everything they can to shut the process down. They obviously could have engaged with the buyers, tried to provide them information to see if a higher price was available. They didn't do any of that. They sent a very chilling message to the market and to other potential buyers by putting in a poison pill. And this is a really aggressive tactic. We don't see it that often. And even within the pantheon of poison pills, this is actually a very aggressive poison pill with a 2-tier structure, gives the board incredible latitude and discretion to determine what takeover offers they will and won't engage. and doesn't allow a possible buyer to engage with management. They have to come with a fully financed offer without the ability to do any diligence. So it's really very disappointing. Speaks to what we've been saying about this board being very self-serving, very entrenched, obviously looking out for their own seats and not really looking out for the shareholder who they obviously represent, and that's their fiduciary, and that's who they work for. And I think they're forgetting that.
And you are a shareholder, 5% holder over at McKellum, and you are seen as a constructive group. I remember following closely your campaign at Bed Bath & Beyond, which unlocked, I would say, a lot of value here. How do you put pressure on this company's board to ultimately do the right thing?
Well, as you might remember, Brian, we nominated a slate last year, and we settled on adding 2 directors from our slate and 1 mutually agreed upon. And as we've written in a couple of our letters now, we most likely are going to have to run another slate here. This board doesn't appear to be working on shareholders' behalf, and it's really troubling to us. And we'll continue to put pressure on the board by nominating another slate, and we'll give shareholders an opportunity to weigh in. Another thing I would add about the poison pill that was particularly disheartening was they didn't even put it to a shareholder vote. Obviously, they have an AGM coming up relatively soon, and this is something that more often than not shareholders vote on whether they want a pill. And the board, waived that opportunity and bypassed that opportunity, really trying to keep control of the boardroom and chill this process to, I think, preserve their seats.
Jonathan, do you think Amazon has been kicking the tires here on Kohl's?
Look, I don't know for a fact. It's interesting to think about, Amazon's move into brick and mortar retailing. They announced that earlier in January. And there was one article that actually compared Amazon to Kohl's, saying if Amazon gets into apparel retailing, they'll look a lot like Kohl's. We know that Amazon has the return kiosks in Kohl's. So there's already a partnership. So given Amazon's desire to get into brick and mortar retailing, get into apparel, the struggles they've had in their own apparel offering, the relationship they already have with Amazon, it seems to make some sense.
And Jonathan, just speaking and thinking a little bit more broadly here, if I'm an investor in a company, it doesn't have to be Kohl's, but using Kohl's as an example, you talked about the poison pill and how the entrenched management, well, they're entrenched. If I'm an investor in a company and I think the company should change, what should I look for in terms of the company's structure and also their operating agreements, their bylaws, to make sure that there is an opportunity for change instead of just carrying out the entrenched interests here?
Well, really, the mechanism for change is a contested election. Interested parties like ourselves, large shareholders, running their own slate of directors and trying to bring change, bring retail expertise into the boardroom, bring experience that we think is more relevant than this current board has into the boardroom. And then I think the board can operate much more effectively. And particularly if there's a shareholder in the room, we think that makes a big difference for boards when there's somebody that actually owns a large stake in the company that sits in the boardroom and really helps focus everybody on generating shareholder returns and creating value for shareholders. So for us, that's really the mechanism we use. As Brian points out, we've done it quite a bit in the past. So I think interested shareholders should watch the evolution of this contested election and to see how things progress. And hopefully, I believe most shareholders will be supportive of our efforts. I think everybody's very frustrated with Kohl's and the stock price and their performance, and are probably going to want to see some change here.
Jonathan, one of the reported bids for Kohl's came out of Starboard, I believe $9 billion. So now that Kohl's has adopted a poison pill, is that deal off the table, or the Starboard folks potentially back working some numbers here and may come back for an offer, or that deal is just up in smoke now because of the poison pill?
I doubt it's up in smoke. As restrictive as this poison pill is, and again, I think it's unusual even by poison pill standards, it's still a stop, look, and listen mechanism, right? The board ultimately can't thwart the shareholders achieving value. And I don't know what Starboard's doing. I don't know what their plans are, but I'd be surprised if a company who's very well known for being aggressive fighters. Darden is one of the greatest examples, I think, of their past campaigns. I'd be surprised if they're just going to pack up and go home. But again, I don't know what's on Starboard's mind. And the board at some point is going to have to acquiesce. We think there's interest far beyond the two buyers that have been mentioned, and we think this is an asset that can generate a lot of interest in private equity and with strategics. And we really do think the board is ultimately going to have to run a process, even though they've neglected to do so at this juncture. We do think they'll ultimately have to acquiesce and run a real process.
What I don't understand, and I used to be an analyst, Jonathan, covering retailers, and at one point I did cover Kohl's. What I don't understand here is the stock price has done squat for a decade, margins under pressure for a decade. Is there just a cultural problem inside Kohl's where they won't even entertain this notion of splitting off e-commerce from retail or selling the company or spinning off real estate assets? What is there something wrong in this company's DNA?
It's a fair question. I guess anybody looking from the outside in is going to scratch their head and wonder the same thing. By the way, Brian, it's not 1 decade; it's 2 decades. Sadly, the price today
My apologies.
Where it was in 2002. But we see this in a lot of campaigns that we run. We see this in a lot of troubled companies. There's a complacent mentality on the board, and that sometimes permeates the organization. And we think with the right board, the right expertise, the right retail knowledge, the right retail experts in the room, this can be an incredible company. It can be a great company. Kohl's used to be when you covered the stock back in the 2000s, this was a company that outperformed all other forms of retail. And sadly, for whatever reason, they've become complacent. They haven't been able to find the right formula of the merchandise assortment, a price value equation that is resonating with customers, but we really think it can. There's no reason it can't. There's been so many examples of other great turnarounds in retail, and we think Kohl's could be the next one. And we're really poised to roll up our sleeves and get involved and fix this company and create meaningful shareholder value.
And we got time for one more here, Jonathan. I was looking at that sideways price action going back to their IPO days, almost, the last 20 years, dead money. What's the number that you have in your head that you would like for this company?
It's a bit of a tricky question because I think part of the answer is who's running the business, who's on the board, what does the structure look like? So I think, we wrote in one of our letters, we think it's a $100 stock, but I don't think that can be achieved in the current board management configuration. I think change has to occur for that to be realized. And I think short of that, I think we said this in one of our letters very specifically, it's either change a significant portion of the board and let's get some real retail experts in there with a vision to fix this, or sell the company. Because if the board isn't changed and isn't refreshed and isn't reconstituted, we're going to be back to the status quo, and we're going to, get the same results we've gotten for 2 decades. And in that set of circumstances, I think the only way for shareholders to really achieve value is through a sale. Give it to somebody else and let somebody else, fix this business, because this board is not capable of doing that, hasn't proven to be capable of doing that. So absent material change in the boardroom, I do think the business needs to be sold for shareholders to realize any reasonable performance.
Bizarro situation indeed. Glad we were able to reconnect on this one. McKellum Managing Partner Jonathan Duskin. We'll talk to you soon. All right, straight ahead, the Beijing Winter Olympics needs some viewers. We'll have the numbers and other top business stories next. The opening day of the Winter Olympics showed a sharp decline in viewership. The event drew nearly 16 million viewers in the U.S. across NBC's streaming platforms, which is a roughly 43% plunge from the kickoff of the Games in 2018. Viewership for the Olympics has dropped in recent years. The Tokyo Olympics in July drew the lowest audience for the Summer Games since NBC started broadcasting the Olympics in 1988. NBC said the company expected this drop because of challenges caused by the pandemic. Delta is urging the U.S. Justice Department to place unruly passengers on a no-fly list. In a letter to the Justice Department, Delta CEO Ed Bastian said there should be zero tolerance for behavior that affects flight safety. Bastian noted that this behavior on the airline increased by 100% since 2019. To date, the airline has put more than 2,000 passengers on its internal no-fly list for refusing to wear a mask and has submitted about 1,000 names to the Transportation Security Administration to pursue civil penalties. And crypto might be the biggest player in the Super Bowl. Cryptocurrency exchanges are shelling out big bucks to run ads during Sunday's game between the Los Angeles Rams and the Cincinnati Bengals. Coinbase, FTX, and Crypto.com are all expected to run ads during the big game. This year, a commercial spot in the game is more expensive than ever, with ads costing as much as $7 million. Crypto sector is expected to spend $160 million on sports sponsorships this year, according to the sports consulting firm IEGA. And Jared, crypto, they have been raising a lot of money, so not surprising to me, they are dipping into their very large pockets and to use these to try to plaster the message all over the Super Bowl.
I'm not surprised at all, but my biggest concern is this a top? Is this reminiscent? Does this have echoes of 1999? I went back and I looked at some of those Super Bowl advertisers from then, basically new tech companies. I'll go through a few names. Some of them you've heard of and some of them you haven't. Autotrader.com, still around. It looks like OnMoney.com, no, they went defunct in 2002. Pets.com, that was probably the banner, the poster child for the internet bubble. And guess what? They were liquidated in 2000. And I think part of them became PetSmart.com. But then some of these other names, HotJobs.com, well, guess what? That was bought by Yahoo in 2002, later purchased and liquidated by Monster.com in 2010. You got to imagine that Yahoo took a little bit of a haircut on that particular one. Lifeminders.com, hadn't heard of that. Monster.com, they're still active. But I think the bottom line here is just coming back to the current situation. When I heard Crypto.com was purchasing the naming rights to the Staples Center, that told me there's a little bit too much enthusiasm surrounding Bitcoin and crypto right now. Nice to see some positive price action on Bitcoin over the weekend. I have to mention that, but I don't know. I think a lot of these names that we're talking about here and that we see on the Super Bowl simply not going to make it.
I hope I get some Budweiser ads, Jared. Some Budweiser ads, some Coca-Cola ads. It can't just be all crypto. I understand they have the big pockets, but so does Big Food. I want my potato chip commercials. All right, switch gears. A big deal in the infrastructure space. We'll have an exclusive interview with the CEO of the company behind it on the other side of the break. Jacobs Engineering said today it will acquire mobility analytics player Streetlight Data for an undisclosed sum. Founded in 2012, Streetlight is a big data platform that helps cities unlock mobility insights from location data pulled from smartphone apps. Joining us now in a Yahoo Finance exclusive is Jacobs Engineering CEO Steve Dimitrio. Steve, nice to see you again. It's been a little bit. Congrats on this acquisition. Why are you making this deal?
Okay, overall, there's a growing need, no matter what the industry is, for localized and data solutions that track the movement of people, goods, and services. And whether it's climate response or cyber issues or social equity or whatever, that's the importance around the world. And so the acquisition of Streetlight Data gives us a tremendous edge on providing those solutions.
Just tracking, you've been acquiring companies and starting to, I would say, pivot Jacobs more into the data space. Why is that so important looking out over the next few years?
4 years ago, we started this transformation. We've deployed over $7 billion of capital. The first few years were around, building our domain of important markets around water, environmental, cyber, and national security, and others. But the last couple of years, we've been focused on now bringing innovative data solutions to all of those markets. And we started with the Buffalo Group, the Black Links, and now the Streetlight acquisition. We've actually been entering into venture capital, where we've been putting seed investments, companies like Hawkeye 360 or Microgrid Labs, in forming partnerships, and then even broader, more recently, big data partnerships with the likes of Palantir and others. And putting all that together, we've really built up this unique data solutions platform.
And can we just take a step back here? Streetlight seems like a really interesting company. When we talk about connected cities, I think most people don't really have a handle, including me, on just how drastically things could change and improve over the next 5 to 10 years. What specifically is the technology they're using? What are they monitoring? And what is the net effect of all of this going to be for the average consumer?
If you just start with, the mission that both of our companies have around, climate response and ESG, social equity, and look at, say, the climate crisis that we're facing. You just mentioned cities. Cities put out about 65% of the greenhouse gas emissions that are creating that crisis. Transportation in particular is around 30% of those emissions. Streetlight brings innovative solutions where they're able to aggregate data from multimodal sources. And it's, millions of mobile devices, it's connected vehicles, it's IoT sensors and geospatial acquisition. And then they've been able to combine that with a real unique set of algorithms and machine learning process technology that enables to take all that data, contextualize it, and bring it into an area where it provides clients meaningful data to then plan and invest and develop solutions around those areas that I talked about.
And all of this is incredibly complex. The company's centered around artificial intelligence, as you've been talking about. But I'm just wondering, and still kind of getting big picture here, when we talk about artificial intelligence and all the investment that's necessary, and you take a look at, for instance, the modern car, you take a look at a Model Y and the incredible engineering that goes into autonomous driving, what's the net effect here for consumers? I'm trying to get it. How are people's lives going to be impacted here? Are they going to be driving less? Are the vehicles going to be such vastly different machines, and that's what achieves your ESG goals? I'm just trying to understand exactly how the consumer is going to be benefiting from this in late 5-10 years.
Yeah, this is huge for the consumer, for humanity overall. I mean, when you think of traffic congestion in major cities, Streetlight has already entered into arrangements with several of the Department of Transportation, working on traffic congestion solutions. In some cases, moving people out of cars into public transportation, also connecting people across communities, social equity, bringing infrastructure to entire communities rather than what's been a problem in the past, just some of the focused higher economic cities. And so it's a variety of opportunities to really improve human life, quality of life, and really address the major challenges that are facing cities and communities around the world.
Steve, the last time we spoke, I believe, was about 1 year ago today, and there was no infrastructure plan just yet. Now it has been passed. Have you seen an uptick in your backlog because of this new plan?
The key is the pipeline, because as we mentioned several times in various media recently, that this is going to phase in, over the course of this year, and then really start to ramp up in 2023 and beyond. And we have seen a pickup in pipeline as we look at the next several quarters of this year, and even as we're entering into 2023. So we're obviously excited about the overall infrastructure bill, the IIJA, and we are starting to see the pipeline improve.
Well, congrats again on the deal. Jacobs Engineering CEO Steve Dimitrio, always good to see you. We'll talk to you soon. All right, on the topic of infrastructure, in the 11 o'clock hour, Akiko Fujita and I will sit down with Transportation Secretary Pete Buttigieg. You will not want to miss this interview. All right, coming up, it is in fact M&A or Merger Monday, I should say. Frontier is buying Spirit Airlines in a total $6.6 billion total deal value, creating the fifth largest U.S. airline. More on what that means for the airline industry straight ahead.
Welcome back. Discount carrier merger Monday. Frontier Group has signed a definitive agreement to buy Spirit Airlines. This is a cash and stock deal that values Spirit at a fully diluted equity value of $2.9 billion. Deal is expected to close in the second half of 2022. You can see Spirit is up 13% in the trading today, and Frontier Group up about 0.5%. We want to get all the details of this and more for some analyst cover. We are bringing in Mike Boyd. He is the president of Boyd Group International. Mike, thanks for joining us here today. Just your initial reaction. I guess a lot of people are saying this makes sense. These are two discount airlines, but it doesn't mean that they're automatically going to be tons of synergies. This is going to take a lot of work to merge these companies, right?
Well, absolutely. Really, what we're going to be facing is probably one less paint job out there on the ramp. These airlines don't necessarily compete with each other. Neither of them, other than they have a little bit of operation in Denver, Frontier does, but there's two other hubbing carriers there. There's no single market that's going to be completely gobbled up by these, so it's going to be almost a non-event. The real issue is putting these together. Yeah, they're both Airbus operators, but one Airbus might have landing gear that's overhauled on hours, and one might have landing gear overhauled on cycles. You got to put those together. It's going to be a very tough thing to do, but they'll pull it off.
Mike, we're all wondering this. If this deal does close, does Flying Spirit get any better?
No, not at all. I mean, I don't mean Flying Spirit, but flying in any event. A merger doesn't improve or disprove anything. I mean, I've got a lot of respect for trying to run that airline on a day-to-day basis. But the fact of the matter is, our air transportation system is one that it's always going to be a hassle to use. I'm sorry if people don't like that, but that's what it is.
And we've seen these deals before. I mean, the airline industry has a long storied history of mergers and breakups, mainly mergers. I'm just wondering, is this a sign of more deals to come, or is this just kind of a unique situation?
This is a very unique situation. Remember, these are wildcatter airlines. They're not like American, Delta, United, Southwest. These two carriers go places where they make money. If they don't make money, they leave. They're wildcatters. So from that perspective, the average consumer won't see a whole lot, and there's no other airlines out there that make a sense to merge. I don't know if these two make any sense to merge. You know, they'll get rid of a lot of overhead. That will make up a lot for the $500 million that was lost collectively with the two last year. But I think, both airlines are well managed. So whatever happens, I think we're not going to see much as far as the consumer goes or competition goes.
Mike, do you think the deal will get regulatory approval? I can see the headlines right now. Deal would potentially raise fares on consumers.
Yeah, well, that's nonsense because the markets they go into, they try to make. They're not competing with anybody. They're not competing with each other. That's a typical Econ 101, leave it in college kind of conclusion. The fact is, I think this is just going to be a situation where the consumer's not going to have less choices. They've always had these choices. It'll be a choice in the same paint job.
And we're talking a lot of airline stuff in the news, especially with COVID. We're talking about unruly passengers, and I think JetBlue actually has the worst track record for 2021. That's according to the Journal. I'm just wondering, is this going to improve I don't want to say cachet? Is this going to improve the image of any of these airlines, or better enable them to handle unruly passengers, for instance?
It won't do diddly. All we're doing is repainting some airplanes, and they'll probably be flying the same place. So all the hassles that we have enjoyed over the years for air travel will remain.
And Mike, Delta CEO Ed Bastian looking to create a no-fly list. Does that solve any problem here?
I don't know if it does or not. I think a lot of this stuff. Remember, 20 years ago there was big issues of violence in the cabin, and I having worked with flight attendants and done some of that stuff, I can understand this. But it's not like getting on a flight to Chicago is like doing a tour in Vietnam. When we get rid of the mask nonsense, we will get rid of most of that. That's next month supposedly.
All right, and I just want to pull up the Wi-Fi Interactive here, just look at some charts. A lot of these airlines, and if we could pull it up, a lot of these airlines have been dead money over the last year. It's been a very tough recovery for a lot of them. Here's Delta Airlines. Let me put a 2-year chart, and you can see still underwater from the pandemic. I'm not going to ask you to comment on the stock prices here, but just in general, what's it going to take for these airlines to be able to return to the profitability that they had before, which was in fits and starts, but the profitability that they had before the pandemic?
Aggressive, foreseeing management. You have United Airlines. Basically, they announced they're pulling out of China for the next 8 months. That kind of thought process, where you move very flexibly, as United is doing, that will get them back into the black. We got to realize we have a totally different air transportation system. Hey, I haven't made more than one business trip in the last 2 years, and I'm in this racket because I can do it the way we're doing it here. That's going to change the mix. Airlines that recognize that, like United is doing, are going to do very well, I think, going forward. Same thing with Delta.
All right, we're going to leave it there. Really appreciate all your insights here and jumping on with us at the last minute. Mike Boyd, president of Boyd Group International. Well, Peloton is the top trending ticker on the Yahoo Finance platform, the stock on a wild ride over the weekend. And that's on reports that several companies are exploring bids for the company, not the least of which is Amazon.com. We're going to discuss all of that with Wedbush's Dan Ives. Welcome back. Rumors are swirling about Nike and Amazon potentially exploring bids for Peloton as the company struggles to maintain its pandemic-fueled growth. Could Apple be in the mix? Wedbush analyst Dan Ives joins us now to discuss. And Dan, thanks for coming in here today. Lots of headlines from the weekend, and we know what an execution disaster Peloton has become. But Apple's an interesting twist to this story. Just a theory, it seems like. But what's your case?
I mean, I think it's more than a theory. I think it comes down to, from a health and fitness perspective, you look at Peloton's unique asset. And I think from Apple, it would be defensive if an Amazon went after it. I mean, they cannot let Amazon get hold of Peloton. But offensively, in terms of fitness, health, Peloton, in terms of the subscription growth and its unique sort of subset into the lives of consumers, that would give them a significant leg up on a lot of their health and exercise initiatives. And if you look for Apple, I mean, they never thought something like a Peloton would potentially come into their lap. This would be about one quarter of free cash flow if they potentially bought this.
So Dan, let's say Apple does come in here, they scoop up Peloton. I believe your valuation estimate was $12 billion to $15 billion on Peloton. Does that acquisition help Apple sell more Apple Watches?
Well, it's all part, Brian, it's all part of the ecosystem, because you look at Apple Watch, you look at the subscription, that's a big focus in terms of how they're really going to build this into a significant business over the coming years. And, I guess some would say, well, Apple could just do it themselves. I mean, why would they have to buy Peloton? I mean, Peloton has a unique technology, unique brand. And I think right now they've sort of hit a brick wall of growth. I think if you look at Fitbit, GoPro, and we'll call other successful consumer strategies at one point, their issue is that they never hit the bid. They never went into a broader ecosystem. So, of course, a lot of this rests on Foley in terms of on the Peloton side. But for Apple, I think it would be a coup if they ultimately bought this asset.
All right, and let's get back to the headlines from the weekend. Nike seems to be in the mix, Amazon as well. How do you think this product, how do you think Peloton would fit into their product lines and ecosystems?
Well, it's from a consumer brand. I mean, there's a cross-sell streaming piece. And then also in terms of just exercise and subscriptions, that's, as the pandemic wanes, that's going to continue to be here. That's not going away in terms of the coming years. I think more and more consumers, whatever the mechanism, they want to work out within their houses. Many are going to go back to gyms, but I think it's a multifaceted approach. You look at Nike, you look at Lululemon and some other sort of areas. I mean, they could clearly look at a Peloton in terms of from a brand and from a subscription service, but then it's technology means. I mean, look at Amazon and Apple. I think that's front and center. Who would look at this? Now, the question is, would they entertain a bid? Are they potentially for sale? And I think right now, just given the activists, given the challenges they have on growth, I view this as a potential acquisition for Apple that would make a ton of sense for a company, since Beats is not a major acquisition. That was $3.2 billion. So I think this is really a very interesting potential asset. And just lastly, no one cared about Activision. They hated it, right, in terms of investors, except for Satya Nadella and Microsoft when they acquired it. So it just speaks to what we're seeing, a theme in terms of strategic acquisitions in 22.
So Dan, you essentially think Apple can save Peloton because for the past year, Peloton has been an operational nightmare, just consistent earnings warnings. They overbuilt in terms of capacity. There would be a lot that Apple would have to clean up at the company.
And I think it would be something that could easily be cleaned up because there's a brand, there's a unique ecosystem. You'll have almost, what could be north of 3 million subscribers. And it's something that they could significantly build into that, that Peloton ecosystem that could now be within Cupertino. And I think these are things, Apple and Cook, they're tacticians from an execution perspective. But importantly here, if Peloton is not up for bid, Apple is not going to go aggressively after it. It's the fact that if they up for a bid, Amazon strategically, Apple's going to have to do it defensively in terms of a blockade perspective. And then from an offensive, this is an asset that would come along every decade or more. And that's why they'd have to go after it.
And Dan, we have you here. We got some time. We just want to pick your brains on a couple of other stocks that you follow. Tesla, if we can pull up the Wi-Fi Interactive, this is a year-to-date look. A lot of stocks under pressure, especially growth stocks. It's down 13%, but I'm going to show you our heat map here. All of these stocks year-to-date, except for a couple there at the top, Toyota Motors, half of these stocks are up 20% or more this year. I'm just wondering how Tesla fits into your equation. I know you have some higher price targets than some of your peers. Just your thinking in general as we emerge or hopefully emerge from this environment where growth stocks are just getting absolutely clobbered.
Okay, it is going to be a tough year for growth in terms of a bifurcated tech tape. And I think you've seen that with the likes of Facebook, Meta, as well as Netflix. But in terms of Tesla, they're going to continue to have to execute in terms of on the supply chain issues. I think that call definitely made investors nervous in terms of some of the supply chain challenges. But you look what's happened in Austin, you look at the profitability in terms of China, that continues to be the core growth story here. Is I think they ultimately, this is a valuation that will continue to be a bull-bear debate, but I think they'll prove it again in 2022, continue to be our favorite way to play EVs.
Dan, I'm not sure about you, but I'm still recovering from that reaction to Meta earnings last week. It was just really absolutely jaw-dropping to cover that. As an analyst that has covered tech for a while, what is the aftermath of a report like that? Do you think it will just continue to put pressure on the broader tech space?
I think there's some dark days ahead for Facebook. I mean Meta. Because look, you could change your name every month if you want. Their strategy is ultimately social media and digital advertising. And you look at Apple in terms of those iOS, that's a gut punch of the Facebook business model along with TikTok competition. I view more as isolated rather than necessarily painting tech with the whole brush. And I think, Brian, that's important. This tape, tech, 90% plus of earnings have been beaten raises across tech. You could focus on Meta, you could focus on Netflix. You'll see some fall by the wayside. I still think it's a very robust fundamentals when it comes to cybersecurity, cloud, 5G, and even digital advertising. But I mean, Zuckerberg and others, they have an Everest-like uphill battle to get back to growth.
And Dan, we got time for one more here. I'm going to give you the floor. Any particular ticker or industry group on your mind catching your eye today?
I think it's cybersecurity. I think probably the most oversold sector that I've seen in years is cybersecurity. Just given what we're seeing in terms of the fundamental performance, where we are in terms of the move to the cloud and the heightened risk. I look at names like Zscaler or Palo Alto, Hannibal, CyberArk, among others. I think these are cybersecurity is one I put an asterisk around. I think this is going to be a subsector that significantly outperforms this year.
All right, we're going to have to leave it there. Wedbush Securities own Dan Ives, thank you for joining us as always. And coming up after the break, stocks currently, let's see what they're doing. They're in rally mode. Even the Dow is up. We can see the Dow's tacking on 77 points to the gains that is experienced so far. And S&P 500 up about 0.2%. The Nasdaq up 1/3%. All right, just over an hour into the trading day. Coming up, we have much more on today's market action. Before we go to break, take a look at some trending tickers on Yahoo Finance. And I have these up on the Wi-Fi Interactive. Oh, we got them there. Peloton up 21%. Alibaba down 5%. Spirit, we've been talking about that, up 15%.
Welcome back to Yahoo Finance Live on this Monday morning. And Jared, I was scrolling or perusing the Yahoo Finance trending ticker page. One thing stood out to me, seeing pretty big moves in all things crypto. Shiba Inu up close to 40%, Marathon Digital catching a bid, Coinbase, you name it. All the crypto stocks seem to be moving higher today.
You bet, Brian. And let's go to the Wi-Fi Interactive and chart the price action that we've seen in Bitcoin recently. You can see it's up 5% over the last 24 hours, but over the last 4 days, we got a nice pop on Friday, is up 17%. And on that strength, we are seeing some signs of life in a sector that we really haven't seen attract a lot of money recently. So you can see at the top of the list, these are crypto stocks, by the way, backed. That company is up 20%. Then we have Galaxy, Digital Galaxy, that's up 12%. Marathon up almost 12%. A lot of these names we talk about, but they have been in the black, excuse me, in the red over the last 6 months. There we go. I'm trying to find my 6-month tab, and we can see some of these names down 73%. There's Bit Digital. We can see they're getting a nice pop, up 17% over the last 4 days. Here's that year-long chart, and you can see just kind of bleeding lower there. And finally, here's a 2-year look of that. You can see here is the original excitement that we got at the beginning of last year. That was not GameStop. This was just a regular crypto enthusiasm at the time, but really just falling off those levels. So most of these stocks kind of broken stocks right now, and they're growing. They're probably going to be that way until Bitcoin finally regains its footing. Now let's just go back quickly to the technicals for Bitcoin. I'm going to dial this down to a 1-year chart. Here at record high that we had, just short of 70,000. And the fledgling move that we have here is just breaking this negative trend line. So that's the first step in the right direction that we want to see. So this is a 1-year chart. I'm going to bring it down to a 2-month chart and put some candlesticks on it. So the next thing we want to see is if there's any kind of retracement, we want to see a series of higher highs and higher lows. And as long as that happens, well, then it's in an uptrend. So having said all that, some nascent signs of life in a Bitcoin rally, and it's benefiting some of the crypto stocks, those that have exposure. But Brian, I think there's still a little ways to go here before crypto really regains its institutional footing. We know that there are a lot of dip buyers out there from institutions, but I have to think that with Goldman Sachs and JP Morgan, everybody gearing up for crypto, they'd like to buy it at lower prices. Just a theory.
That point well taken here, Jared. And I was just thinking back briefly while you're running through crypto. Really good stuff there. New friend of the show, Mike Boyd, really just coming out aggressively on all things airlines. That Spirit for Frontier deal taking center stage here this morning, getting Merger Monday started off on a good note. What are you seeing in their stock prices?
Well, let's take a look at the travel and reopening page. First thing I'm going to show you is there's a lot of green here. I think I went over this on the open, and it looks like a lot of these stocks are adding to their gains. This is Carnival, obviously not an airline, but just checking out the relative performance, indeed pretty close to session highs. Let's take a look at Spirit Airlines. It's so small that it's difficult to find here. Let's take a look at the market caps. This is a $2.7 billion company. I'm just scanning here. That looks to be definitely the smallest of any of these guys here, but let's pull up a chart. Spirit Airlines, along with many airlines, have been dead money for some time simply because of the pandemic. But guess what? On a 5-year chart, goes a long time before that. In fact, if we pull up a max chart, you can see that this stock, which peaked in about 2014, beginning of 2015, has been in a solid downtrend ever since. And in fact, this trend line is pretty steep here. Not going to be that difficult to break, I would say, but there's a ton of resistance here. So absent any material, we were talking about this with Mike Boyd. He doesn't think there's going to be any change other than a paint job. There are going to be some synergies to be realized, but not the biggest hopeful. I'm not exactly too hopeful for the bullish prospects of this stock. There, I got it out.
Yeah, there we go, Jared. Spirit Airlines on the charts, losing altitude. Real quickly, though, before we go here, Peloton. Hit me with the Peloton chart, Jared.
Ooh, all right. So we're going to go to our trending tickers. I think that's going to be at the top of our list here. And Peloton is another stock. I've said dead money so many times, but guess what? It's a thing. And we are in a market environment where we have a lot of stocks that simply haven't done anything for 2 years, like Peloton has. It's up 7% over 2 years. At one point, I've forgotten how many percentage points it was up, but it was a multiple. It was up 3 or 4 times its starting place at the beginning of last year. So Peloton, this was a giant warning flag. They've got that head and shoulders. Once that neckline was broken to the downside, I think we're looking at potentially even lower prices here. But with the merger potential here, I think probably going to forge some kind of a bottom. But if unless it gets into a bidding war, I don't have much hope for this stock just yet.
Slumping shoulders on Peloton. Maybe they should hop on the bike. And in the next hour, Kiko Fujita and Brian Chung, they actually will start the show with a Peloton analyst that covers the company, of course. So we'll look for more analysis there. And of course, we'll also be live in just a few minutes with Transportation Secretary Pete Buttigieg. Do stay tuned for that. I'm looking forward to talking to him on all things infrastructure in this country. That's it for me and Jared. I'll hand the ship now over to Akiko and Brian Chung. Talk to you soon.
Welcome to Yahoo Finance Live and happy Monday to all of you. I'm Akiko Fujita along with Brian Chung. We are seeing stocks pushing higher as Wall Street looks to build on the S&P 500's best week so far this year. All three major indices firmly in the green now, with the Nasdaq leading the gains, up about half a percentage point right now. Merger Monday sends airline stocks soaring. Spirit and Frontier announcing a marriage of low-cost carriers, but will the deal get past regulators? We'll be discussing that in just a bit. Another day, another apology. Shares of Spotify are now pushing lower as CEO Daniel Ek addresses another controversy involving podcast host Joe Rogan, why he says removing Rogan from the platform isn't in the cards. And the nation's roads taking a deadly toll, with more than 3,000 deaths reported every month. Transportation Secretary Pete Buttigieg is going to be joining us this hour to discuss the actions his department is taking to curb those numbers and the role self-driving cars could play to keep pedestrians and drivers safe. We are beginning this hour, though, with news of Peloton. Speculation never stops, Brian. The company's shares seeing gains accelerating on reports that it could be an acquisition target, with reports over the weekend pointing to Amazon and Nike as potential suitors. Let's bring in our first guest for the hour. We've got Scott Devitt, who's an analyst over at Stifel. And Scott, of course, this comes as the company faces pressure from Blackwell's Capital, who's been pushing the company to, number one, fire CEO John Foley, but also seek out a potential sale. What do you make of the news? or reports, I should say.
Right. I think there were multiple news reports on Friday, including companies named Amazon and Nike. And, without commenting specifically in terms of targeted acquirers, what I would say is that, Peloton, the reason why it's viewed as a strategic asset is there's many large technology and health platform companies that have been going after, the opportunity in different ways. In the health industry, Amazon, Apple, and Google have initiatives. Of course, Nike's in the fitness business and has had various initiatives as well. So a company like Peloton, which is leading this trend towards in-home and internet-connected fitness, is a logical match for a number of companies, that are much larger but don't quite have a footprint in the area yet.
Hey, Scott, it's Brian. Now, this is interesting because you've seen a lot of the commentary off of these rumors kind of open up a debate about who would be the best fit. But if I'm hearing you right, you're saying that any of these large technology companies would be good for Peloton. Why is that? Because it seems like the integration strategy for, let's say, an Amazon might be very different than with a Nike, just based off of their existing business models.
Sure, there'd be different synergies depending on which company made the acquisition. But Peloton has 2.8 million subscribers to its connected fitness product, which is the $39 per month plan, another 900,000 that pay $12 a month. The connected fitness subscribers churn out less than 1% a month. So it's a very sticky customer. And the interesting thing of Peloton, despite some of the recent challenges, is the longer term prospects for this business pre-pandemic always were to layer in multiple hardware products into one single subscription. I very much think, that path does still exist. And so the opportunity from a subscriber standpoint with good execution is considerably larger. When you plug that into a network, whether it is, as you named, Apple, Amazon, or Nike, there are different synergies depending on who the acquirer is. And that's why it's difficult to kind of go into detail because they're not all identical, but they all do make sense.
Scott, we're seeing some of those reports fueling the stock rising today in this session. It is up in a big way, but of course, $30 a share, that is well off the 120, 130 level that we saw last year. What would an acquisition ultimately mean for the stock itself? You've got a price target of, I think, $40 a share. I mean, does that include a potential acquisition, or do you think it could push higher if something does go through?
Our price target is 12-month forward price target based on this being an independent company that's dealing with growth challenges. So, I think as a strategic asset, to the extent that, Peloton were in play, if you will, the numbers, would look quite a bit different in terms of what an acquirer would be looking at. And so I think one could make the case in that scenario of figures that are quite a bit higher. Peloton, today, as I mentioned, has 2.8 million connected fitness subs. What's interesting is if you go back to our model before the pandemic for fiscal 22, the subscribers relative to what they're actually going to be this fiscal year were 42% lower. So you have a business that's considerably larger today than it would have been no pandemic. And you have a stock price that even with the move today is roughly at its IPO price and hanging out now right around the level that it was hanging out in the year preceding the beginning of the pandemic.
Well, Scott Devitt, Stifel analyst, it's good to talk to you today. We'll be watching to see if any of those companies really do emerge as potential suitors. Another stock we're watching today, Brian, is Spotify, yet again in focus here, with Spotify CEO Daniel Ek issuing yet another apology over the weekend following new recordings that emerged showing popular podcast host Joe Rogan using a racial slur. You see the stock down about 1.5%. Brian, this is different from the controversy we were talking about last week related to disinformation around COVID-19. This specifically deals with Joe Rogan's use of the N-word. We heard the artist India Arie over the weekend point to 24 times that Rogan used that slur. He has since come out and said, look, that was taken out of context, but now I understand this is not a word for me to use. And here we are talking about Spotify yet again having to issue an apology and address employees to say, here's what our policy is on content.
Yeah, and I think that we have to kind of note that there is some interesting distinction between the kind of recency of these episodes. They were, in many cases, before some of the episodes that were put on after the Spotify deal. And we do know that Spotify has taken a number of those old episodes from the Joe Rogan Experience down from their platform. But it does underscore just how many issues and thorns there are in Joe Rogan's history that Spotify is now digging up and that listeners are going to continue to dig up. But I think when we talk about the company itself, obviously it's had quite the slide over the past 6 months. But as we kind of spoke about with our guest, I think it was Lou Basinese from Disruptive last week, he was saying most of that still remains a subscriber story, not necessarily a Joe Rogan story. But of course, the social headlines putting the company in a bad PR light. It's obviously a very serious issue. But again, they paid $100 million for the exclusive licensing rights here, and it's kind of hard to see Daniel Ek, the CEO, wanting to turn away from that, Akiko.
Yeah, and let's point to what Daniel Ek specifically said in this letter he sent to employees, where he said we should have had clear lines around content and take action when they are crossed, but canceling voices is a slippery slope. And he said, look, I agree with this decision to remove past episodes from our platform, but I want to make one point very clear. I do not believe that silencing Joe is the answer. Brian, you talked about subscriber numbers. Specifically, we saw the stock move on the back of that last week when Spotify reported their numbers. Interesting research out from Forrester Research that points to roughly 20% of Spotify users who said that they are likely to cancel their subscriptions as a result of the controversy around Joe Rogan. But of course, the question is whether in fact users do go through with that and whether in fact they come back once the controversy kind of dies down. So something we'll be watching, but Spotify's shares taking a hit today in the session, down about 1.5%. Well, moving on to another big story. It is Merger Monday and a marriage of two low-cost airline carriers sending travel stocks soaring. We're talking about Frontier and Spirit Airlines announcing a merger. Let's bring in Yahoo Finance's Alexis Keenan, who's following that story for us this morning. Alexis.
Hi, Akiko. One less airline, I guess, in the U.S. here. The new combined airline will become the U.S.'s fifth largest U.S. carrier, Denver-based Frontier and Miramar, Florida-based Spirit, announcing their merger. Shareholders agreed over the weekend, they say, to a cash and stock deal that is valued at about $6.6 billion. Now, under these terms, Frontier equity holders will end up controlling 51.5% of this new combined company. Meanwhile, Spirit stockholders, they will have 48.5% of that new company. And for each of Spirit's shares, its shareholders in this deal are going to get 1.91 shares of Frontier plus $2.13 in cash. And based on Frontier's share price as $12.39 as of Friday's close, those numbers, the companies say, imply a value for each Spirit share of $25.83. That represents approximately, based on that Friday close, a 19% premium over Spirit's closing price on Friday. Now, the new airline, as I said, will become the fifth largest in the U.S. No word yet on what the new company's name will be. In a joint press release, the company said together they'll compete even more aggressively, especially, they said, against the dominant Big Four airlines, namely American, Delta, Southwest, and United Airlines. They also said that the combined networks will serve more than 105 destinations across the U.S., Latin America, and the Caribbean. Guys?
And worth mentioning, Alexis, that all the major airlines today up in a big way as well. Alexis Keenan, thanks so much for bringing us the details there. Coming up, the Biden administration is out with a new plan to make America's roads safer. Transportation Secretary Pete Buttigieg is going to be joining us on the other side of the break. We'll be right back. The Department of Transportation is looking to address an alarming rise in deaths on roads across the country. Traffic-related deaths soared to a 13-year high in 2020, despite stay-at-home orders, and that number climbed even higher last year. That's prompted the department to roll out a nationwide safety strategy to try and curb those accidents. Let's bring in Transportation Secretary Pete Buttigieg, who's joining us this morning alongside Yahoo Finance's Brian Sozzi. And Mr. Secretary, it's good to talk to you today. It's a pretty sobering number when you think about 3,000 deaths a month that are reported on the country's roads. Let's start with that problem. What do you attribute the uptick in those numbers to?
Well, you would have thought with fewer people driving during the pandemic, there would be fewer crashes and fewer fatalities. Instead, the opposite happened. There are a lot of different factors going into that. One that appears to be a factor is speed. Speed is very often one of the reasons why a crash happens, or one of the reasons why a crash is fatal. And with less congested roadways, there were actually people more likely to drive at unsafe and illegal speeds. And of course, there are consequences to that. But we also have to look at the bigger picture. Not only are we troubled by the fact that there's been a recent uptick, but just the fundamental number of traffic fatalities in our country is too high. And we've all grown up with it, so we're used to it. But the truth is, it's not standard, it's not inevitable, it's not normal for something like 40,000 people every year to die on our roadways. If you think about it for a second, we would never tolerate that many people dying in airplane crashes. We would never tolerate that many people dying in transit or train or ferry accidents. And yet we just think of it as part of the cost of doing business in America. Now, if you look around the world, and even if you look around our country, some places are much better than others at preventing roadway deaths, which is one of the reasons we know that this crisis is preventable. So my department's released a national roadway safety strategy, pointing to the strategies that are proven to make a difference, to have safer roads, safer vehicles, safer drivers and passengers, safer speeds, and a better standard of care when there is a crash in terms of emergency services, so that more people are able to survive.
And when you think about that plan that you've laid out, it's a pretty ambitious one when you consider you're trying to get from 3,000 deaths a month to ultimately zero in the long term. There's a long list of proposals you've put out, but I wonder how technology is likely to play a role in all of that. When you think to self-driving cars, the initial argument has been that, look, if you've got autonomous driving, that's going to reduce the number of accidents too. And yet here we are in 2022 still talking about accidents stemming from that.
Yeah, I think there's a very compelling vision for the long run about these technologies and forms of autonomous driving being safer. After all, as you can tell by the numbers you and I just talked about, human drivers don't have a very good track record when it comes to safety. The question is, how do we get from here to there in a safe way? And right now, with a lot of wonderful technologies emerging, we're also in a bit of a danger zone because people see these partial automation technologies and sometimes lean on them too much. So it's very important for every driver to remember that no matter how high-tech your vehicle, any vehicle that you can buy today requires a driver to be behind the wheel and paying attention. These lane assist technologies, the forms of cruise control that we've got, automatic emergency braking, these are great, but they are driver assistance technologies. They are not driver replacement technologies. And we've got to make sure that we're very clear about that. Now, as we look to the future, taking things like that automatic emergency braking and looking at whether that can be less of a bell and whistle, an expensive feature, and more something that's just standard on cars, I think that's a direction we can move in that will help to save lives, not just in vehicles, but for pedestrians too.
Mr. Secretary, Tesla said recently their full self-driving technology will be available this year. How concerned are you that big tech is moving aggressively with technology like this when our infrastructure isn't set up to support it?
Yeah, again, it's very important for people to understand that any commercially available technology right now, no matter what the brand name is, no matter what people are calling about it, requires that you as a driver be paying attention. And you got to read the fine print on some of these things. Now, again, there's a lot of promise in these technologies for the long run, but we are reaching a point where the policies haven't always kept up with the technologies. I mean, so many of our regulations to keep cars safe are based on how cars always used to be. We need to make sure that they're based on how cars are going to be. It makes no sense to continue to focus on I don't know, a regulation that says exactly where a steering wheel or a mirror needs to go in a car that doesn't even have a driver in the future. And these are exactly the issues that my department's working with as we look to the future, even as we try to address an issue, a crisis really, on our roads today, which is, again, yes, it has to do with cars, it has to do with drivers, it also has to do with roads. It matters how you design a road, how you design an intersection, how you design an interchange, and safer designs will save lives.
What I find so interesting, Mr. Secretary, is that the big automakers are so focused on making the best new cool looking navigation screen or the best cool new plug-in electric vehicle. But there are technologies out there, some of which you highlight in your report, like alcohol detection system for the ignition and eye tracking technology. Now, do you think these things should be mandated standard equipment inside of automobiles?
So we are going to be evaluating how these safety technologies could become standard because this is part of how you also address some equity issues here. You know, if having a car that's going to protect your safety, your life, your children is something that's only available as an expensive luxury item, then that raises some deep concerns about who is protected. We have taken steps as a country over the years, from seat belts to airbags, various things, not only to have things like the 5-star ratings that my department puts out to help people understand performance, but also just basic fundamental standards that we say, if you want to drive a car in this country, this is part of what goes into that car so that you know you're safe. And the answer is evolving as the technology is evolving. That's a good thing. We just got to make sure that we're keeping up. Now, also remember, technology cuts both ways. These safety technologies have enormous promise, but other technologies, smartphone technologies, some of the things that can go onto screens, run the risk of increasing distracted driving, which unfortunately it's taken its place right alongside impaired driving and drunk driving as a source of crashes and injuries.
Mr. Secretary, let's talk about where things stand with the administration's climate agenda as we see Build Back Better hit a bit of a wall here without support from Senator Manchin. The president has said he wants half of the cars sold in the U.S. to be EVs by 2030. He's also laid out a goal of 500,000 charging stations by the end of this decade. Can you get to those goals without the incentives in place from Build Back Better?
I think we can make enormous progress with the tools that we already have. Of course, we believe in the incentives in Build Back Better. We think they'll make a big difference in making electric vehicles more affordable. And some of the people who stand the most to gain from adopting electric vehicles, rural drivers, low-income drivers who could really use that gas money that you save because it's cheaper to fill up on electric than on gas and diesel. It would go a long way to buy down the sticker price for those cars and pickups, which is what those incentives would do. So we still believe in them. But I will say, with what we already have, the resources to create a national charging network of 500,000 chargers so that you never have to wonder if you're going to be able to get charged where you need to go. The partnerships that we have and the conversations we're having with industry. I mean, the automakers already working very quickly and effectively in this direction give me a very great degree of confidence that we're going to achieve this goal. We're going to try to beat it as a federal government, making sure that just when we buy our own cars, if you just think about the number of light-duty vehicles that the federal government buys, we can lead by example. We're working to do that, and that's another goal the president set that we're working hard to make sure that we meet or beat.
From cars to airplanes, Mr. Secretary, Delta CEO is looking to create a no-fly list for unruly passengers. Is that something you support?
Well, certainly we support airlines taking steps to protect their passengers, their crews, and a number of airlines, including Delta, have done that. They've said that, if you are behaving in a way that's unruly, dangerous, you can't fly on our airline anymore. It gets a little more complex when there are proposals for the government to do that. But right now what we're seeing is that companies are completely within their rights to take action to keep people safe. I will also say that the FAA is continuing to vigorously enforce and encourage criminal referrals where appropriate for this kind of behavior. I mean, in 2022, we should not even have to say that when you're on an airplane, you need to behave in a way that is safe and appropriate. But we still have far, far too many cases, far too many examples of flight crews being mistreated or even other passengers being harmed by unruly passengers. It's got to stop, and we're going to continue doing everything that we can through enforcement and through just getting the message out there that we stand with flight crews and we stand with those who are up there, by the way, as the announcement always goes when you're putting your seatbelt on, primarily for your safety. They deserve that respect, and everybody deserves to get to where they're going without incident.
But just to clarify the point, it sounds like you think a no-fly list is really within the purview of the airlines, the private companies, not necessarily for the government to create.
Well, look, I think we need to continue to look at anything that will help keep our skies safe. What I'll say is that many of the airlines have already taken that step privately, and we should continue to look at what we can do at a policy level, knowing that there's a lot of complexity when you try to do that in a way that cuts across airlines and is developed by the government.
Secretary Buttigieg, it's good to have you back on the show today. Really appreciate the time, and our thanks to Brian Sozzi as well for joining in on the conversation. Well, coming up, the latest tightrope for the Federal Reserve. Our next guest outlines the challenges for the Fed after a strong January jobs report and rising inflation. That discussion is up ahead on the other side of the break.
Time for a quick flashback to Friday when we got that jobs report, which took Wall Street by surprise when the government reported that 467,000 jobs were added to the economy in the month of January. Expectations were much lower given the surge of Omicron cases throughout that month. But our next guest actually had a prediction that was pretty close to the real number that we got. So who better to discuss the future labor market conditions than Peter Morici, economist and University of Maryland professor of business. Professor, it's great to have you on the show today. Your guess was 250,000 payroll additions for the month. A lot of people on Wall Street had negative expectations, and that ADP print that we got earlier in the week showing a contraction of over 300,000 got a lot of people spooked. Why did you have such a positive read on the January jobs report that actually ended up being pretty close to the actual number?
I don't think that businesses want to lay people off just because there was the Omicron strain and so forth. And they've been struggling to hire people, for the last several months. So I think that hiring exercises were just continuing in the anticipation that Omicron would, peak over a period of 3 or 4 weeks. So there wasn't much let up. The other thing was there was a lot of pressure to keep things going. Now we're starting to see anecdotal reports as they come in that a lot of, for example, companies in the food industry, cereal makers, meat packers, and so forth, as folks called in sick, they relied on part-time workers. Well, if you're paying someone when they're sick, they count as an employee. And if you pay for a replacement, that counts as an employee too. Because they're basically asking, who did you pay this week, the week of the 12th?
Right, and that kind of brings up the nuances of how the survey is done. But at the same time, there are some questions about the revisions, right? Because there could be a large confidence interval issue with the numbers that we got, because 2022's January report reminded us that there's an annual benchmarking where revisions for months that were reported in the year prior could be marked up or marked low as much as 400,000 jobs. In some cases. Do you think that might have played a factor into what we saw in January? Should we expect to see that number get revised down based off of the surprise that we got?
No, I don't think so. I don't think there's a reason to believe it would go one way or the other. One of the problems we're dealing with is that the normal seasonal adjustment figures that we use, reflecting patterns of layoffs in January and retail establishments, as they wind down from holiday shopping and then the returns week, the first week in January, don't work as well as they used to because we're in this very unsettled environment. But by and large, numbers tend to get revised up, not down. The report is based on a preliminary survey for the month of the 12th. That's a survey and it's limited data, just like a poll for who are we going to vote for president. At the end of the year, what they do is compare that to state governments' unemployment claims and unemployment insurance payments. Unemployment insurance payments are important because that's another head count. I mean, basically, we're asking businesses, who did you pay? And there are checks on that. So I'm not expecting that this number will be revised down.
Peter, the number we got on Friday has really only added to the speculation of how aggressively the Fed's likely to move, especially in the face of rising inflation. And we heard the president on Friday really tout the growth that he has seen or the country has seen in the economy under his watch. I wonder if you think these predictions, these forecasts hold anywhere from 5 to 7 rate hikes, whether that type of growth can really continue in the face of such aggressive moves from the Fed.
We are not going to have the growth in 2022 we had in 2021, simply because we were rebounding from a recession caused by COVID. We were reopening and so forth. We all expected, even before Omicron came along, that this year would be a good year, but not as good as last year. And we wouldn't return to a normal pattern of growth of about 2% a year until the second half of 2023 or 24. There's a couple of things weighing on the Fed right now. One is that Mr. Powell, when he was concerned about being reappointed, seemed to cling to the idea that inflation was temporary much longer than he should. And there were folks both on the right. I'm a conservative economist. I write a weekly column in the Washington Times and on Dow Jones Market Watch, one of your competitors. And last February, I was saying, this guy's cooking up inflation because he's printing too much money. The Biden stimulus came along. He basically financed $2 trillion of stimulus with printed money. And on the left, Harry Summers was writing in the New York Times basically the same stuff. They're basically creating much more demand than the economy can supply as it comes out of this pandemic. And below, we got all this inflation. So now this is a man that really is in trouble in terms of his legacy and reputation. Mr. Biden doesn't fire anybody. He reappoints everyone, it seems. So he's not worried about anything like that. But his legacy is at stake. Now, he's been very tepid about raising interest rates. I mean, he's still printing money. He's saying, well, I'll start raising interest rates maybe in March. This is going to push him to raise them a bit more rapidly than he would like to, but it probably won't be enough. History has taught us that when we get inflation like 7% a year, it's hard to avoid raising interest rates a lot and bearing a recession. And I don't think Powell will want to do that. And that's very unfortunate because that's how William Miller in the late 70s handed Paul Volcker a mess around 1979.
Yeah, and there's some comparisons being discussed here. We're going to be watching that one closely. Peter Morisi, economist and University of Maryland professor of business. Good to talk to you today. Coming up, Germany's Chancellor Olaf Scholz meeting with President Biden this afternoon. The latest developments as Germany faces scrutiny over how it's handling Russia's troop buildup along the border with Ukraine. We'll be right back. In our worldview today, President Biden is set to meet with German Chancellor Olaf Scholz at the White House today in the first face-to-face meeting since Scholz became leader. Discussions are expected to focus on Russia's military buildup along its border with Ukraine. Scholz has faced growing questions in recent weeks about Germany's commitment to NATO, with the country refusing to commit its own troops to confront Russia. Scholz has also been reluctant to deploy weapons to Ukraine and spell out sanctions against Russia. Meantime, over in Moscow, French President Emmanuel Macron is set to meet with Russian President Vladimir Putin as France looks to avert a crisis in the region. Macron is also scheduled to travel to Kiev and said he's reasonably optimistic in talks with Putin. Russia has amassed more than 100,000 troops along its border with Ukraine while deploying more in Belarus on Sunday. National Security Advisor Jake Sullivan warned a Russian invasion of its neighbor could come any day now. Ottawa has declared a state of emergency following protests over COVID-19 restrictions. Hundreds of truckers have blocked city streets for more than a week to push back against vaccine mandates for truckers crossing the U.S.-Canada border. Ottawa's mayor has said the demonstrations pose a serious danger to the safety and security of residents, with some taking to social media saying they are too afraid to leave their homes. Police have launched at least 60 criminal investigations tied to the demonstrations so far, with dozens of other arrests following. And Chinese tennis star Peng Shuai is retiring from the sport just months after she accused the former Chinese vice premier of sexual assault. Peng made the announcement in her first interview with a Western media outlet since she went public with those allegations last fall. She told France's L'Equipe that she was surprised by the international outcry and said she didn't want to add any more hype to the story. The hour-long interview was conducted alongside an official from the Chinese Olympic Committee. That came after IOC President Thomas Bach met with Peng for the first face-to-face meeting in Beijing. In a statement detailing the dinner, the IOC did not address Peng's allegations.
Well, keeping it in the theme of the Olympics, the Winter Olympics in Beijing did begin last week, but as some of the best athletes in the world go for gold, not as many people are apparently tuning in as maybe NBC, the broadcaster, had hoped. In fact, the broadcaster says 16 million people tuned in to watch Friday's opening ceremony. But how does that compare to previous Olympics? Well, Yahoo Finance's Josh Schaefer is here to stop by with more details on exactly how those numbers compare. Josh, not looking so good for NBC, is it?
Yeah, Brian, we'll start with those numbers you were just referencing right there. And I should mention NBC spent over $7 billion on these broadcasting rights. So it's a big investment for the company as a whole. So 16 million viewers for the opening ceremony. That's down 43% from 2018. Those Olympics in 2018 were in South Korea. So a pretty similar time change for the US, but down 43% from 2018 for the 2022 opening ceremony. And then if you take a look at the opening night, so that was last Thursday night. The events usually start a little bit before the actual ceremony. That had 7.7 million viewers, and that's down from 16 million viewers in 2018 and 20 million viewers in 2014. So a huge drop off for viewership. And there's really two big reasons why. There's a political reason, and then of course, COVID-19 has still impacted pretty much everything. And so those two reasons combining have kind of given NBC a really tough time here. So from the political standpoint, we know the US and other Western countries have posed a diplomatic boycott from the Olympics themselves. And this is over human rights issues in China and China's mistreatment of the Muslim minority population known as the Uyghurs. And so this is, the US has accused China of genocide and what they're committing in Western China. And so that's really something that we've seen in the past. It makes people not want to watch sports when there are political issues going on. People usually just step away from sports. Yahoo News did a survey back in 2021, and it said that 34.5%, so more than 1/3 of people, said that they stopped watching sports in 2020 and 2021 because of social justice and political issues. And then if we get to the pandemic, there was also a trend of people not watching sports amid the COVID-19 pandemic. People just don't want to watch a sport with no fans, a sport where the athletes are wearing masks and the interviewers are wearing masks, and it just kind of reminds them of the life that they don't really like on the outside with what's happening with COVID-19. And that causes syndication issues. The Super Bowl last year, I should point out kind of our reasoning for knowing that COVID-19 impacts sports. The Super Bowl last year was the least watched Super Bowl in 15 years. And we know people normally like to watch the NFL. And one last note on kind of what's happening here with syndication problems is because of all of this, NBC doesn't have the same presence they normally have over in China. They don't have the Today Show there. They don't have their other programs there. And so we're not seeing the normal audience be brought into the sports audience, and it's leading to less numbers for NBC.
Yeah, Josh, that was really noticeable in the coverage of the opening ceremony, where there's kind of that split screen between Beijing and then Connecticut, which is where a lot of their broadcast is happening too. Thinking back to last year during the Tokyo Olympics, that was supposed to kind of be the big launch or push for Peacock. And we talked about this in the lead up to the Olympics, you know, how helpful the Olympics have actually been to Peacock getting those numbers up. Did we get any additional numbers from the weekend about whether, in fact, they're seeing subscribers migrate over to try and check out the programming that NBC has put for the Olympics on the streaming platform?
Yeah, there's been some increase in Peacock subscribers, and I think we're going to see that sort of continue throughout the week. So this is kind of, a lot of people are reacting to these first weekend numbers because they are big misses. But it is also the start of NBC's big week. They traded for Super Bowl rights for this upcoming Sunday with CBS. They traded years purposely for this moment. And kind of Peacock's big day is going to be next Sunday. NBC is going to stream about 18 hours straight of Olympics content into Super Bowl content, then back into Olympics content. So I think that's where we're going to see did people use Peacock? Did people download Peacock to go all in on a giant sports day on a Sunday? So we're really kind of looking for those numbers, I think, at Kiko, next Monday, next Tuesday. What were the downloads on Peacock and what was the engagement for the investment of the Super Bowl combined with the Olympics? And is Peacock that premier sports streaming service that NBC wants it to be?
I mean, look, for me personally, I tried downloading Peacock. I couldn't figure it out. And I was like, well, what's on USA? Because I already had that downloaded. And then Peacock was too much. So I was like, I'll just Chromecast it on my, this is all just a huge mess. But yeah, Finance's Josh Schaefer. Thanks for breaking all that down for us. Well, coming up on the other side of this break, last year's largest offerings on the stock market appear to be sputtering. We'll explain why some of 2021's biggest IPOs aren't doing too hot next. Well, some bad news for some of the companies that went public last year. Some of last year's largest IPOs are now trading at least 20% below their initial public offering price. Yahoo Finance's Inez Frey is here with a list, and it's not a good list. It's a list of the worst IPO performers of the pandemic. Give us the breakdown on who's on there.
Yeah, that's right, Brian. And taking a look at 2021, we looked at the 5 largest IPOs, that mean being the companies that raised the most amount of money in their initial public offerings, and looked at their IPO price compared to the price that they closed on last Friday. So if we take a look at those, we rank these by their fall from their IPO price. So you've got at the top of the list, Didi, which is down about 73% from its IPO price when it put its ADRs at $14 a share when it went public last year. And then you've got Robinhood down about 60%, followed by Coupang, that's the South Korean e-commerce company, down about 40%. Bumble is down about 35%. And Rivian is trading about 20% below its IPO price. Rivian, of course, being the largest IPO of last year. If you take a look under the hood as to the reasons why, well, Didi, you've got the regulatory issues that it has been facing last year year. And also Didi, of course, will be delisting off the New York Stock Exchange and moving over to Hong Kong. Then you've got Robinhood, which has battled a few challenges last year, including the gamification of trading after the GameStop saga, scrutiny over payment per order flow. And then you had Robinhood, which had a really stellar second quarter, but then the third and fourth quarter, they saw trading slow down. And then if you look at Rivian is down about 20% from its IPO price, but you'll recall that Rivian opened much higher than its IPO price of $78 a share. And in fact, its market cap ballooned up to $153 billion in mid-November of last year. Right now, its market cap is at around $55 billion, as it's just a snapshot of what investors were looking for, especially last year, anything to do with electric vehicles. They were pouring a lot of money into these companies, and a lot of the air has kind of come out of those given the higher inflation and the prospects of tighter monetary policy. But that's basically a snapshot of what we saw in 2021, these large IPOs, and now all those stocks are trading lower than their initial public offering price.
Yeah, Inez, I'd be curious to see if you break it out with SPACs, how much more the declines are. But let's talk about how this compares to 2020, because you're talking about 2021 numbers. How do things fare when you compare it to IPOs in the first year of the pandemic?
Well, what's interesting is that the largest 5 IPOs of 2020 during the pandemic actually are trading above their IPO price. So if you take a look at Snowflake being one of those, you've got Royalty Pharma, also DoorDash, Airbnb, and Warner Music Group. All of those are trading above their IPO price. And if you just take a look at Airbnb, this kind of gives you a snapshot of that turnaround story of this company, which had to lay off people at the beginning of the pandemic. Then the company really turned around. It had its IPO in December of 2020, pricing its IPO at $68 a share. Shares opened on that first day of trading at $146. And right now, those shares are still trading above the first trade of that day in December when they went public. And Airbnb year to date is down about 7%, and it's kind of been sold off also with high growth stocks amid higher inflation. You've got tighter monetary policy coming, but still over the last couple of weeks, you're looking at Airbnb that's up about 20% in the last 2 weeks. So it kind of gives you a snapshot of that IPO that was successful and that it has done well overall when you look at the whole pandemic.
Yeah, interesting to see the comparisons there. Inez Ferre, thanks so much for bringing us those numbers. Coming up, tech editor Dan Halley explains how you can hide your home on Google Maps. Stay tuned for tech support after this break. While Google Maps and Apple Maps can be very convenient when planning out a trip, there are some features that may be seen as an invasion of privacy. Yahoo Finance's Dan Halley is here to explain in this week's Tech Support. What privacy violation, Dan? I've seen so many homes when I use Google Maps. What's the new issue?
Well, it really comes down to, the impetus for this is because Apple CEO Tim Cook actually has a stalker, and he recently filed a restraining order against them. And so as part of that, Apple and Google have taken the move of pixelating his home on their services, Apple Maps and Google Maps. Now, when you look at that on its face, you think, well, the CEO of the richest company in the world is getting special treatment. But in reality, that's not the case. You and I can actually go ahead and pixelate our homes on these services as much as we want. In fact, it's relatively straightforward on both platforms. And while they are beneficial to being able to, say, figure out where you're going to meet up with your friends after work for dinner, knowing what the building looks like, some people can find it to be an invasion of their privacy. So if you happen to want to pixelate your home on Google Maps, here's what you have to do. You have to start up the app itself on either your desktop or on the smartphone. You're going to go into your image and go to Street View. So you're going to type in your address, go to Street View where you can kind of navigate, drive around virtually on the streets. And then you're going to tap the settings button. That's 3 horizontal dots at the top right corner of the screen and select Report a Problem. And that's going to pull up a completely new window. You're going to see a red square over the image of the building that you want to blur. So if it's your apartment building or your home, you can do that. And then you're going to click Request Blurring. And you can do this for your car, a face, a license plate, or specifically your home. And when you click Request Blurring, you're going to have to just enter the address to give them an exact location that they're going to blur. This way, they're not going to blur your neighbor's house instead of yours. And once you do that, you can click Submit after entering your email address. And the team at Google Maps should blur it, no problem. Now, there's a few things to take into account here. And one is that blurring is permanent. So if you want to be able to go back and look at, your home years from now, see how it's changed over time, that's something that you wouldn't be able to do if you blur it. So just keep that in mind. And then with Apple Maps, not as, many hoops to jump through, but not as really responsive. You're going to just have to send an email to Maps image collection at apple.com and ask that your particular address be blurred. And it can be very helpful. As I said, Tim Cook's address right now, you can do a virtual drive-by of his home, and it just looks like a pile of pixels. But if you drive by your own house, you likely have it showing up. And again, this is a very helpful feature, excellent for being able to figure out what the building looks like that you are traveling to if you're happening to be using maps, or if you just want to check out a location. Maybe you're looking on Airbnb and you want to stay somewhere and you want to see if it looks nice, you can use that. But if you're looking for a little more privacy on Google Maps or Apple Maps, then this is the way to do it.
Hey, Dan, I've actually been trying to follow your directions here because I've got a few exes that I know I want to make sure they can't see this type of stuff on Apple Maps. But can I just ask you, though, let's say, for example, a person wanted to also, I don't know, find another location, right? Let's say you want to do this for your parents, or you wanted to do this for another location, maybe a vacation home, perhaps. Can you enter in more than one address and have 2 locations blurred?
Yeah, you would just have to go in and blur it in a second time. So you would go and then search for that address and then blur it on your own. The whole thing is to just include your email address, and that's likely part of the confirmation process from Google to make sure that you're not just out there blurring random homes on Google Maps, which I'm sure I just gave someone an idea to do that right now. So please don't do that. Or if you do, just don't link it back to me. That's all.
Yeah, no, just say Dan Halley sent you when you send that email over to them. Yahoo Finance.
Sure, why not?
Dan Halley, thanks so much, man. Thanks so much. Coming up on the other side of this break, Disney, Uber, Lyft, Peloton are among the companies set to report earnings this week. We'll break down what you need to know after the break. Welcome to Yahoo Finance Live, noon hour here on the East Coast. I am Brian Chung, here to hang with you alongside my co-anchor Akiko Fujita. We'll give you the game plan on exactly what we plan on covering over the next hour, but not before we first take a look at where markets are on this Monday afternoon. Stocks turning lower. The Dow's actually been bouncing up and down through the morning. It's just barely down from where it ended the day on Friday, but the S&P 500 down about 0.25%, and the Nasdaq, interestingly, down 0.4%. Also keep an eye on Facebook, which is down 4%. That stock still down bad. In the hour, though, China is using the Olympics for the grand unveil of its digital yuan. Does the innovation, though, make for a smoother functioning economy? And how are private fintech companies cool with the government stepping into the ring? We'll discuss with Cornell's professor, Eswar Prasad, on the issue. And then get ready to see more crypto, as whether you like it or not, Katie Thomas from the Carney Consumer Institute will stop by to give us the breakdown on how crypto dollars and other types of companies are flowing into the year's biggest advertising event. But first, we've got a number of economic and company-wise news expected this week with a look ahead for the week. Let's bring in Yahoo Finance's Emily McCormick. And Emily, obviously inflation data on the CPI coming in on Thursday morning, but there's a number of companies also expected to report their earnings. What are you watching for the remainder of this week?
Well, Brian, we're kicking off another packed week on the earnings and economic data calendars. But turning first to those earnings names, we're keeping an eye on a number of major companies reporting their quarterly results this week, including Take-Two Interactive tonight, Peloton and Lyft tomorrow night, and Uber and Disney on Wednesday. But zooming in really quickly on Peloton, of course, this earnings report comes amid reports that it's attracting potential buyers, including from Amazon and Nike. Those reports first emerging Friday afternoon. That stock is up another 16% this afternoon on the heels of those reports. And of course, Peloton has also been drawing considerable attention from activist investors over at Blackwell's Capital, which have criticized the company's CEO for his handling of the company over the past year, as Peloton shares have dropped by about 80% over that period. Now, Peloton is expected to post an only 7% year-over-year increase in revenue for the December quarter. That would compare to a 128% growth rate in revenue that it saw in the same period last year. So definitely seeing quite the deceleration on that top line, as of course there has been a little bit of a waning in that demand for these connected fitness products. But one other company that I want to highlight as well is going to be Disney. That company reporting, as I mentioned, on Wednesday after market close, and a lot of attention is going to be focused on Disney Plus streaming performance after Netflix's disappointing streaming growth and guidance from its own quarterly results reported just a couple of weeks ago. So any updates about whether Disney Plus is continuing its momentum will be closely watched. A consensus analysts are looking for net subscriber additions of about 7 million over at Disney Plus for this latest quarter. That's all going to be closely watched alongside how traffic is trending at some of Disney's in-person theme parks. So definitely quite a bit to watch on the earnings front just from those two names specifically. But just as one final stat more broadly on earnings season, heading into this week, do you want to highlight that just over half of all S&P 500 companies had already reported their quarterly earnings results, and earnings growth is currently tracking at about a 29% year-over-year growth rate, according to FactSet. And if that is maintained, this would mark the fourth consecutive quarter of growth above 25%. Again, we'll see if that growth rate, though, can be maintained in the coming weeks. But then turning quickly to the economic data calendar, of course, a number of major reports on that front as well. The big one is going to be that consumer price index, or CPI, out on Thursday. Of course, after last week's much stronger than expected report on payrolls for January, a lot of focus is going to be paid to the inflation front, and of course, how hot inflation is running during this economic recovery to help inform the Federal Reserve's next moves. But specifically, consensus economists now expect to see the headline CPI jumped by 7.3% in January over last year, which would mark the fastest rise since 1982, and also an acceleration from the 7% jump that we saw in December. And even on the core measure of CPI, excluding more volatile food and energy prices, that still likely rose by about 5.9% on an annual basis, which would also be the biggest jump since 1982. So taken together, quite a bit for investors to be keeping an eye on here in terms of both economic data on the inflation side and, of course, many of these key earnings reports, guys.
Yeah, crazy busy week. And another stat, I think there's only 76 instances, this is coming from Bank of America, of earnings per share guidance that was issued in January. That's below January of last year. So we're having less transparency into 2022 as well. Yahoo Finance's Emily McCormick, thanks so much for the breakdown. Well, let's shift our attention to the markets with Christopher Wolfe over at First Republic Private Wealth Management. Christopher, it's great to have you on the show. Want to talk about the market volatility that we've been seeing. That seems to be the theme through this earnings season. When you see big tech stocks going up and down 25, 30, 40% up and down in some cases, and you're looking at a VIX handle, it's what, 24 right now? That's not too much of a red flag. Is this an investable market right now, or are you really trying to approach some caution, especially ahead of the macro headwinds that could be coming from the Fed?
I think that's a great way to frame it. It is investable. Let's just be clear about it. But I think the Fed's going to make it a bit more challenging than it has been in the past. And just so we're clear, it's been really easy in the past because the monetary base has been growing so wildly, and it's been very easy, I think, to do relatively well. So you mentioned something about valuations. We're starting in a place where there were a lot of really good expectations built in. And what you're going to have this year, I think, to the point about what you're seeing for high valuations and that rising earnings story, is a little bit of a battle between valuation multiples, which are high and are probably going to come down, and earnings growth, which is going to be modest. But I think when you look underneath the market, you're going to find variation that's going to be pretty big. Energy up a lot, tech up some, healthcare up some, maybe more of the financials up a lot, consumers probably down a little bit. So we're going to see a real mixed situation, I think, for the earnings story in 2022.
So how much cash should investors be putting to work? I mean, I realize that's a really broad question. The risk appetite depends on the investor, but when we're talking about March coming up, that first rate hike coming in, is the thinking here that maybe you kind of just hold tight until then to see the reaction and then get in? I mean, how do you take this approach when you say it's investable?
Yep.
How do you time it?
Well, I would say three things. The first is most of the portfolios that we manage on a long-term basis are fully invested. But what we've been doing is repositioning where things had run up a lot. For example, rebalancing back to our long-term goals, number one. Number two, if you got a lot of cash on the sidelines and you're waiting for an opportunity, we don't recommend that. We recommend taking an averaging in type of an approach. That tends to work relatively well, particularly, I think, as Brian described, in volatile markets. You might get some ups and downs, particularly some of the downs that allow you to average in. That makes a lot of sense. And then the third piece is how long should your averaging in window be? It should be through at least the end of this year, maybe even into early next year. The market's not going to adjust all at once in, say, June, because there's still some more labor market reports that we need to see before I think the market gets convinced that inflation is much higher than the Fed wants. So I think that period between now and, say, June in the middle of the year is going to be pretty volatile, and that's where you're going to have opportunities to rebalance portfolios. I would use those volatility points to put cash to work.
Okay, well, if that's the case, then are you willing to go into maybe those higher risk growth stocks because of some of the sales prices that you're seeing with the market dips? I mean, people are looking at these big tech stocks, which you can make a fortified portfolio off of these huge big cap stocks because of the stock declines that we've seen. Is it good to get in, or is there a risk of catching a falling knife?
I don't think we're catching a falling knife. I think a lot of damage has already been done. And by the way, it's even worse in biotech if you're thinking about the damage that we've seen already. We started, I think, a year ago with more than 65 companies trading at 20 times sales. Those are astronomical valuations. We're now down into the 30 number of companies. So the market's squeezing out some of the excesses at this point. It's not all done. But that said, many of the big cap tech names don't trade at absurd valuations. They trade at something a bit more normal. Now, normal in this case means that you have to expect higher than long-term average profit margins. We expect that, number one. And number two is you have to expect the Fed to be moving relatively gradual. So I don't think you're catching a falling knife if you're doing that averaging in and kind of buying things bits and pieces over the next several months. So yeah, we would be looking at big cap tech names here. And keep in mind the big picture around tech investing and growth investing is usually you try to buy things that are scarce. And if things are going to slow a little bit in 2022 from the high growth that we had in 21, growth is a little bit more scarce. I think you want to pay up in some cases where you have confidence that that growth will be delivered. And many of those big cap tech names will deliver, we think, because you have a reasonably good economy in the US in 2022, and things are just starting to turn in Europe. That's key for tech because the earnings base for tech is typically focused on the United States as well as in Europe.
Some good takeaways there. A lot of viewers taking notes right now. Christopher Wolfe, First Republic Private Wealth Management CIO. Good to have you on. Let's turn our attention to one stock that is getting a big pop in the session. We're talking about Tyson Foods hitting a new 52-week high in the session on the back of their quarterly results. The company saw first quarter profit nearly double, helped by higher prices. The company earned $2.87 a share on revenue of $12.9 billion. Average beef prices jumped more than 30%. Chicken prices up 20% and pork up 13%. So those higher prices really adding big support to the company's bottom line there. Tyson's operating margin grew to 11.3%. And Tyson says they now expect sales to be at the upper end of $49 billion to $51 billion range. And Brian, this is such an interesting story to be watching, because when you think about the price increases of, just the price pressures that the average American is facing right now. I mean, poultry, meat, a big chunk of that. And of course, this comes at a time when we've heard the Biden administration try and go after a lot of these companies who he says is pretty much controlling the market, and some would argue pushing prices higher artificially.
Yeah, and we know that obviously when you think about giants in the meat space, obviously Tyson is the biggest name that you think of. And what is interesting, though, is that the big kind of positive reaction on the street is because of their margins having increased. I mean, their net income was a huge knock out of the park compared to the street's estimates, and they have more pricing power because of the ability to, leverage the fact that people are spending more on their groceries. Chicken prices up at a CPI basis, 10.4% on a year-over-year basis. But Tyson is using this to possibly get more competitive advantage when you consider that they've used some of the margin that they've gotten to invest in R&D. Another story that we haven't necessarily talked as much about through the pandemic. They broke ground on a $355 million bacon plant in Kentucky. So they're really kind of using this to grow their company. A little bacon R&D. Who doesn't love it, Akiko?
Bacon R&D. I'm all for bacon R&D, but certainly not for these increases. And you're right. I mean, we talk often about these price increases that we've seen. A lot of companies, not just Tyson, push higher. That's good for investors. They like it. Obviously, brings the profits higher, but certainly not good for the American consumer, who's already having to deal with so many different price increases. Yeah, I mean, we're going to be talking about CPI later this week, but certainly near.
Yeah, I was going to say really
highs.
quickly. Do you remember when Wingstop, they couldn't get cheaply priced wings, so they tried to change and rebrand themselves as Thigh Stop? I mean, actually, if you think about it, chicken has been a whole story about inflation since like the beginning of the pandemic. I never tried their wings though. I don't know how good they are. So
Thigh Stop just doesn't sound good. I like chicken thighs. I do, as much as wings, but just not a good name.
Dark meat's better. Right? Dark meat is better.
Yes, I'm all for dark meat over white meat. Something that Brian and I can agree on. I think we agree on a lot of things on food, but again,
can we get that banner,
Tyson,
producers?
Brian and Akiko agree on food. All right, we're gonna move on here. On the other side, China's digital yuan attempts to go for gold. We are breaking down how the country's digital currency is aiming to take center stage at the Beijing Winter Olympics. Next.
to discuss energy that
The future of currency changing rapidly as we know it, with China's digital yuan now being used at the Beijing Winter Olympics is just one of 3 ways to pay. China certainly leading the way on central bank digital currencies, but there's more than 80 other countries who are now exploring their own rollouts. Let's bring in Ishwar Prasad, Cornell University professor of economics and the future of money author. And Ishwar, this is something that you've been writing about for some time. Let's talk about what's playing out in China right now with the Olympics. There was so much expectation riding on this big rollout. It's been pulled back a bit, largely because the Olympics have been scaled back. But how much adoption have we seen domestically so far?
So some numbers sound impressive. There are apparently about 260 million people who have downloaded the digital yuan app onto their phones. But if you look at the volume of transactions being conducted using the digital yuan, it's still very modest, only about $8 billion officially over the last 6 months, compared to, well over $1.5 trillion in the Alipay platform just in 2020. So I think the issue here is whether there is a strong user case for the digital yuan, given that you have Alipay and WeChat Pay providing very easily accessible, low-cost digital payments to practically everybody in China. But the government is certainly determined to make sure that the digital yuan gets a lot of traction, and it's putting all its muscle behind it.
Anybody who's been to China certainly knows just how little cash is exchanged, at least in major cities. And yet I have to wonder how the PBOC sort of moves things in the direction of the digital yuan when so many consumers are used to doing everything in WeChat Pay or Alipay. How much of this is really about the government, number one, trying to crack down on these companies who the government's made it pretty clear they think there's too much power concentrated, and how do they spur things along?
So you've hit upon exactly the relevant issue in the context of China, because if one wants to think about a country where the user case for a digital official currency is quite weak, that country is China, because the use of cash is declining very quickly, because the private sector, especially Alipay and WeChat Pay, are providing digital payments in a very efficient and easily accessible manner. But the government is concerned, Akiko, for exactly the reasons that you mentioned. These two payment giants have accreted a lot of economic and political power. They are making it harder for new entrants into the payment space, limiting competition, limiting potentially innovation. And more importantly, the government is very concerned about 2 things: that the use of central bank money at the retail level disappears, which the central bank certainly does not want. And second, that these payment platforms have been collecting a trove of data on payment transactions conducted on their platforms, and until recently not been willing to share it with the government. We've already seen actions by the Chinese government to cut down these tech giants to size. And I think it views the digital yuan as one more tool in its toolkit to be able to cut down the power of these giants.
As far as Brian Chung here, that's a really important point that you bring up about the privacy, because again, if you are transacting in the PBOC's digital yuan, there is the concern that the government will be able to see all your transactions. So in tandem with the concerns that we've seen, especially on the global stage of the Olympics with human rights, is there a serious concern within the Chinese kind of domestic economy over how the government's going to use this? Have they outlined any sort of parameters or limitations by which they'll be looking at use of the digital yuan?
That's a very legitimate concern, Brian. But somewhat curiously, the Chinese government is trying to make the case that people in China should use the digital yuan rather than Alipay and WeChat Pay, because the government would be more prudent in terms of how it uses the data compared to those commercial giants which would use it for commercial purposes. But certainly the sense that it could be used for the government's surveillance is a major concern. Now, what is interesting is that the government is offering these digital yuan wallets with different categories of privacy. So, for instance, the high-grade digital wallets, which would allow you to hold large balances in those digital wallets, use them for high-value transactions, have to meet know your customer and regulatory requirements. But then there are also low-grade digital wallets, where in principle, just by providing a mobile number, you can get access to such a wallet, and that gives you some degree of transactional privacy. But the reality is that anything digital is ultimately going to be traceable, because no central bank really wants its money to be used without auditability and verifiability of the transactions. So I think this is a very legitimate concern, although certainly there are design options that are becoming available that will make that trade-off between privacy and convenience somewhat better than it is right now.
I mean, how much of those concerns around privacy inevitably point to the leadership on the Chinese part, just given that they don't necessarily have to deal with the type of privacy issues that would pop up in the U.S.? Certainly, that's part of the concern with the Fed pushing for the digital dollar as well. You know, there's going to be a lot of people who are saying, well, do I want all my transactions tracked in that way?
That's, again, a critical concern. Every economy that is considering the issuance of a digital currency is looking at these issues as not just an economic or technocratic issue, but really a social one. Because as you correctly point out, whether we want to live in a world where every transaction ultimately is going to be visible, either to a government agency or central bank or to a private payments provider, is a really deep question that we all need to be grappling with. But the reality is that cash is on its way out. So the question here really is whether we have an alternative in the form of a central bank managed digital payment system as an alternative to a private payment system. And I think there are certainly some advantages to having that, at least as an alternative. But it does bring to the fore a broad range of concerns, and the loss and the erosion of whatever little privacy and anonymity in our financial lives that we have right now is certainly going to be a significant risk.
Ishwar, so then on that point, could you see the Federal Reserve wanting to take on the idea of adopting a U.S. digital dollar? Because that, in addition to the concerns about competition, because the Fed doesn't want to get into the space of taking air out of fintech companies that are already providing payments options, could you really see the Fed wanting to take this on?
That's a really key question, Brian, whether we want the Federal Reserve to be providing services, either payments or some sort of banking services that the private sector can provide quite efficiently, and indeed that the private sector should be providing and innovating on. So central banks like the Fed are dealing with this conundrum right now because the use of the money that they provide, physical cash, at the retail level is disappearing. So the question is whether they want to maintain their relevance in that dimension. But the risk is that if the central bank does provide a payment mechanism in the form of a digital currency, then it could inhibit private sector innovation. It could end up with a lot of deposits fleeing to central banks rather than commercial banks. Again, there are ways in which you can design central bank digital currencies through either design choices, conceptual or technical, that can mitigate but not eliminate those risks. But the Federal Reserve recently put out a paper, and I think it posed exactly the right questions. And the Fed has made it very clear that if it moves ahead on a digital dollar, it's going to do so only if it has full political and public support. And that, I think, is a very wise thing for a central bank not to go forward on its own unless there is broad support for it.
Yeah, and by the way, they are soliciting public comments on that. I think there's just over 100 days left to submit comments. So you can go to the Federal Reserve and tell them exactly what you think. That's for all of our viewers. But Ishwar Prasad, Cornell University professor of economics and the author, by the way, of The Future of Money. Thanks for stopping by. Well, we want to promo the event that we got going on tomorrow. Do not miss Yahoo Finance's 1-hour special, The Future of Finance, presented by Grayscale. Again, that'll be happening tomorrow at 12 p.m. Eastern. But coming up on the other side of this break, a crude awakening. I don't know who wrote that tease over there, but we're breaking down the latest moves in oil prices after Brent touched its highest price in 7 years at $94 a barrel. On the other side. Welcome back to Yahoo Finance Live. Let's take a look at crude oil early on this afternoon, on this Monday, February 7th. Looks like it's $91. But over the last 6 months, obviously, the big story has been crude going up nearly 40%. So let's get a little bit more commentary on whether or not we should expect to see energy prices continue to go up. For more on that, we've got Troy Vincent, DTN Senior Market Analyst, joining us from Louisville. It's great to have you on the show, Troy. Simple question here, I guess. Should we expect to see oil prices continue to go higher from here? Because it's been a remarkable 6 months so far.
I mean, I certainly think there's room for positioning to continue to, be more bullish in the coming weeks, particularly on the speculative side of the market. I think there's been a lot of people that have kind of held out that particularly, that in past cycles may have already been in on this oil cycle, but that have been so hesitant, whether it's for the ESG narrative pushing back against oil prices or, renewable growth, et cetera, all of the essentially, bearish kind of macro themes for oil. But yeah, so I think for multiple reasons, there's still room to go higher in the coming weeks.
Well, geopolitics certainly clouding the outlook, especially with what's playing out over in Russia and Ukraine. How much of that disruption you think has already been priced in when you look at where oil is trading today? I realize part of that is really more of a natural gas story, but how much do you think prices push higher if, in fact, there's some kind of military activity?
I mean, I certainly think at the end of the day, ultimately it does come down to, how extensive the military action, becomes. But I certainly think, you could see a 10, 15% run higher in crude prices if, in fact, you did begin to see some type of hot war, and they could even go much higher than there if, a hot war were to expand and, the U.S. were to sanction oil exports from Russia, for example, things along that line. So I certainly think, we're in a precarious situation. One of the bigger themes moving into 2022 is this potential for OPEC spare capacity to be much smaller, particularly by the time we get to summer, than what we've seen in many years, that would bring it kind of back to that 2018 level. And anytime you have a scenario where you have spare production capacity limited, whether it's a weather event, like hurricanes, or it's a geopolitical event, like a hot war or terrorist events, et cetera, there's just so much more potential for upside in price action and response, and price just becomes far more sensitive to any type of, even potential development that could be disruptive to supply.
Let's talk a little bit more about OPEC, because my understanding is that OPEC Plus did agree on a March output rise. So how do you think that's going to weigh on not only, I guess, the price of barrels, but also the prices that consumers pay at the pump? Because the statistic is what? The national average for a gallon of gas, highest level than in more than 7 years last Friday.
Yeah, I mean, so OPEC is, they're in a very precarious situation at the moment where they have been agreeing for months now to increase production by this 400,000 barrel per day mark, and lifting, slowly but steadily every month that quota or that allotment. However, there are a number of players within OPEC that just haven't been able to deliver. And, Angola, Nigeria are kind of key to that, outlook or that development and the underproduction. But as we move, particularly into the spring and summer, that those members that are underproducing are going to, go under even further scrutiny, and it's going to be even more important to the global market whether or not they can bring crude back, that supply back. And Russia even is becoming a player that is likely to not be able to increase production materially here over the coming months. So you're in a situation where, although OPEC is agreeing to, in word, to increase production by 400,000 barrels per day per month, by this point, they're actually underproducing somewhere around 700,000 barrels per day as a group relative to what they're supposed to be, or what they're allowed to be producing, if you will, under that, output agreement that they've been growing by that 400,000 barrel per day pace in recent months.
Troy, I mean, you've introduced a lot of layers here, potential drivers for oil prices over the last few minutes. I mean, bottom line, is $100 a barrel, is that pretty much inevitable at this point?
I wouldn't say it's inevitable, but I think it's going to be very easy to get there. As I said, there are a number of factors. I've got to bring this up, I guess, as well. You've still got institutions like the EIA, for example, that are saying that prices, in their last short-term energy outlook, now we have a new one coming out tomorrow, which may adjust things likely, but in their latest issuance from early January, they were calling for the price of oil to top in January. And so from their perspective, you should have already seen the high for the year. However, investment banks, hedge funds, et cetera, that have been paying a little more attention to both slow production growth returning, the slow production growth and the return of production in the U.S., as well as the seemingly inability for a number of OPEC and OPEC plus members to, increase production along the lines that we just discussed previously, that are seeing a much different picture as we move into 2022 than the EIA is, for example, in their outlook. So I think that, that potential for this big divergence in outlooks also just creates, the potential that you see prices whip higher in a much more rapid pace, than we've seen even in recent weeks.
And we will certainly be watching for any changes to that outlook from the EIA. Troy Vincent, DTN Senior Market Analyst. It's good to talk to you today. Appreciate the time. Coming up, crypto companies looking to score a touchdown at the Super Bowl this year. We're breaking down the millions of dollars these exchanges are shelling out for ads after the break. an on-screen reunion of real-life couple Scarlett Johansson and Colin Jost with Amazon's Alexa, to Paul Rudd and Seth Rogen selling potato chips. This year's slate of Super Bowl ads set to be yet another celebrity-filled event, but another big star, crypto. Let's talk about Katie. Let's bring in Katie Thomas, Carney Consumer Institute lead. And Katie, let's talk about the exposure or how much we're likely to see crypto here. It seems like a natural transition. We've seen exchanges like FTX, all over baseball playoffs, basketball as well. How significant a presence are we going to see crypto in Super Bowl ads?
Yeah, Kiko, it's looking pretty meaningful here. We're hearing things like it's being referred to as the crypto bowl. And I've heard, a handful, 5 or 6 different crypto companies are going to be advertising this year's Super Bowl. And I think it's really powerful. It's the right time to do it because ultimately there's still a lot of consumer confusion and even just intimidation around crypto. So having just one ad maybe wouldn't get enough consumers over the hump, but seeing a handful of ads is going to probably pique enough interest that consumers will then go ahead and do their own research and find out a little bit more. The challenge for brands will potentially be to stand out amongst the different crypto organizations, but still a great opportunity just get consumer eyeballs and really gain some interest there.
Hey, Katie, it's Brian Chung here, but let's talk about the companies that even aren't crypto companies, right? I'm talking about, let's say, the big beer companies, and they've shown that they're interested in wanting to ride the metaverse NFT crypto SEO wave as well, right? I think it's Miller Lite that has, for some reason, this metaverse bar going on, and then Bud Light's going to have an NFT collection for some reason. I mean, why is it that even the other traditional consumer brands we're used to seeing are wanting to dive into that space as well?
Yeah, you're just seeing an opportunity for diversification there. For Miller Lite specifically, there's sometimes parameters around how they're allowed to advertise during the Super Bowl because of Anheuser-Busch really running the show. So I think they're just using this as an opportunity to get creative. But I think there's been so much chatter around NFTs, the metaverse, that this is a great opportunity for brands to test and learn and figure out what that overlap is. We know how many people watch the Super Bowl. The sort of gaming virtual metaverse is something we're still learning about. So it's a great chance for brands to really tap into that and understand where the opportunity lies. I mean, and then you're seeing it in sillier, more tactical ways too, right? Captain Morgan has created a punch bowl that's a speaker and it tells you the store. So you're seeing consumer engagement being tested in different ways and a nice lighthearted approach to the Super Bowl this year.
Yeah, it feels like hyper engagement, right? You don't know which screen to be looking at here. The NFL has had really great ratings throughout the playoffs. Obviously, the ratings expected to get a big bump from last year's Super Bowl too. I mean, who knows? But I wonder what the payoff is for some of these brands. And that's a conversation that's been playing out over the last few years. Is it worth the millions for that 30-second spot? Is the payoff still there during the Super Bowl?
I know it's a complicated question. I mean, as you see here, the average price $6.5 million. Some brands paying upwards of $7 million, including these new crypto brands that don't necessarily have a long-standing relationship with the NFL or NBC. So it's complicated there. Now, the reality is, though, ultimately is a lot of these brands compete in increasingly crowded categories. And the challenge is just that, which is a competition for consumer eyeballs. So even though the ROI can be hard to measure, to get that much scale and to drive some interest and traction in the brand, and then especially thinking about what consumers are going to do with it next. So how do we take the eyeballs on the brand from the Super Bowl and really translate that into purchase and not just awareness? Is where there will really be a difference maker. But I think there is power in the Super Bowl this year, just given the momentum we see going in, as well as just trying to break through the noise of to your point, all the different media and platforms we're using at any given time.
And then, Katie, obviously sports betting, it used to be the case that the only way you could bet would be by the squares where you're betting on the score of the game, which, by the way, I put our office pool together. Really hard to do. Not easy to put together those squares. But I want to ask, obviously, now with a bunch of states legalizing sports gambling, you can place bets on the spreads or player props. Should we expect to see the flow of Caesars ads and DraftKings ads that we've already seen the last few months also invade the Super Bowl as well?
Yeah, one time, Brian, I managed our office's March Madness pool, and I certainly came to regret it. Yeah, but yeah, I think the great thing about gambling, I mean, certainly it has some inherent risk in its own right, but the great thing about DraftKings and FanDuel as some of these other sites is it really just drives additional interest in the game. So especially a year like this, where the Bengals and the Rams, aren't your traditional teams, not quite what you'd expect. Just a couple fun bets can drive a lot of interest in the game, as well as the different parlays you can do and all the specific things you can bet on. So yeah, I think you'll see a lot of those big brands really take advantage, not just in the Super Bowl, but again, going into March Madness and some of the other big sporting events we have coming up, of just letting consumers really have fun with it.
All right, Katie Thomas from the Carney Consumer Institute. Thanks so much for breaking all that down for us. Enjoy the big game this weekend.
Thanks.
Well, coming up on the other side of this break, we are taking a look at where stocks are as we get deeper into the afternoon. We'll have the breakdown of all the market action on the other side of this break. Welcome back to Yahoo Finance Live. We've been teetering up and down, especially on the Dow, red and green through this Monday, February 7th. So let's get a little bit more of the update as all the market indexes appear to be in the red now with Yahoo Finance's Jared Blakely. Jared, what's the update?
That's right. We had a little bit of green to start off the day. We saw that close to the open and then peaked shortly thereafter. You can see we're in the red right now, down 0.4%. But in the grand scheme of things, especially compared to the volatility we were seeing last week, not a whole lot of price movement today. And in fact, if we put a longer term price action chart here, candlesticks, we can see we're really just inside, in terms of the Nasdaq, we're just inside the prior day's range, which was almost equal to the prior day's range. So really not a lot of action over the last few days, just kind of looking for that next catalyst. Do have a bunch of earnings this week. And of course, everybody's looking ahead to the Fed and that big CPI print, I believe Wednesday, Thursday morning, somewhere in there. A lot of a focus on that. Here's the S&P 500, very much an inside day here. So as I've been saying, this is the decision area, and I think If this is broken to the upside, got a big shot at reaching those record highs. And if we break it to the downside, probably going to at least test these lows and possibly go even lower. I want to take a look at the bond market. 5-year T-note yield down about 2 basis points right now. You can see it did break up to the upside on that jobs report last Friday. 10-year T-note, pretty similar chart here. And finally, the 30-year, that is hovering at 2.24%. Want to take a look inside the market now, and we can see, well, here's our meme stocks. I guess we left off on that. Interesting to see American Airlines up 4%, I guess, and not seeing a whole lot of other big movers. AMC down 3%, GameStop down 1%. A lot of these guys had a rough go of it this year so far. Did see activity pick up a few times, but we'll have to see if anything comes of that. Energy is now the leading sector of the day, as it has been just about the entire year, followed by staples, real estate, discretionary, and industrials and financials also in the green there. To the downside, communication services is the worst performing sector along with tech. So between those two, you got Alphabet, Apple, you got Facebook in here. So a lot of the mega caps under a little bit of pressure here. Let's take a look at what's happening. We can see Amazon bucking the trend. That's up 1%. So is Nvidia up over 1.5%, but Alphabet down 2.5%. Facebook continuing its woes. That stock is down 5%. I just want to check a 3-month candlestick chart so we can really see the precipitous decline that we saw the other day. That was on their earnings announcement. And as I've been pointing out, the last time this happened, 2018, stock was dead money for a couple of years. So have to kind of figure out where we're going to find a bottom here, guys.
Jared, Bitcoin also seeing some gains in the session today, just breaking above that $44,000 level. Still well off of those highs that we saw above 60,000. But what's going on there?
Yeah, well, we have this downtrend that's been in place since probably even before 3 months. Let me put a 6-month chart on here. And here is that record high that we had last November. And if you draw this line, you can see we broke through over the weekend, late last week. So nice to see this price action here. It is the beginning of potentially a rally, but also keep in mind that, as we were discussing over the breaks, not a lot of institutional flows over the last year. So we'll have to see what we can make of this, if we can finally eclipse those record highs, but need a big catalyst for that to happen. Also, check out the SHIB. Shiba Inu, that is up 50% today. And I don't know, do you need news on a ticker like this? I don't think so. But guess what? It has broken its downtrend as well. So pretty big, I would call anytime you see a chart like this where you have a very long consolidation period or trend period and you break to the upside, that's usually going to be a bit of short covering. So we'll have to see if we can find any momentum there. But also looking at some of the other big winners and losers, I haven't talked about Ripple in some time. That's up 17%, Dogecoin up 12%, Litecoin up 10%. So really nice to see some gains in the crypto space and also all these beautiful crypto stocks as well.
Hey, look, we love to see an altcoin getting attention. It still feels very 2021 of us. Yahoo Finance's Jared Blickery. Thanks so much. Well, coming up on the other side of this break, the worst airlines ranked. We'll reveal the airline that took the top spot. And just a hint, it's not either of those companies that announced a merger today. We'll have the answer next.
Welcome back to Yahoo Finance Live. In our hot takes today, we are talking about airlines. Shares of all the major airlines up in a big way on the back of that announcement from this morning. Frontier and Spirit merging to create the 5th largest airline in the U.S. But Brian, right now we're talking about the top airlines when it comes to just how on time they are. The Wall Street Journal out with their 14th annual report. Taking the top, Delta, not entirely a surprise, but let's walk through the numbers here. Delta canceled 0.6% of their scheduled departures last year. That's better than the performance they had back in 2019. So even with COVID, even with some workers calling out sick, they were able to still maintain a very low cancellation rate. JetBlue on the opposite side of things, and the Wall Street Journal says specifically, approximately 262,800 completed flights, but 14% of those were delayed 45 minutes or longer. I don't know which airline you fly a lot, Brian. I am trying to switch over to Delta. I like Delta. I have a lot of United miles, so those are kind of the two airlines I often work with. But I don't know, JetBlue, in my experience, I haven't had too many delays every time I've flown them.
No, and I haven't either, but you see these rankings come out every year and you're always just like, you know what does this even matter? Because I'm booking the flight that they provide me the best option with. And it's often about timing and it's about where you live. For example, because of the hubs, if you're flying to Dallas-Fort Worth, you're probably flying American. If you're flying to Minneapolis, you're probably flying Delta. Like, it's just, you really don't have that much of a choice. And when you do in these loyalty programs like you're in, Nikiko, you're just pigeonholed to this whole thing anyway. Even if United treats you terribly and you're like, you call consumer support and then they throw you another 10,000 miles and then you go, okay, well, I guess I'm going to fly United again. And now with the consolidation of Frontier and Spirit, we're just going to have fewer options here. So again, I just don't see these rankings weighing on people booking their flights and going, I think I'm going to try to book Delta over United this time. You ultimately just go with whatever works best for your schedule. And when they treat you like garbage, you deal with it anyway.
I have found, Brian, that Twitter shaming is a very powerful tool. And so when you've got a delayed flight and you're not getting what you want out of the airline and you tweet, guaranteed you get a response right away. I had a flight on United where I was stuck on the tarmac for more than 2 hours, and they did end up crediting points back to me because I flew on mileage. But it is a bit of a hurdle when you have to deal with that. And you know what? Chances are if you went with Delta, that's the one time your flight would be delayed, right? That's kind of the luck that I think a lot of passengers have right now.
Yeah, that's always, and that's always how it ends up going. But a little bit of blue check rage, I guess, certainly doesn't hurt if you're complaining to them on Twitter. I haven't tried that yet before. I should do that. Just to at support. Help me.
Twitter shaming?
Yeah,
it works every time. It works.
I just don't want randos hopping in there like, wow, embarrassing. Brian flies economy. basic
I'm
economy.
Not ashamed to say that I'm not willing to pay for an upgrade, but hey, airlines, something that I think a lot of us can relate to. There's a lot of frustration at the airports, whether it is the delays, just crowds, TSA, and then of course the airline experience. We were talking to Secretary Buttigieg earlier about unruly passengers. Not sure if that's going to get better, but certainly interesting to see, at least in numbers, specific data that points to which flights were delayed the most. Delta coming out on top yet again. That does it for Brian and I in these 2 hours. We've got much more to come here on Yahoo Finance Live as we see all three major indices in the red. We'll be right back.
A match made in the skies. Budget airlines Frontier and Spirit plan to merge to create the 5th largest U.S. carrier. But just hours after the announcement, all Frontier flights are grounded. We break down what the deal means for passengers and how an ultra-low-cost giant will impact the legacy airlines. Spotify's CEO apologizes to employees for the Joe Rogan backlash, but stops short of removing the controversial podcaster from its platform. What's next for the streaming service as it tries to do damage control? And 85% of the world's millionaires are men. We speak with the author of the book, We Should All Be Millionaires, about just what's holding women back from a 7-figure net worth. Hello, everyone, and welcome to Yahoo Finance Live. I'm Alexis Christoforous, along with Karina Mitchell, and taking a look at the market, stocks reversing an early gain. Now the major indexes modestly lower, Karina, despite another batch of strong earnings from companies including Hasbro and Tyson.
Yeah, exactly, Alexis. Stocks bouncing around a little bit between alternating between gains and losses. Actually nice to have a quieter day without as much volatility. After the S&P booked its best week of the year, so far nearly 60% of S&P 500 companies have reported, and more than 75% of those beating on earnings and revenue. So looking at the benchmarks, as you said, all in the red right now. The Dow off by 26 points, the S&P lower by 10 points. The Nasdaq, the laggard there. That's despite a push higher from Amazon, building on that nearly 14% spike last week. Sector-wise, let's take a quick look at some of the winners. They include energy and consumer staples. Meanwhile, on the flip side, some of the biggest losers, communication services is the biggest laggard, followed by tech and materials. Let's head over to the bond space and take a look there. The 10-year yield is little changed at the moment. It is at 1.93. That after surging last week to hit that level on that better than expected January jobs report, the 30-year yield now at 2.24. Okay, with more on what's moving markets on this busy day, let's bring in our Jared Blickery. And Jared, like I said, it's nice to have a little bit of quiet today, less volatility, at least at the moment.
Yes, and even faced with these small losses right here, I think investors would take that over the gut-wrenching losses that we had 1 week ago. Also noting the Russell 2000, that is in the green for 0.33%. Just taking a quick look at the sector action, as you said, Karina, energy, the biggest outperformer, up over 1%. We'll take a look at crude oil in depth at the oil market close at 230. Also, communication services, that is the biggest laggard to the downside. And guess what? That is a Facebook and Alphabet story, and neither is doing quite well today. Facebook continuing its downward trend after that huge loss last week, where it lost $251 billion in 1 day. That's $250 billion. Alphabet down 2% as well. Some other standouts here. Not a lot of dark green to look at. Align Tech, that's up over 2.5%. Booking.com over 2%. So let's take a look at the travel space, and we're seeing a lot of green here. Carnival Cruise Lines, that is up 6%. Norwegian up 7%. Royal Caribbean up 7.5%. And the airlines, Delta's up 2%. Southwest up about 1%. Well, let's take a look at some of the tech sector, which is flagging today largely, but not in the semiconductors. We'll take a look at some of the other names in a bit. AMD up 1%, Applied Material up 1%. NVIDIA up 2%. Now, in the software space, we were talking with an analyst earlier, likes cybersecurity. We are seeing Snowflake, that stock is up 8%. Datadog, that is up 2%. And I think we got to get to Peloton. We're going to be talking a lot about this stock today, as we have, but got to chart some of the price action, because you take a look at what it's done over the last 2 years. And it is right back to break even, up only 1.5% during that time. Had been up many multiples of that, but it's been a slow and steady downward slog for the fitness device maker. And it's almost difficult to see what the price action is today. It's up 15%, but really not a lot in the big picture. I do have a little bit of analyst commentary. Just want to check this out. Cowen rates the stock in outperform with a price target of $40. You can see that's about $12 above the current price, saying any deal is unlikely, and given the company's dual class share structure. That has to do with voting control, also concerns about long-term growth potential and vision. Basically saying it's a poor fit with reported potential acquirees. So we'll have to see. Is it going to be Amazon? Probably not. We had Dan Ives from Wedbush Security on earlier today. He was saying it could be an Apple buy. So I guess they're in the lookings. We'll have to see, guys. Peloton. It's been one of the dogs of last year.
Yeah, and Apple has not made a real sizable buyout since buying up Beats a few years back.
Good
so
point.
We'll see how it plays out. All right, Jared Blickery, thanks so much. Let's bring in Brent Schutte now, Chief Investment Strategist at Northwestern Mutual Wealth Management. Brent, always good to see you. I was reading up on some analyst notes this morning, and there are a couple of diverging opinions out there. You've got JP Morgan telling clients to buy stocks right now because the Fed's rate hikes are already priced in to the market. They say that the equity cycle is far from over. But then you've got strategists at Morgan Stanley telling investors to position defensively for more downside. So I'm curious where you fall in all of that.
Yeah, I mean, we think that sentiment alone is washed out. So there's many people right now who are actually bearish. If you look at some of the sentiment surveys, they're completely washed out. And that in and of itself is a good contrarian indicator. That typically leads to an up equity market in the future. Think about climbing that wall of worry that we've all heard so many times on Wall Street. The good news here that I think kind of would explain why we are optimistic is that inflation, we believe, is set to moderate. And so you've had inflation and the Federal Reserve. What will they do about it? Those are the two big fears that are out there. And certainly we get a CPI report this week that will remain elevated. But we do think you are seeing signs that inflation is moderating. So think about the last few years. We've had shortages of labor. Last week's labor market report showed 1.4 million people rejoined the labor market. So hopefully some of those jobs that are open will be filled. And on the supply side, you've seen supply growing. So you've seen inventories rebuild. In the fourth quarter GDP, that was driven by inventory rebuild. And last week in the ISMs, we saw some customer inventories being rebuilt. We saw backlogs of orders being chewed through. And so all in all, when you tie it together, we think that leads to some inflation concerns ebbing. And importantly, I think the nail on the head was the Fed, the 5 rate hikes are already priced in. We do believe it will be less than 5 in 2022.
And is that because you believe that whatever they do with rates will work its way through the system and bring inflation down enough that they won't have to raise 5 times?
Yes, I mean, I think inflation is already set to move lower. Certainly the Fed raising rates will help that. That's a delayed process, keep in mind, because that doesn't usually filter through until 6, 12 months in the future. But all in all, a lot of what's happened on the inflation side is due to COVID and pandemic related issues such as labor shortages and heightened demand, which was shifted towards goods. Goods arrive in container ships. Goods are where you have seen inflation pressures the most, and those are set to ebb in 2022 as people return to public, as some of that demand has been pulled forward. And Jared brought in that Peloton chart. Think about the Peloton demand that was possibly pulled forward last year because of people having to stay home. Now, if they have to go out, if they get to go back out in public, perhaps some of that demand's pulled forward and you won't have that pressure on prices on that goods side in general.
I want to get your opinion on the FANG stocks in particular, because the popular sort of FANG trade has been showing a lot of cracks lately. And it looks like investors are sort of reconsidering their approach to these big tech names and cherry picking who they think the winners will be over the next year. Some have been hurt by the prospect of higher interest rates, others hurt by stretched valuations. What do you do now with that FANG sector?
I just think in general, you have to be more specific about what you're trying to buy, not just buying whole indices such as the FANG stocks in general. I think more and more you're going to see companies that can have positive earnings revisions outperform, and you've seen that. Think about the disappointments versus the ones that have actually gone higher. And so all in all, I still think, tech sector, longer term secular grower, but I would again point people back towards other parts of the market that haven't been as popular recently. You have something called the US small cap sector. The S&P 600 is going to grow earnings or expected to grow earnings in 2022 by 12%. It trades at 13.5 times those earnings. Contrast that with large cap US stocks. I'm not saying they're all bad, but in general, large cap sector, the S&P 500 expected to grow around 8% on the earnings side. It trades at 20 times. And so we would incrementally focus our viewpoint towards those small cap segments of the market, which we think are cheap and poised to produce more earnings growth in 2022.
I'm so glad you brought up the small caps, Brent, because I wanted to ask you about the Russell 2000 small cap index performance year to date. It is continuing to underperform the broader market, the S&P 500, even the Dow Jones Industrial Average. And it sort of has been this canary in the coal mine for stocks for much of the past year. And I'm wondering if you think this continued weakness we're seeing in the small caps is a harbinger. Does it suggest another pullback in the markets?
No, I mean, we focus more on the S&P 600, which is more quality. The Russell 2000 doesn't have the same profit metrics that the S&P 600 does. Both small cap markets, but we would focus there. I think to me, it all comes back to this worry about, will the Fed make a policy mistake because of inflation? Will they over tighten policy too much? Will they be forced to tighten policy too much? And I think that's where the big argument in the market is. Our answer is no. Inflation is going to moderate. You're going to see some of these things normalize as the economy normalizes. And you're going to see a Fed that does not want to end the economic cycle, and they have a pretty powerful say in when it ends. They want to fine tune it right now so that they get a longer economic cycle to get more employment growth, which is still their mandate number one.
Let's just break down a few sectors for folks looking for some investment ideas in 2022. Energy just came out of the gate on fire this year. And just taking a look at crude, pulling back a little bit today, but still that steady march towards $100 crude appears to be happening. What, if any, exposure do you have to energy right now?
Yeah, we recommend, and so we certainly have energy stocks. We recommend a balanced approach. And so when I talk about making tilts, we just tilt a portfolio in that direction. But we keep exposure to nearly all sectors in all different parts of the market. We just want to overweight and underweight and emphasize different themes throughout to add value above and beyond the benefits of diversification. And so we do have exposure to energy stocks. We also still recommend that investors have exposure to something called commodities, which is more the prices of those raw materials rather than what the companies are creating with them. And so certainly exposure to both is recommended, especially in a period like today where we still have fairly strong demand against somewhat constrained supply.
So when you're looking within commodities, is there anything there that you like over another, gold over copper, or are you doing anything with the outlier commodity, and that would be the cryptocurrencies, specifically Bitcoin?
You know, I've been on this show and I've talked about hope, streams, themes, and meme stocks, and that's kind of what drove markets for 2021 on the back of that really large monetary policy that was out there. So people were encouraged to take risks. Real rates were really negative. I think you're on the opposite side of that right now. And so certainly there's probably some value within cryptocurrency, but I want people to not speculate too much. The time for speculation is probably not when the Fed is trying to tighten policy like they are today. I don't think they're going to over tighten, but you open the comments with back and forth in markets. Think about more of that in the future and people really trying to figure out what's real and what's not real. And if you're going to speculate in cryptocurrency, which is speculation, just be careful, because certainly there is still a lot of unknown. There are many cryptocurrencies out there. Which one is going to win? Which one isn't? And then what's the real value of all those? And I think those are still up for grabs. And so I would focus more on hard commodities rather than cryptocurrency.
All right, Brent Schutte, Chief Investment Strategist there at Northwestern Mutual Wealth Management. Thanks so much for helping us kick off the week here on Yahoo Finance. And a reminder that you can step up your investment strategy with a free 14-day trial for Yahoo Finance Plus. You'll get expert research reports, actionable investment ideas, advanced portfolio tools, and more. It all comes to you in a sleek ad-light experience, and you can check it out starting today at yahoofinance.com/plus. Karina?
Okay, coming up, the two largest low-cost carriers in the U.S. announce a plan to merge, what it means for the airline landscape. Coming up next. Welcome back to Yahoo Finance. In a deal valued at about $6.6 billion, Frontier Airlines and Spirit Airlines are combining forces, merging to combine what would be the fifth largest airline in the country. Here to help us discuss is Sarah Nelson, President, Association of Flight Attendants. Sarah, thanks so much for being here. I know you don't work particularly for any one of those airlines, but why do you think this is such a big deal and a good decision for both of them? Because they both have been trying to expand.
Well, look, we represent the flight attendants at both Spirit and Frontier. And so we have a very sincere interest in this. We heard from the executives a couple minutes before this was announced to Wall Street and the media. And I have to say that I've been around for a lot of airline mergers, and that was something new. We are used to airline management reaching out to us sooner. So they didn't necessarily get off on the best leg with labor here in waiting so long to talk with us. But what we are saying is that this could be a good thing, but it's not going to have our support until we understand how it's actually going to be a benefit to the people on the front lines who have sacrificed for these airlines, worked hard for these airlines, worked through crises for these airlines, and really made it possible to get to this day where we can consider bringing these airlines together for a bigger network for consumers and a potential real advantage for people who have invested.
And I want to bring your attention, you may have seen this, a recent Wall Street Journal survey ranking several airlines across several metrics, and Frontier and Spirit ranked worst across 7 different measures for the airline. So what do you think a merger like this will mean for consumers at the end of the day and for the industry as a whole?
Look, there's a lot of kinks to work out here. We had a glitch at Frontier this morning where we had a ground stop because there were IT issues. We've had operational meltdowns recently at Spirit. We've worked with this management. This is being overseen by the billionaire Bill Franke, who's been in the industry a very long time. And if there's the right investments in putting these systems together, this could work a lot better. But we actually know how these mergers work, and they should be engaging with the unions on all of that. That will be an absolute benefit to consumers if they do that. And frankly, we're going to withhold our support until that happens.
And then, Sarah, I want to bring your attention. The Delta CEO, Ed Bastian, said that he wants to put unruly passengers on a no-fly list. And we actually had Transportation Secretary Pete Buttigieg on the show earlier. Wanted you to take a listen to what he had to say and then just get your reaction on the other side. Take a listen.
The FAA is continuing to vigorously enforce and encourage criminal referrals where appropriate for this kind of behavior. In 2022, we should not even have to say that when you're on an airplane, you need to behave in a way that is safe and appropriate. But we still have far too many cases, far too many examples of flight crews being mistreated or even other passengers being harmed by unruly passengers. It's got to stop, and we're going to continue doing everything that we can through enforcement and through just getting the message out there that we stand with flight crews.
So we're coming right to the source here, Sarah. You've experienced it. You've heard the stories from your crew. Tell us, how important is something like this? Do you agree with it?
Well, this is incredibly important, and we really appreciate the support of the Secretary. The Secretary has also said that what should be on the table. In the past, he has said that a no-fly list should be on the table because there has to be very severe consequences for those who are acting out. It's a relatively small number of people, but they have created incredible harm, incredible risk to the safety of everyone on board, and at the very least, a major inconvenience to the rest of the passengers. But what this also has done, if we accept this as a new normal and we don't get busy trying to get these incidents down, is that we're also handing another tool to those who would like to use commercial airliners as a weapon against our country like they have in the past. And that remains a threat that we are on the lookout for every single day. We don't need any distractions from that. And that's another big consideration here, in addition to the fact that the people that I represent should not have to go to work in an environment that feels hostile every single day.
Yeah. One of the big considerations, that happens is that people are upset about having to wear masks in flight. They don't want to do it. Some of them are critical about, not having alcohol. I want to get your reaction to Southwest just announcing that it is going to reintroduce alcohol on longer flights for passengers. So now American is the only big carrier that isn't allowing alcohol. I know there has been some pushback from flight attendants and the union there. Yeah. Where do you weigh in on this?
I really support my good friend Lynn Montgomery, who is the president representative of the flight attendants at Southwest, their TW 556. And they have said that this policy went into effect at Southwest of not serving alcohol the week after the flight attendant got two teeth punched out. And so this has been part of the efforts to keep down these violent events on the plane. And we haven't seen a decrease of those events. So why we're bringing alcohol back is a mystery to us. We're totally opposed to that. We don't need to be introducing anything else that is a major contributor to these events. I want to give American Airlines a real, I want to really applaud the way that they have worked with the unions and listened to us and really worked with us to protect the people on the front lines, and that they have kept that no alcohol policy in line. But we also need airports stopping pushing alcohol in the airports with to-go alcohol. These are some of the things that we still need to work on, because these incidents are just way too high, way too frequent, a major risk to everyone who is flying. And we're getting to a place where people are starting to think that this is what you're going to experience when you buy a ticket. And that has real economic consequences potentially too.
And then I want to turn your attention finally to, we just came through the winter holidays and airlines got hammered for having to cancel flights. There wasn't enough crew. There weren't enough pilots. Part of it has to do with vaccines and mandates for crew and staff to be vaccinated. Where do you stand on that? And, what percentage now of the flight attendants in your union are vaccinated?
Well, I want to be really clear that the cancellations had nothing to do with vaccine mandates over the holidays. It was all about the rise of the Omicron variant, and that we actually had crews that were getting sick at the same rate that the rest of the public was getting sick. And so people were out sick and not able to cover those flights. We're already running an operation where people are not willing to pick up the voluntary overtime hours that they were before the pandemic because of the conditions at work, because of the concerns around the pandemic and the concerns of the conflict when they get to work. So this was really a result of that surge, and we were feeling it everywhere. We were feeling it in staffing in the airports, on the planes, and in the transportation, even getting to our airports and the restaurants and hotels around there. So everyone felt it. And this is not really about the vaccine mandates, where we are well over 90% vaccinated in the airline industry. Don't forget that our workplace is the world, and we're also subject to vaccine mandates with other countries as well. So in order to do our jobs, it's just critical. This is something that we're used to. We're used to having to have vaccines for any number of communicable disease. And this is the same with coronavirus. And so the flight crews are very highly vaccinated. And at United Airlines, of course, they're 100% vaccinated.
All right, we are out of time. We'll have to leave it there. Sarah Nelson, president for the Association of Flight Attendants, thanks so much for stopping by today. Alexis, over to you.
Coming up, we're going to talk self-driving technology with Transportation Secretary Pete Buttigieg. Welcome back. The rise of self-driving technology is one of the most vexing issues facing safety regulators, and much of it is falling on the U.S. Department of Transportation to figure out. Yahoo Finance's Akiko Fujita and Brian Sazi spoke earlier with Transportation Secretary Pete Buttigieg, and Akiko joins us now. And Akiko, I know this is one of the huge tasks facing his department.
Yeah, no question about that, Alexis. But there's a larger issue the department is having to deal with right now, and that is the alarming rise in the number of deaths they're seeing on roads across the country. When you look back to 2020, when everything was shut down, road deaths hit a 13-year high. That number was even higher last year, with roughly 3,000 deaths reported per month. So the Department of Transportation has laid out this ambitious goal known as the nationwide safety strategy to bring that number down to zero. In our conversation with Secretary Buttigieg, I asked him to what extent he believed technology could play a role in bringing down that number, and whether he was concerned about self-driving technology moving rapidly ahead without the proper safety checks in place. Take a listen.
It's very important for people to understand that any commercially available technology right now, no matter what the brand name is, no matter what people are calling about it, requires that you as a driver be paying attention. And you got to read the fine print on some of these things. Now, again, there's a lot of promise in these technologies for the long run, but we are reaching a point where the policies haven't always kept up with the technologies. I mean, so many of our regulations to keep cars safe are based on how cars always used to be. We need to make sure that they're based on how cars are going to be. It makes no sense to continue to focus on a regulation that says exactly where a steering wheel or a mirror needs to go in a car that doesn't even have a driver in the future. And these are exactly the issues that my department's working with as we look to the future, even as we try to address an issue, a crisis really, on our roads today, which is, again, yes, it has to do with cars, it has to do with drivers, it also has to do with roads. It matters how you design a road, how you design an intersection, how you design an interchange, and safer designs will save lives.
What I find so interesting, Mr. Secretary, is that the big automakers are so focused on making the best new cool-looking navigation screen or the best cool new plug-in electric vehicle. But there are technologies out there, some of which you highlight in your report, like alcohol detection system for the ignition and eye tracking technology. Now, do you think these things should be mandated standard equipment inside of automobiles?
So we are going to be evaluating how these safety technologies could become standard because this is part of how you also address some equity issues here. If having a car that's going to protect your safety, your life, your children is something that's only available as an expensive luxury item, then that raises some deep concerns about who is protected. We have taken steps as a country over the years, from seat belts to airbags, various things, not only to have things like the 5-star ratings that my department puts out to help people understand performance, but also just basic fundamental standards that we say, if you want to drive a car in this country, this is part of what goes into that car so that you know you're safe. And the answer is evolving as the technology is evolving. That's a good thing. We just got to make sure that we're keeping up. Now, also remember, technology cuts both ways. These safety technologies have enormous promise, but other technologies, smartphone technologies, some of the things that can go onto screens, run the risk of increasing distracted driving, which unfortunately it's taken its place right alongside impaired driving and drunk driving as a source of crashes and injuries.
Mr. Secretary, let's talk about where things stand with the administration's climate agenda as we see Build Back Better hit a bit of a wall here without support from Senator Manchin. The president has said he wants half of the cars sold in the U.S. to be EVs by 2030. He's also laid out a goal of 500,000 charging stations by the end of this decade. Can you get to those goals without the incentives in place from Build Back Better?
I think we can make enormous progress with the tools that we already have. Of course, we believe in the incentives in Build Back Better. We think they'll make a big difference in making electric vehicles more affordable. And some of the people who stand the most to gain from adopting electric vehicles, rural drivers, low-income drivers who could really use that gas money that you save because it's cheaper to fill up on electric than on gas and diesel. It would go a long way to buy down the sticker price for those cars and pickups, which is what those incentives would do. So we still believe in them. But I will say, with what we already have, the resources to create a national charging network of 500,000 chargers so that you never have to wonder if you're going to be able to get charged where you need to go. The partnerships that we have and the conversations we're having with industry. I mean, the automakers already working very quickly and effectively in this direction give me a very great degree of confidence that we're going to achieve this goal. We're going to try to beat it as a federal government, making sure that just when we buy our own cars, if you just think about the number of light-duty vehicles that the federal government buys, we can lead by example. We're working to do that, and that's another goal the president set that we're working hard to make sure that we meet or beat.
So Secretary Buttigieg there saying that, yes, the Biden administration can try to get to those goals on climate, but not necessarily that we will get there on that very issue. And that's partly because when you think about the amount of money and the incentives that have been laid out in Build Back Better, it is pretty significant, $500 billion specifically on climate initiatives, and then well over $12,000 for customers who are looking to buy EVs. By some estimates, Karina, if we're talking about 500,000 charging stations, some would say that the $7.5 billion that's laid out in the infrastructure bill would only pay for about 15% of the cost. And the big question is going to be, how are they going to pay for the rest of it if Build Back Better doesn't pass?
And so how well are U.S. automakers working with the Biden administration to make sure they reach some of these, really lofty EV goals, even if they don't have Build Back Better?
Yeah, it's been interesting to see how the administration has been working closely with the CEOs of the major car makers. Just last month, we had the CEOs from GM, Ford, and other car makers over at the White House touting the Build Back Better Act. That's been the number one goal for the administration, to try and get these executives out front to say there is an economic benefit. Behind the scenes, though, no question, as the secretary said, there's going to be some conversations that are going to happen about how much slack the private sector can pick up if, in fact, the government doesn't set aside these federal dollars. And I go back to that number again, in incentives, about $12,500, roughly. That's the amount of incentives laid out for EVs, because that would be play a significant role in getting that adoption up. And right now we're talking about the price of the EV being too high, adoption not necessarily being there, the infrastructure also not being built out, and the private sector is expected to contribute in a big way in building that out, because that's going to be necessary if the president is to get to that goal of half of all car sales being from EVs by 2030.
All right, Akiko Fujita, thanks for bringing us that interview with Transportation Secretary Pete Buttigieg. Of course, you can check the whole thing out on our site, yahoofinance.com. Karina?
Yeah, that was a great interview. Okay, coming up, we speak with the CEO of WM about earnings and the growing problem of waste in the U.S. That story ahead. Welcome back to Yahoo Finance. Well, Waste Management has officially changed its name to WM and changed its slogan from Think Green to For Tomorrow. Joining us now from the WM Phoenix Open for more on the evolution is Jim Fish, WM CEO. Thanks so much for joining us. The weather looks fantastic behind you, and you are billing this as a zero waste tournament. So tell me why the name change and what is the broader implication?
Well, when we went public 50 years ago, all we did was pick up trash and dispose of it. And we've become so much more. The evolution of WM over that 50 years is now to a company that takes renewable natural gas and powers our fleet that we create out of our landfills. We are investing a huge amount of money in rebuilding our recycle plants. We're already the biggest recycler in North America. And we just bought a company that takes low-value plastics and mixed papers that would otherwise have gone into a landfill and turns it into a sustainable building material. So we felt like the time was right to make that change.
So Jim, this is your 13th year as title sponsor of the Phoenix Open, and you bill it as the world's largest zero waste sporting event. Tell us what that means exactly, and how did you help it get there?
We've been zero waste here for 10 years. So we've been the title sponsor for 13, and 10 years of those 13, we've been zero waste. It is the biggest zero waste event in the world. And so it's a symphony. It takes a lot to get vendors, to get the general public, to get our employees. There's a collection of folks that contribute to making this zero waste. We recycle everything, or we reuse it, or we take it for energy production. There's any number of things that we do to make this a zero waste event, but it is now for 10 years been a 100% zero waste event.
Jim, I'm wondering, what have you been seeing as far as trash levels in general during the pandemic? We know that there are so many places that have pushed off being able to put off trash. And then with all these at-home test kits and masks that people have you seen the level of waste increase, and how are you dealing with disposing of all of that? You know, I have a daughter who has to take a at-home COVID test every Monday before going to school. And she said to me, "Mom, I don't know what to do with this." And I was like, I'm not sure how to dispose of it correctly either.
Right. You know, we've seen, we talked about our volumes last week on our earnings call, and they've been pretty robust. The only place that we're still not fully back to where we'd like to be is in our commercial line of business, because so much of that is small business. So small business is coming back, but our industrial waste business has rebounded nicely. Recycling is doing fantastic. Residential obviously has been strong since the pandemic began. As far as what do you do with those masks, I'm not sure we have a good solution for recycling those masks, because they're not really a recyclable material at this point. So a lot of them do show up in the trash bin, as do a lot of those at-home test kits. And for the most part, those are not recyclable today. Not to say they won't be, though, going forward.
You know, Jim, a couple of years ago, you and I were talking about China and our trash. At the time, there was a trade war that President Trump had sparked, and China was not going to take our recyclables, not going to take our trash anymore. Do you have any indication that that might change in the future? And if not, how did you have to pivot your business to account for that?
So you're right. It's been about 3 or 4 years that China almost overnight decided they weren't going to take recycled material coming from the United States. So a lot of those processors of that material have actually moved stateside to the U.S. So we're producing a lot of material that now, instead of putting it on a container ship to go overseas, stays in the U.S. And that actually has been a good thing in terms of reducing greenhouse gas emissions and transportation costs and the like. So it's actually been a good transition. It happened fast, and we had to be able to pivot quickly.
Jim, really quickly, great earnings results last week, a $2.3 billion return to shareholders. How do you continue that momentum, particularly tied to costs and margins? And then you've also labeled yourself an employer of choice, but now starting to automate more. And I'm wondering what that does to jobs and attrition.
we're still an employer of choice, and we like our position. We do a lot to try and make us the best employer out there. We just introduced a plan where we're paying for college for dependents, which I think is unique. I know a lot of companies pay for their employees to go to college. We're paying not only for the employee, but also for their dependents. So I think we are still a strong employer of choice. Earnings were good. We're excited about 22. It looks to be a bit quieter year than 21 and 20, which is a good thing. We are going to be making significant investments in those things that I mentioned early on in our conversation: renewable energy, rebuilding our recycle plants. All of those have really strong returns for shareholders. We're excited about the next 3 to 5 years.
Okay, Jim Fish, WMCO. We will leave it there. Have fun out there.
All right, coming up next, why more women and people of color are being left out of the Millionaires Club. Welcome back, everybody. According to the latest figures, 85% of the world's millionaires are men, and the racial wealth gap isn't much better. 1 in 7 white families in the U.S. have a net worth of $1 million or more, but only 1 in 50 black families do. Here to talk about it is Rachel Rogers, CEO of Hello 7 and author of the book Why We Should All Be Millionaires. Hi, Rachel. Thanks so much for being here. Lots to dig into, but overall, just in a broad sense, talk to us about what is holding back women, particularly women of color. What's holding them back from earning more and joining that Millionaires Club?
Yes. Well, I mean, unfortunately, we live in a society that has historically and systemically marginalized women, and Black women most of all, women of color. Women of color still make as low as 54 cents on what a white man will earn, what $1 a white man will earn. And so when we live in a society where there is so much marginalization built into universities, banks, when applying for credit cards and debt, corporations, obviously we're getting it from all sides, sexism and racism at play. And then on top of that, we internalize those messages, which turns out to be imposter syndrome. And so we start to believe that we're not good with money, or we start to believe that we can't earn more. And we're told, cut coupons and stop buying lattes, when that's not really the true path to building wealth.
So let's talk about that true path. And you brought along some ways that not just women, really all people can start to build wealth. The first thing you talk about is setting boundaries. And this is a particularly important one, I think, for women.
Absolutely. I mean, studies show still today women are doing the vast majority of the domestic labor in our households, right? And so those dishes go to us. All of the emails from our kids' school, it's us, right? And so, you know, in order to make money, we need time, right? We need time to think of those money-making ideas, to pursue those different opportunities. And so we need to set boundaries and say, listen, you're going to share in this labor. I am not doing all of the work, okay? So we need to set a boundary and really protect our time, both in the workplace too, because we don't always have to be the one ordering Chad's cake for his birthday party, right? I feel like all of that sort of domestic type labor, even in corporations, winds up falling to women. So we just need to put some strong boundaries in place to start. And that is the first step that we can take. And then we need to think about how much money do we actually want to be making, right? We think like, oh, I get a finite paycheck. I've got to rely on that paycheck and think about all the ways that I can sort of divide it up. And instead, I want us to think about how much more could we earn, right? What do we actually want, right? Do we want to send our kids to private school? Do we want to be able to put $1,000 a month in the stock market? What are those costs that would really be huge lifestyle changes for us, or things that matter to us that we want to be able to invest in, and figure that out? So if you're someone who's, let's say, making $5,000 a month, but you want to be making 10, well, that's a $5,000 a month gap. That is not insurmountable. Let's start getting our brainstorming going and thinking of ways that we could earn another $5,000 a month. I think these things are in reach for us, but we think that they aren't, right? And so the last thing I would say is then, you know, once you're brainstorming those money-making ideas, think about the skills that you have in your current job, right? So what are you good at? Could you do consulting? Could you build a side business like many of my clients have done to, you know, increase their income significantly? There are so many ways that we could take the skills that we have and turn that into additional money. And so, you know, brainstorming those things, taking some of those assessments like StrengthsFinders or DISC to figure out what are we good at and how could we sell those skills. And then lastly, get a cheer squad to really support you. Studies, and this is very old research, shows that 95% of our success or failure in any endeavor has a lot to do with who we are surrounded by. So if you're surrounded by other ambitious women, other ambitious people who are out there getting after it, you're going to increase your network, right? You're going to increase your opportunities. You share opportunities with each other. You share ideas with each other, and that helps us all go farther.
Yeah, I know. I like that idea of building your squad, because who you surround yourself with can sometimes determine your success or your failure. What about people who like the industry they're in, like what they're doing, but want to be able to earn more? What should the messaging be, you know, when they have those annual compensation talks with their boss?
Yeah, well, I'm a boss, right? I have 27 employees currently. And when I have these conversations, and I tell my own team, right? Tell me, you know, I know as a boss, what I'm thinking about is the needs of the business. How can we, you know, increase the profitability of the business, increase the longevity, increase the results that we're getting, right? There are certain metrics that I'm trying to hit as a business owner. And so when my employees say, hey, I can help you increase those metrics. Here's how I add value. Here's what additional I could take on, or here's this additional role that I could take on and how that would serve, or here's how I'm adding value already that maybe you don't see. Let me put it in numbers for you. With that kind of presentation, it's hard to argue with that. And then come with your outside data and evidence as well, but come with some internal data and really appeal to your boss and what they care about, so that you can sort of match what you care about, which is how much you're getting paid, with what they care about. And definitely always negotiate. Sometimes we just don't even ask, and we absolutely should.
And we leave money on the table. All right, Rachel Rogers, CEO of Hello7, some good tips you brought along. Thanks so much. Karina?
Yep, good advice there. Okay, we're going to take a quick break, but on the other side of it, Joe Rogan and the latest on that Spotify controversy. Stick with us. Welcome back to Yahoo Finance. Well, Joe Rogan back in the news once again over the weekend, this time getting in hot water over a video of him using racial slurs surfaced. Here with more, let's bring in Yahoo Finance's Dan Howley. And Dan, to be clear, these slurs aren't from now. They came from, past times that he's made these comments. And the CEO did condemn them, but he says he won't silence Rogan.
That's right, Karina. These are older podcasts. About 70 of the Joe Rogan Experience podcast episodes have now been pulled from Spotify. And as you said, this comes as we're seeing more controversy. Artist India Ari had posted a video, a compilation of Rogan using racial slurs throughout his prior podcasts. And he had referenced a movie in particular, about an experience he had going into a predominantly African-American neighborhood. And so, it really is compounding issues here. And so Daniel Ek, the CEO at Spotify, did make comment on exactly what they're kind of doing as far as Joe Rogan goes, but said that they shouldn't fully take him off the platform. They said, "I do not believe that silencing Joe is the answer. We should have clear lines around content and take action when they are crossed, but canceling voices is a slippery slope." And then this comes after, obviously, the COVID issues that we had seen with the Joe Rogan Experience, basically having people on that cast doubt on the use of masks or vaccines. And so Spotify had to go ahead and put a label on some of those episodes, basically saying that they have COVID information in them or they have COVID at a discussed topic, and then a link that points to kind of a hub for all of the correct COVID information out there. And so, now we're starting to see this pushback from artists against not just the COVID issue, but the content of some of his previous podcasts, specifically around those racial slurs. And Joe Rogan has come forward and apologized for the second time in this controversy now.
But, Dan, despite all that, you've got the online video platform Rumble, I think it's based in Canada, coming out in support of Rogan and actually offering him some big bucks very publicly to jump ship.
Right, that's right. We have Rumble. They're very popular with conservatives. And the CEO there, Chris Pavlovsky, had written a tweet essentially to Joe Rogan and the Joe Rogan Experience. And he says, how about you bring all of your shows to Rumble, both old and new, with no censorship for $100 million over 4 years. And obviously, that's in reference to the $100 million that Spotify paid to make the Joe Rogan Experience an exclusive there. Now, it's worth pointing out that Rumble is linked to former President Trump's social media platform, Truth. Basically, they're going to be carrying the video element of Truth Social. So this is now kind of bringing people out of the woodwork who are trying to kind of drum up PR for their site. Obviously, that's what Rumble's trying to do. Whether or not they actually make a serious offer, remains to be seen. But this doesn't seem like it's going to go anywhere anytime soon. And as I said previously, if we see any major artists, major current artists come out against Joe Rogan saying that they would pull their catalog or from the platform, that could really start to impact Spotify on a deeper level than just bad PR right now.
Okay, we will leave it there, Dan Howley. I doubt that it's the last time we've heard on this story. Thank you so much. Alexis?
All right, thanks a lot. I want to get another check of the markets here because we are sort of drifting higher, at least the Dow and the S&P. Actually, the Dow finding some nice strength now, up 96, 97 points. The S&P 500 in the green by just 2, but the Nasdaq trying to find its footing, off about 3 points. We've seen stocks sort of oscillate between modest gains and losses all day long. Wanted to get a quick check of some of the winners there for the Dow, what's leading to some of the strength we're seeing today. And that would be Boeing, also energy, hot for another day here in the markets. We've got Chevron leading the advance there, Walgreen Boots Alliance, Honeywell, and American Express, all those stocks leading to some strength there for the Dow Jones Industrial Average. We've got lots more to come here on Yahoo Finance Live. Is a bidding war brewing for the troubled exercise equipment company Peloton? And also Congresswoman Nancy Mace is here to talk 5G, her new cannabis bill, and a whole lot more. So don't go away.
The ride isn't over for discussions over the rollout of 5G tied to the aviation industry and regulations tied to autonomous vehicles still up in the air. We speak with Congresswoman Nancy Mace about those issues and a push for cannabis reform. We also speak with the CEO of a global leader in industrial automation and digital transformation for his take on how the company is making a push for sustainability. And pedal to the metal, Peloton shares surge on reports there may be interest in a takeover deal from a couple of big-name suitors. Hello, everyone. I'm Karina Mitchell, along with Alexis Christoforous, taking a little bit of a breather in the equity markets. Equity is trading in a smaller range today ahead of a blockbuster week for earnings. Here with a look at some of what's moving markets, let's bring in Yahoo Finance's Jared Blickery. Jared, the Dow is getting a nice little bounce, and another stock getting a bounce is Hasbro, seeing a rise after strong earnings tied to consumer and entertainment growth.
That's right. Pretty decent earnings here. You can see the stock is up about 83 basis points right here. And let's actually try to find Hasbro if we can in our trending tickers. I do have some notes about it. However, they are facing some margin pressure, and they are going to be rising their prices. They say that is going to take effect in the second quarter. And they're also saying that they're going to see cost pressures continuing throughout 2022. So let's see if I can find Hasbro here. It was one of our trending tickers earlier, and unfortunately it doesn't look like we have this particular company on our heat map here. So the stock, well, I'd love to describe it, guys, but it looks as though we're going to have to move on to the next one.
Okay, no worries, because there's always a next one, Jared. And I know that SoftBank may be getting ready to sell some or all of its massive stake in the Chinese tech giant Alibaba. Tell us why analysts think that might be the case.
That's right. So Alibaba has shares that trade domestically. They also have what's called ADS, or American Depositary Shares. Sometimes they're called American Depositary Receipts. Those are trading in the U.S. on an 8-for-1 basis. So if you own one ADS of Alibaba that you bought on a U.S. exchange, you're going to actually own 8 shares of the underlying. Now, why this is important, they have registered over $1 billion worth of shares so that insiders, potentially insiders, could sell. And really the only reason for that would be, in fact, if insiders like Masayoshi Son's SoftBank would want to sell. So we have the stock down 5% today. We've been tracking the woes with the Chinese tech sector over the last year, a lot of heavy-handed regulation. And this may be one of the final acts here. If, in fact, Alibaba is going to be relisted domestically and the listing is going to be removed eventually from the U.S., this would be part of that. Also, Son may be facing a lot of internal pressure. A lot of his other holdings are down right now, Didi, DoorDash, and a host of others. So a lot of pressure there, probably going to see some more forced selling in the future. However, with a stock this depressed, you also have to look out for potential short squeeze. And given the price action, it could be substantial.
Okay, and Jared, let's finish on a sweet note. The Yahoo Finance Plus investment idea of the day is a bullish call on Hershey after recently beating on fourth quarter results. And we're almost at Valentine's Day. National Retail Federation expects a big bump up this year in candy sales.
Exactly. Let's take a look at Hershey Co. And I got some commentary by Argus Research. They've issued a report. Hershey's is facing record demand for its products. It cannot keep up with that demand. And we'll see what Argus Research has to say here. First, let's pull up a chart and we can see it is up 85 basis points today. And let's get some commentary here. Here we go, finally. They are upgrading to buy with a $224 price target. And they're saying Hershey shares have outperformed over the past quarter, gaining 17% compared to a 1% decline for the S&P 500 and a 9% gain for the industry. So pretty big outperformance there by this food stock. Hershey recently reported fourth quarter results that topped expectations. And on a technical basis, the shares are in a bullish pattern of higher highs and higher lows. That dates to the pandemic sell-off in March of 2020. Valuations are at the high end of the normal range, though we believe that higher multiples are warranted based on the company's growth outlook and performance history. And let's take a look at its pandemic performance. Here's a 2-year chart, going to go back to the beginning of 2020. And you can see there, after we put in this low, I believe that would be March of 2020, pretty much from the lower left to the upper right ever since then. Also want to note, this is a record high. This is a company that has been posting many, many record highs recently.
All right, we will leave it there. Jared Blickery, we will see you back a little bit later on oil, but let's stay on markets right now and bring in our guest, Debbie Boyd, DLB Financial Services CEO. Debbie, thanks so much for being here. I want to start by reminding you the last time you were on with us and spoke to us in October, you had a quote, and I want to tell you what it is. You said, did we think it would stay this low forever? I think people are in denial about how the markets work, talking about rate hikes, of course. So do you think the denial is now over? Markets pricing in between 5, maybe even 6 rate hikes to come. Investors are getting whiplash between all the analysts, between bearish and bullish calls. Where do you stand?
Well, I'm a mortgage broker by trade, so I do believe the Fed is going to raise rates. We've already seen almost a point raise since the end of December. So I've got people buying homes that when they first came to me and they were just, quote, looking, I was giving them rates in the 3.5 range. Well, now that's pushing 4. It's been up, it's been down. This is the new normal. And what I think people need to figure out is that things aren't going back down. We're very happy that our homes have gained all this equity in the last year. And that means that property taxes are going up. That also means that interest rates can handle it. There is a demand. So we have to quit thinking this is a bubble and just start thinking that this is it now. This is the real thing.
So do you think that we see as many as 5 or 6 rate hikes, or do you think that inflation does come under control at some point during the year and maybe the Fed doesn't need to be as hawkish and will, step back?
I wish everybody would just leave the market to do what the market does, but that's not the case. So I think we're going to have 3, maybe 4 hikes this year. Doesn't mean they're all going to be huge, but even 1/8 of a point or 1/4 of a point does trickle down through the markets, and it makes everybody nervous. Now, is that going to slow down housing? No, because if you need a new house, you're going to go buy a house. If you're moving across the country and have to relocate, you're going to be buying a house. It doesn't matter what the price is. We are used to now historically low interest rates. I remember when I got a 5.5 rate several years ago, like 10 years ago, and that was a great rate. So it's all in what we're used to. We've forgotten that rates were higher than 2% at one time.
Yeah, you're exactly right there. I want to turn your attention to then how should investors be positioning themselves right now in an environment where, tightening policy, we're seeing these rate hikes, volatility is still there. Is it a time to sort of sit back and remember cash is king and maybe sit out a little bit for things to calm down a little bit? Or is it the right time to sort of jump in selectively? And if so, where do you suggest looking?
There are still going to be homes available to buy, and people are still going to need to move. So whether people get priced out of the market and they need a rental property, now's a great time to buy. Interest rates are as low as they're going to go. They're not going back down. So if you want to get into the rental market, now's a great time. It's just like when you need to buy a car, you buy a car. If yours is dead, you need a new one. It doesn't matter what the interest rates are. You're going to get the best deal you can. So investors, yes, and now's a great time to buy property. Values are up, but they're going to stay up. That's what we wanted. So you're going to be buying a little bit more expensive with a little more expensive money, but it's not going to get cheaper. So if this is the market you want to get in, you need to get in now.
And then earnings, blockbuster earnings coming out this week. We're going to see Coca-Cola, Pepsi-Cola, Chipotle tomorrow. Kellogg's as well goes right to the heart of the consumer and inflation. What are you most concerned about? What are you looking for as earnings do come out?
Well, I do think that we have to think about how we spend money and what we buy. So when a family starts to tighten their belt, they're going to buy food, but are they going to be going out for food? That's going to be the question. And if so, what kind of food are they going to buy? They're going to buy cost-effective food. So if Chipotle is still going to be easy to order online, it's very convenient. There is a demographic that is going to keep buying that. As families see the cost of everything go up, housing, gas, We're going to see not a lot of job pay increases, and we're going to see inflation go up with your groceries. People are going to clamp down. So are they going to be going out as much? Probably no. And then I think it's good news for the streaming services, Disney Plus, Netflix. People are going to be staying home more than going out. You know, ticket prices at theaters are also going up. So you just have to think of what is the most cost-effective way. If I'm a family and spending money, where can I get my best bang for the buck? And those are going to be the stocks to look for.
And then as far as sectors that you like, I know the last time you came on, you were quite bullish on airlines back in October. Do you still feel that way? What about financials? And you said you like energy as well.
Sure. So when we talk about airlines, you know, there's a big merger coming on with Frontier and Spirit. I think a lot of companies, we talked before in the last break about Peloton's going to be maybe looked at by some different suitors. Now is the time for a lot of companies to, I guess, re-transform themselves into something else that they think is going to be advantageous moving forward. So yes, airlines, we're still going to airline travel, but is this good for consumers? Sure. If we can get reliable air carriers at an affordable price with some options, it's going to be a great thing for consumers. So I'm looking at it like that. Energy prices are going to go up. Food prices are going to go up. So we just have to be prepared for that. I know the orange market had a tough time in Florida this year. Orange juice is going to be super expensive. So you're going to see consumers looking at different products just to fill the gap in their grocery budget.
And then finally, what do you think about big tech as a sector to invest in now? Because the Nasdaq is down more than 13%, almost 14% from a recent peak. So is this the time to sort of go through and cherry pick, or do you stay away from those growth names for right now, at least?
I am going to invest in tech because, as you see, people are changing jobs and they're going to jobs that are tech heavy. So am I really in the mortgage business, or am I in the technology business of getting your loan done as quick as possible? So tech helps me. If tech helps your company, which it helps almost every company right now, you've got to be invested in tech. I think it's always a good idea.
All right, we will leave it there. Thank you so much for all that insight and perspective. Debbie Boyd, DLB Financial Services CEO. Alexis?
All right, thanks so much. Coming up on the other side of the break, lawmakers hear from the airline industry about their concerns over 5G interference. Congresswoman Nancy Mace will join us next to talk about that and much more. Welcome back. The head of the FAA made his case last week before Congress on just why 5G technology, as it stands today, poses a threat to airplane safety. Congresswoman Nancy Mace of South Carolina was at that hearing, and she joins us now. Congresswoman Mace, thanks so much for making time for us today. I know the FAA Chief Steve Dickson said at that hearing, quote, "We're changing the oil on the engine as the airplanes are flying when it comes to dealing with the dynamic nature of 5G development." I was wondering, what did you think of that when you heard that, and how did we get to this point?
Well, it's sort of crazy, right? We know that American airplanes can handle 5G because they already do. Their altimeters already do in 40 different countries. Crazier than that, the FCC has already approved and given the nod to this technology. So the FAA actually should be working double time to make this a reality.
And Congresswoman, I want to turn your attention to the autonomous vehicle space. It has been so hard for federal regulation to come together, and all of the stakeholders are on a different side of the debate, right? So AV makers have pumped billions into the industry, and now they're facing pressure for return on their investment. Lobbyists say the cars are safe. Unions say that companies are cutting corners and cars shouldn't be put on public roads till they've gone through stringent testing as well. So it's a little bit like the Wild West. People are all over the place on different sides. What are the major concerns, and what do you think is causing such a stall?
Well, I think having the due diligence, having this conversation now is great. I wish it had happened a couple of years ago. This kind of technology is innovative. It's moving quickly. And we're seeing it in every major city across the country, seeing vehicles that have greater autonomy than before. And so safety is obviously top of mind, but it just goes back to the bureaucracy of the US government, how slow we are. We're more reactive than proactive when it comes to innovation and technology. And that really can hinder development. It can hinder investment and resources in companies here in the US as well. We need to be ahead of the curve, not behind it on this kind of technology, but we've got to move gracefully and got to move together. And you've got to look at why each different group is advocating for one position or another, right? More autonomous vehicles means fewer people needed in the transportation space and the industry, and we get that. That's why unions would be against it, right? On the other hand, you've got lobbyists that want to protect interests in the industry, and so there's got to be a balance there between safety and innovation, and we've got to get the government, make sure the government doesn't get in the way of that innovation and those investments and those resources as well.
And then just a follow up to that, you know, the FAA has the authority to review the technology that goes into aircraft before they start flying. But car manufacturers are basically free to certify themselves over a particular feature. And it's only if something happens that then there's closer scrutiny. So, for example, Tesla has undergone multiple investigations in the news today, again, for its full self-service driving vehicles, caught on camera crashing into a pole. So is it viable that there are 50 different laws in 50 different states? How safe is that?
I will tell you, Tesla, we do know, they take safety seriously. And I have friends that own Tesla vehicles and they put out beta software. I mean, the market's going to kill a vehicle manufacturer if they're having those kinds of accidents frequently. So I would imagine anyone in this space isn't going to want to have accidents on the road because that's going to hurt their market share. That's going to hurt their branding. And so the safer they are, the more they will sell those vehicles. And so I do know from personal experience and seeing friends that own Teslas that Tesla does take that seriously. And they'll often put technology out first to a handful of users and see how it goes and test it out that way. And so safety's got to be paramount when we're talking about this kind of technology as well. But also, you know, the burdensome of regulations that we have, we can't over-regulate so that there is no innovation. I was just in Taiwan in November and saw fully autonomous buses. I actually rode on one. I'd never seen that kind of technology here in the US and was overseas when I saw it the first time. And it was safely done, and it was fascinating, and it was innovative.
Congresswoman, I just want to switch gears and talk a little bit about cannabis legislation, which I know you have been working on, and you've spoken very courageously about your personal experience with marijuana, detailing how it helped you through the trauma of sexual assault when you were in high school. With the States Reform Act, you say you want to treat cannabis like alcohol instead of heroin. How so? And do you think that lawmakers are committed to giving you a hearing on this?
Well, for starters, the States Reform Act would regulate cannabis like alcohol, as you mentioned. It would deschedule it, taking it off of Schedule 1, which puts marijuana or cannabis on par with heroin. It should never be. You want to take it off Schedule 1 so you can study it for medical purposes. We need to respect the laws of every state. So in my home state of South Carolina, we have CBD and hemp. Florida has medical. California has adult recreational use. And so the States Reform Act would permit all those things to being legal. It would get the federal government out of the way. It would operate like alcohol, very low federal excise tax, and provide a framework for what's legal and what's already happening in 47 of 50 states. And so we haven't done enough on this issue. We have tried to do safe banking. It sounds like we might try it again for a 7th time. But the definition of insanity is doing something over and over and over again and having the same result. So it's time to do something different. And this is a comprehensive bill. It's got something for Democrats and Republicans alike. It's endorsed by groups on both sides of the aisle, from NORML to Americans for Prosperity to veterans groups to law enforcement groups. It has expungement and release for nonviolent criminals in there as well. It's got something for everyone on both sides of the aisle. And so it's time for us to try something different now.
Speaking of doing something over and over again and getting the same result, I know the Safe Banking Act passed the House for a 6th time last week. Looks like it still faces an uncertain fate in the Senate. And of course, this bill would allow marijuana businesses to utilize the banking system and not have them be so dependent on a mostly cash only basis. Where do you stand on that act, that Safe Banking Act, and why do you think it hasn't been able to move through the Senate?
I'm fully supportive of it. And it sounds like the House, we might actually tack on another bill to safe banking and do it a 7th time. For whatever reason, it can't get movement. Schumer, can't get it through the Senate. I don't know why. This is something that Democrats campaigned on. This is something the vast majority of Republicans, even in the House chamber, they support safe banking. It should be easy to get it done, but it's not, which is why we need to go back to the drawing board, figure out what's missing with safe banking and make it work, which is why I believe the States Reform Act is a great option. It's literally once we get through safe banking again, and maybe we'll do more, and maybe Schumer will do his version of the bill, we're not going to be left with anything that can pass. And we've got to be able to work together, Republicans and Democrats alike, to make this vision a reality. And it's far past time that we do it. It's a wildly popular idea. 70 to 90% of all Americans, depending on how you're polling it, want to see cannabis reform at the federal level in one shape or another. And it's far past time we've been doing this. California has had some form of cannabis legal for over 2 decades now. And so it's time to tax it, regulate it, let states do what they've already been doing, which is a very Republican idea, but we can work on it together as Democrats and Republicans alike.
Congresswoman, more broadly, midterms are around the corner. Inflation is high. Country is still split over COVID policies and masking. How much on defense are the Democrats at this point?
Very much so on defense. And I do believe there will be a sweep later this year with Republicans getting the majority. The only question really is how broad will that majority be? Is it going to be a mandate pushing back on the Biden administration, or is it going to be more of a consensus building time from 22 to 24? Because the November election in 2020 really should have been about consensus. The House had a very slim majority. The Senate is split 50-50. This should have been a time over the last year and a half for us to work together, because that was the mandate from the American people. So we'll see. It'll be sweeping, but the only question is how broad will it be? And I feel very good about my chances. I feel very good about every swing district in the country right now going into Republican hands or staying there in the 22 cycle.
All right, Congresswoman Nancy Mace of South Carolina, thanks for stopping by the show today. We appreciate it. And coming up next, New Jersey moves to end mask requirements in schools, but is it the right time? Our health reporter joins us to help answer that question next. With new COVID cases on the decline now in many parts of the country, is it the time to start lifting some COVID restrictions? Our health reporter, Anjali Kamlani, here now with what we should expect. And Anjali, we already see that the governor of New Jersey says he's going to lift those mask mandates for kids in schools starting March 7th. It's a pretty controversial move.
Right. So we heard that from Governor Phil Murphy today, following in the footsteps of Pennsylvania's governor just last month. And we also know that Delaware is making similar moves, as well as, again, across the Northeast and Mid-Atlantic. That partnership that has sort of existed throughout the pandemic is taking force here. And we see that that's sort of the trend that they're looking at when it comes to especially those new cases, hospitalizations generally down across this area, and generally speaking, good vaccination rates. So that all blends in to why the governor is setting that lifting of mask mandates for March 7th. So just a month from now, and extending the public health emergency until then. His reasoning also for March was very specific. Here's what he had to say about that.
Early March traditionally means the weather starts to warm up at least a bit, and Pat, you'll make sure that that happens, which will give schools a little bit more flexibility to increase ventilation, be more creative with that, and further decrease the risk of COVID spread. And perhaps most importantly, this is a huge step back to normalcy for our kids.
So as you can hear, a lot going on when it comes to looking at that return to schools, return to normal, return to office, and that sort of conversation that we've been hearing about, quite honestly, in the past few weeks. And this seems to be sort of where that is coming from. And specifically on that point about ventilation, that is key to this, because we know that that is sort of why we see these winter surges as more people are indoors. Poorer ventilation allows for an airborne virus to then circulate a lot faster. Back to you.
Okay, and then New York as well, looking to reduce their mask mandate coming up in several weeks or months as well. Andre, I want to ask you just really quickly, where are we as far as cases and hospitalizations? Are we turning a corner? I know deaths just hit 900,000.
Well, we are seeing that, right? All the numbers seem to be pointing in the right direction. And a lot of experts, including, the governor earlier, pointing to that as sort of a cautionary optimism there, with cases down, hospitalizations coming down in some parts of the country. There are still some hospitals that, while ICUs are freeing up, hospital admissions aren't necessarily letting up. And we continue to see a pretty high daily death rate, so about 2,600 on average per day. That's still pretty high, even though it is not, the highest that we've ever seen. And so that has really kept people concerned, especially also, as we know, there's that subvariant sort of lurking in the background. So maybe within the next month or so, we'll see, previous estimates were that we would peak mid-February with the current variant. As it stands right now, definitely looking to see the tail end of this surge. But of course, the rest of 2022 still await.
And I'm just wondering if, with everybody having such COVID fatigue, what the numbers are now on vaccinations, but also on booster shots, because we know that in many parts of the country, even people who were fully vaccinated with 2 doses had not yet gone for that 3rd dose.
That's still lagging, and that is sort of where some of the concern comes from, not just here in the U.S. with boosters, but also globally, of course, still not getting to those first doses. It all is part of the same story when you look at the outlook for the virus, here in the U.S. and its, future impact. And this also plays a role, quite honestly, in what we're looking at for kids. And that's sort of where the controversy comes from also for the school debate, which is we see that there is a small number of kids vaccinated already for those that are eligible. And we're still looking to bring on board, of course, that under 5, that meeting next week with the FDA to kind of set the tone for whether or not under 5-year-old will be eligible. So all of this put together is really the part that's straining. So while we have seen, slow gains, it seems like generally speaking, the U.S. has sort of plateaued on these numbers, and that is playing a role in moving forward.
All right, Anjali Kamlani, thanks so much for wrapping that up for us. Karina?
Okay, we're going to take a quick break, but we will check in on the energy sector amid rising gas prices and take a look at how crude settled. Stay with us. Welcome back. Well, oil just came off their ultra highs after positive signs on U.S.-Iran talks that could lead to the removal of Iranian sanctions. That's offsetting concerns over some of the tight supplies. With more on how crude settled, let's bring in Jared Blickery. Still, Jared, oil closed above $90 a barrel.
I think that's the point here, and we have seen nothing but gains for the most part on net over this year. And WTI crude futures for March delivery, they just settled at $91.32 per barrel, still trading the electronic market. And you can see basically down but choppy sideways trading action most of the morning once those lows were made after midnight. Now let's take a longer term view here. Here's a 3-month view, and we can see it's up 11% over that time period, but much more from this December low. So nothing really holding back crude oil from further gains. And I'll tell you what, also in the energy market, natural gas down 7%. This is a 3-month look, and let's take a look at the candlesticks here. Here is that huge, that was the biggest gain ever for natural gas. That was on contract expiration, but you can see the volatility here just kind of coming down. And on a levered basis over this many days, this is an incredible volatility for this particular contract. And I also want to check out the energy market, some energy stocks, because when there's nothing else to buy, it looks like everybody wants to buy the outperformer of the year. That would be energy. Exxon, that's up over 1.8%. Chevron is up almost 2.5%. And look at this, Schlumberger up 4%. And let's just take a year-to-date view, and we can see some incredible gains here. 35% up for ExxonMobil this year alone.
Okay, Jared Blickery, thank you so much for that report. We'll keep it on the energy sector and bring in our next guest because oil did come off its highs recently. So let's bring in Patrick DeHaan, Gas Buddy, Head of Petroleum Analysis. Patrick, for a 6th straight week, gas prices continue to rise. The national average now about $3.42 a gallon, according to Gas Buddy. How high do gas prices go? President Biden wants them to come down. It's a midterm election year.
Well, certainly President Biden's going to have difficulty bringing them down at all, especially in light of the Russia-Ukraine conflict and protests in Kazakhstan and unrest in Libya and terrorist attacks in the UAE. I see nothing but gas prices going upward, especially as we get closer to the start of the summer driving season. Refiners will be switching back to more expensive summer gasoline, adding into an increase in demand as the temperatures start to warm. So if nothing else, geopolitical tensions and normal seasonal trends push gas prices up more significantly starting in March and lasting through Memorial Day, when the national average could reach that $4 mark.
So we've seen energy prices skyrocket, right? Up 17% just last month. Where do you see crude headed by the summer? And what are some of the upward pressures?
Well, we've obviously seen crude oil prices continue to rally as fears of the Omicron variant have subsided. And I think the upward direction is the only way we go. I think eventually we will hit that $100 barrel for WTI. That's something that could happen as early as March, and we could head to 110 or even 120. A lot of it really holds, a lot of the cards really held by Russia right now. Will they invade Ukraine? Will they use oil as a weapon? A lot is being said about talks as well, the Western powers with Iran. So something could come of that, but I think we're going to be on the doorstep of triple-digit oil here shortly.
What does happen if we start imposing sanctions on Russia? How are our markets impacted? I know Europe has close ties, so will they be more largely impacted? What do we feel here?
Well, I think the risk is that that Putin will potentially use oil as a weapon, as he has used natural gas as a weapon. Gazprom really limiting shipments of natural gas to Europe, likely in response to a tit for tat over the Nord Stream 2 pipeline that Germany is waiting to approve. So I think that's the risk here, is that you just really don't know how Putin is going to react. If the U.S. does issue sanctions, it certainly could curtail exports temporarily to inflict more harm on the global economy.
And then what can you tell us as far as inventory that's on hand right now and SPR?
Well, the SPR continues to decline. Of course, President Biden had released crude oil from it. It's not really having any effect at all, as was expected. A 50 million barrel release is really just a very small amount. It's about 2.5 days of U.S. oil consumption. And for the first time in quite some time, U.S. total commercial petroleum inventories could fall under 1 billion barrels. Now, I know that sounds like a huge amount, but in the grand scheme of things, this is very much hand to mouth and doesn't represent a whole lot of crude oil. So, and that's a sizable psychological barrier for U.S. oil inventories to fall under that billion barrel mark, but that's possible in the months ahead. All of this fueling oil prices to the sky.
And the natural gas prices are, a popular way to heat homes. We're just coming through a cold spell in the Northeast. What do you see as far as natural gas prices? I know Jared just said that the prices are a little bit lower coming off some of that volatility, but what do you see in the year ahead?
Well, certainly more volatility. Now we've gotten a break over in Europe where weather tends to be, or has tended to be, a little bit warmer than average. So the crunch there has been alleviated by Mother Nature, but look for this imbalance between supply and demand that has hit so many areas of the economy, crude oil, natural gas. That will likely continue. I don't think gas prices, natural gas prices, that is, will fall back to the $3 range commonly until potentially the summer. But, next winter, it could be another story of $4 or $5 natural gas, depending on the whole Russia situation.
And then, Patrick, inflation is climbing higher. We get another CPI read this week. Already we hear that some people are trying to, minimize the amount of trips that they make in the car just to sort of save a little bit on gas. What happens, do you think, to fuel demand as we go forward?
Well, it's been seasonally weak, which is not a surprise. North America is in the middle of a cold winter. We've had a couple of winter storms that have held back gasoline demand, but this is where we start to see demand launch up, is in the middle or later innings of February, and that's going to last all the way through Memorial Day. So we are just on the cusp of seeing gasoline demand start to rise seasonally. And of course, keep in mind that all of this winter gasoline that's flooded the market right now is going to be purged out for summer gasoline. And so inventories could be relatively tight, but demand is low now. I would expect that to change here probably in anywhere from 2 to 3 weeks' time.
And how does travel start impacting that as Omicron sort of starts to ease? People are thinking about getting on those flights, maybe taking longer distance trips as well. What happens there?
Well, we're kind of coming into this perfect storm, right? That Omicron cases are starting to decline and weather is going to start warming as we near spring. So it could be a double dose of an increase in demand. People have stayed maybe a little closer to home, not so much as we did in 2021, but combined with warmer weather, there could be a ripe scenario for a surge in gasoline demand, not only in the US, but keep in mind other countries, especially in Europe, where there have been tighter restrictions. New Zealand, Australia reopening their economies to tourists in the months ahead. That could start to boost at least jet fuel demand and pull the rest of the oil complex up with it.
All right. Well, in the grand scheme of things, oil prices and gas prices still relatively low compared to years ago. All right, we'll leave it there. Patrick Nahan, Gas Buddy, Head of Petroleum Analysis. Thanks so much for your time. Alexis.
All right, that is certainly true on those oil prices. Coming up next, the CEO of Rockwell Automation is here to break down their new sustainability report. We're back right after this. Welcome back. Fresh off a strong earnings report and raised guidance for the year, Rockwell Automation is out with its annual sustainability report. And here to break it down for us is Rockwell Automation's CEO, Blake Moret. Blake, good to have you on the show again, and thanks for stopping by. Look, I know you work with a lot of Fortune 500 companies, including just about every major auto manufacturer out there. How are you helping your clients use technology to reduce their environmental footprint?
Well, it's a fact that over 20% of greenhouse gas emissions come from industrial processes, from manufacturing, whether it's automobile production or clothing manufacturing. All of these things can benefit from the efficiency to make more with less, to have good visibility to what they're using so that they can balance the load. And that overall visibility leads to a lot of opportunity for huge advances in terms of being able to be good stewards of scarce resources.
So then tell us how you can have, because when I think of manufacturing, I don't necessarily think of, good for the environment. So how is carbon neutral manufacturing even possible?
Well, I'll start in our own backyard. Rockwell is a large manufacturer in our own right, and we've set goals to be emissions neutral by 2030 in terms of what we're doing in our own factories. And so when you look at, for instance, an automobile manufacturer, to look at the amount of electricity and natural gas and other inputs to their processes, typically they're not running as efficiently as they can. So we help them with the technology to be more efficient, to be able to identify new targets, to be able to reduce the amount of energy that they're using and still produce at a very high level.
Is there a particular, because you work with lots of companies in different industries, is there a particular industry out there that's sort of out in front when it comes to ESG impact?
I think all of the industries are recognizing that it's important for their own business plan, for their own P&L, but it's also important for their customer base, because we found, as our customers have, that this is important for the customers that they're selling to make sure that they have a plant and they have a continuous process of improvement. Automobile manufacturing is certainly one. Cement and steel production are traditional high energy users. Even oil and gas production has a huge opportunity to be more efficient and to be able to limit emissions.
You also, in this report, the sustainability report, you actually call out some customer success stories. I know First Solar was one of them. Can you share a couple of those with us and why they're so successful?
Sure. There's a few areas that we're targeting as we look at improving our customer sustainability. It's the use of energy as well as the creation of renewable sources of energy. And with First Solar, we're very proud to be participating in the production of two brand new photovoltaic cell plants, one in the US and one in India. It's also about water treatment and the transportation of water. The needs are only going up, and to be able to do that as effectively as possible to provide clean, safe water is important to everyone. And then waste, and being able to reduce waste either by reusing or recycling. That's a hugely important topic to many of our customers.
And lastly, I just want to touch on earnings. You had a great earnings report recently. You said orders rose more than 40% over the prior year to $2.5 billion. Share with us what your guidance is for this year as well, and where are you seeing the most momentum coming from?
Yeah, so organically, we're guiding to over 15% growth in the fiscal year. And it's really a combination of, first of all, automation is becoming more important to customers in a variety of industries, in part due to the ability to increase sustainability. It's about the position in the cycle, because we do believe that we're in the early stage of a period of economic expansion. And then finally, it's about Rockwell's unique position in this industry.
I want to get back to something else in the report, and that is sort of framing cybersecurity as a sustainability tenet? I mean, that's a little bit unusual. Tell us why you're doing that and how you're doing that.
Yeah, so think about sustainability and cybersecurity as aspects of resilience, being able to do what you're doing as a manufacturer and to keep doing it with minimal disruption, because things happen when disruptions occur. You're in a more unsafe situation, you're not as efficient. And so when you think about being more resilient through cybersecurity, you can continue to operate these processes with a minimal amount of volatility. And so in that way, it's similar to being good stewards of energy inputs and being more sustainable.
All right, Blake Moret, CEO of Rockwell Automation. Thanks so much for being with us. Karina, back over to you.
Yep. Okay. Coming up, reports suggest Peloton could be poised for a potential takeover. Who are the players and why would it make sense? More on that ahead. Welcome back. Well, potential takeover talks sent Peloton stock soaring today. Here with more details is our Yahoo Finance's Inez Ferre. And Inez, activist firm Blackwell's Capital has urged a sale, but is it just talk or could it actually happen?
Well, certainly the conditions may be ripe for that, given the share price right now. I mean, Peloton is down about 80% from its all-time high about a year ago. So you're looking at that. And also, of course, the issues that Peloton has faced, execution issues, demand not being perhaps where the company had thought it would be at, the company now slashing its costs, raising the price of its bike, whereas before it had lowered it to make up for demand. And then as you said, investor activist Blackwell's Capital demanding that Peloton's co-founder and CEO John Foley step down, also talking about potential suitors that could take over the company, that could acquire the company, including perhaps Apple, Nike. There's been reports also that Amazon may be interested in this company. And we spoke to Wedbush's Dan Ives, who said that Apple would be the best suitor here, that Apple Apple wouldn't want Amazon to take Peloton, and that Peloton could perhaps fit well into Apple's ecosystem, since Apple launched Fitness Plus during the pandemic to go with the iWatch. Take a listen.
It's all part of the ecosystem, because you look at Apple Watch, you look at the subscription, that's a big focus in terms of how they're really going to build this into a significant business over the coming years. And, I guess some would say, well, Apple could just do it themselves. I mean, why would they have to buy Peloton? I mean, Peloton has a unique technology, unique brand. And I think right now they've sort of hit a brick wall of growth. I think if you look at Fitbit, GoPro, and we'll call other successful consumer strategies at one point, their issue is that they never hit the bid. They never went into a broader ecosystem. So, of course, a lot of this rests on Foley in terms of on the Peloton side. But for Apple, I think it would be a coup if they ultimately bought this asset.
And Ives thinks that an acquisition could happen anywhere between $12 and $15 billion. And right now, Peloton is at north of $9 billion. That's a far cry, though, from the $50 billion market cap that it had reached last year.
Yeah, next week, Ines, we're going to have Lululemon CEO Calvin McDonald on. Definitely want to ask him. They have the mirror, of course, so definitely want to get his thoughts on Peloton. But I mean, regardless, could it turn out that nobody really wins here just because of the unique, I guess, stock structure that Peloton has?
Right. So it has that dual stock structure, which is Class A, which have a 1 vote, and Class B shares, which have 20 votes. And you've got John Foley and other insiders that have veto power over big decisions. So perhaps Cowen's analyst has said that perhaps they don't want to give up control so easily, give up the company so easily. So you have that hurdle. And also one other note that John Blackledge over at Cowen had noted is that for Amazon, this may not be the best fit, because Peloton is seen as a high ticket item and Amazon tends to sell to the masses. So perhaps it may not be the ideal fit for an Amazon.
Okay, well, investors definitely buying the rumor, the market cap jumping by $1 billion today from 8 to 9. All right, Yahoo Finance's Ines Ferrer, we'll leave it there. Alexis, over to you.
All right, thanks a lot. Quick check of the markets, everybody, because it looks like the three major indexes have quietly risen to their highest levels of this session, with the Dow up nearly 200 points now, and the broader market finally finding its footing and moving higher as well. That's going to do it for me, Alexis Christoforous and Karina Mitchell. Stay with us, though. We're going to take you through the closing bell in just a few minutes. Stay with us.
Stocks are extending gains after the S&P 500's best week of 2022 last week. Investors are looking ahead to another packed calendar of new economic reports and inflation data later this week, plus a bevy of corporate earnings results from the likes of Peloton, Disney, Uber, and Lyft, to name a few. We'll have team coverage of Take-Two Interactive's and Simon Property Group's quarterly reports after the bell today. And it's Merger Monday for the budget airlines. Frontier Group announced plans to merge with Spirit Airlines in a $6.6 billion deal that would create the fifth largest air carrier in the U.S. But will the regulators green light this tie-up? We'll discuss with Cowen Managing Director Helene Becker in a bit. Plus, Representative Ro Khanna of California stops by to discuss his new book, Dignity in a Digital Age. We'll discuss with the congressman how he thinks we should address America's digital divide and the latest on the legislative agenda out of Washington. We have an hour to go in today's trading day. I'm Emily McCormick.
And I'm Brad Smith. Great to be here with you on this Monday to kick off yet another trading week, Emily. And as we wrap up this final hour of trade, let's take a look at the major averages to begin here with about 59 minutes left in trade. You're taking a look at the Dow Jones Industrial Average, holding on to gains of about 0.5% in a move higher on the day, 165 points to the upside there. S&P 500, that's seeing gains too. That's up by about 0.2%. And then additionally joining in on the positive gains party here on the day, it's up by about 0.1%. It is the Nasdaq Composite, and it is up by a little more than 19 points, 20 points now. So with a little bit more on what's moving this particular session and what some of the pieces at play are, let's begin this final hour with a check of what some of those underlying elements are with Yahoo Finance's Jared Blickery. Jared, what are you seeing?
Well, I'm seeing a reversal of fortunes today. We began the day with the Nasdaq leading and the Dow underwater slightly. Here's the Dow, and you can see a lot of red, or a little bit of red towards the open and also the middle of the day. But now we have climbed and broken those previous session highs, and I'll show you the Nasdaq because kind of the opposite situation here. We can see it fell into the red after starting the day in the green. All of this, well, maybe not too much because in the grand scheme of things, we are talking about pretty low range here. This is a 2-month candlestick chart. This is today's price action, and you can see just about where we were on the open in the Nasdaq, which is still inside the prior day's range and Thursdays as well. So not a lot to get excited about here or fear. I mean, we had a pretty nasty reversal to the downside last Monday, so I think investors will accept this. Also, here's the VIX. We can see heading down towards the 20 level, but still inside the prior 2 days range as well. Just kind of showing you that there's not a lot going on, at least at the index level. Now, at the stock level, we're going to see a lot of high flyers and low flyers today. Here's a 10-year T-note yield. It is down 2 basis points. A 5-year is down 3 basis points, and the 30-year is down 2 basis points. All in all, we've seen a compression of the yield curve. The 5-year heading higher along with 2-year towards that 10 and 30 years. So I have to keep an eye out for that because guess what? When they cross, when one becomes inverted, then that is the recession signal, but probably not looking out for that for quite a while. Here's the US dollar index. It is in a prior day's range as well, so not a lot happening on that front. Well, here is in our heat map, we can see Amazon has been the mega cap leader, or one of the mega cap leaders, up over 1%. If you want to call NVIDIA mega cap, that is up 3%. But Facebook suffering a 4% decline after that nasty spill, 25% to the downside last week. Guys?
Yahoo Finance's Jared Blickery. Thank you so much for that breakdown. We're sticking with the topic of the markets with our next guest. Matthew Dezok is Merrill and Bank of America Private Bank Head of Fixed Income Strategy for the Chief Investment Office. Matthew, thank you so much for joining us this afternoon. We're in the middle of corporate earnings season and also awaiting the Fed's next monetary policy decision in March. I'm wondering, do you think that strong, solid corporate earnings results will be enough to offset some of the volatility that we saw earlier this year as the market started to price in a more hawkish Fed?
So generally speaking, yes. Inflation, which can hurt consumers when it's too high, has generally been good for corporations. Corporations can make money in 2 ways, really. They can sell more things or they can raise the prices of the goods and services they're selling. Right now, companies have tremendous pricing power. They have great demand for their goods and services, so they can sell more goods and services at higher prices. So the inflationary environment we are in right now has been positive for corporations. We might have seen peak earnings growth already, so the continued pace of earnings growth might decline, but we're not at peak earnings yet. And that's generally what you're looking for in the market, is when you are at peak earnings, and we're not there yet. Continued inflation, continued high aggregate demand, continued pricing power is very good for corporate earnings. That being said, with the Fed about to embark on a rate hiking cycle, with pulling back on quantitative easing, with starting to let the balance sheet roll off, there should be attuned to higher volatility going forward. That is very normal as you start a rate hike cycle.
How can the Fed deliver its mandate and within that dual policy mandate without an added shock value to the markets?
So they are really concerned, as you put it, about shock value. So coming into this rate hike cycle, they were very patient. And it took them almost 6 months to lay out the plan for quantitative easing roll-off, to slow down bond purchases. And they announced that in November. But then they got the hint pretty clearly. Inflation is now 7% to the plus, and they were behind the curve. They sort of painted themselves into a corner where they were saying inflation was transitory, would slow down on its own, and they quickly pivoted. And they've actually done a very good pivot in the last 2 months where they said it's probably not transitory. The supply chain shocks are probably not just supply related. It's probably too much aggregate demand now. So we might have to raise rates. We're going to have to stop buying bonds, and we might have to let some bonds roll off our balance sheet. So now they're in a much better place. They were too loose with no options before. Now they have options. Now they have the ability to deal with higher inflation if necessary. So we think they're going to be relatively slow. A hike at the March meeting, perhaps a hike each meeting thereafter, and see how things react. But we're not expecting a 50 basis point hike. We're not expecting a shock and awe to the market. Ben Bernanke, a former Fed chair during the financial crisis, had a great line. He said, central banking is 90% talk and only 10% action. And you've seen that 90% talk. And the market has heard that. The yield curve is flattening, as Jared has just pointed out. So a lot of the talk the Fed is doing some of the work for them, conditioning the market to expect rate hikes, having fixed income and equities recalibrate to possibly a higher rate environment. So by delivering the shock and awe with their words now, they won't have to deliver as much with their actions.
So with that in mind, with what you're saying that the Fed is in many ways testing the market with its communication and trying to get this reaction function out of the market before the Fed actually moves, do you think we ultimately get 5 quarter-point rate hikes like many market participants are expecting for this year?
So officially, Bank of America Securities is anticipating 7 rate hikes this year. We're at the wider end of the spectrum. But what we are cautioning investors on is that while we have our opinions and the Fed has their opinions, the market has their opinions, we think investors should be less focused on how many rate hikes, exactly when are they doing QT, how are they going to do that? The most important thing now, as we mentioned up front, is that the Fed has optionality now. The Fed themselves do not know how much they're going to hike rates because no one knows how the economy is going to unfold this year. We're seeing a little slowdown, which we believe is Omicron related. If you look at data from the labor market and elsewhere, it looks like things are incredibly strong. So we think they'll be able to deliver rate hikes this year. But importantly, trying to exactly pinpoint when and what they're going to do is probably not the right point. The right point is to think they're going to generally be removing accommodation from the markets, but they're going to iterate with markets, as you put it, condition the market. So they're going to go slow and gradual relatively to see how the market reacts. And again, if they see too much volatility in markets, if they start to see other shocks, if the slowdown in some economic data is not Omicron related or there's a new variant, they will adjust pace. So the future is unknown, therefore Fed policy is unknown. The important thing is they have the tools available. They're no longer painted in a corner. They're no longer stuck in this transitory inflation myth. That's very good for markets. So we do expect an upward path of rate hikes, but we don't think we have to put too fine a point on it. The Fed will iterate with markets to get to the right answer. And the yield curve is telling you recession is not a concern for this year. Maybe in 23, maybe in 24. But at the beginning of a rate hike cycle, equities can still do quite well.
Matt, only got a second here, but how can somebody best position their portfolio for the set of policy announcements that are about to come forward from the Fed?
So our view is still be overweight equities and underweight fixed income. Within fixed income, less treasury risk, less rate risk, a little more corporate risk, but safe and diversified in fixed income. Do not swing for the fences there because we recommended overweight equity position. Even if your equity assumptions are lower than they have been, if you're not expecting 8 to 10%, if you're expecting 6 or 5 or 4, that still compares very favorably to a 10-year treasury around 2%. So be overweight equities, expect more volatility. Within your equity portfolio, be overweight the US, which is still quite strong. Be diversified, make sure you have value, make sure you have cyclicals. Do not be overweight, money losing, speculative investments. Be diversified, focused on the US, making sure you're balanced between value and growth.
Matthew Dizok is Merrill and Bank of America Private Bank Head of Fixed Income Strategy for the Chief Investment Office. And we thank you so much for your insight this afternoon. Coming up, we'll break down the details of the $6.6 billion merger between Frontier Group and Spirit Airlines. Keep it right here on Yahoo Finance Live.
Welcome back to Yahoo Finance Live, everyone. A mega merger between steel birds as Frontier and Spirit Airlines aim to create America's most competitive ultra-low-fare airline. Joining us now is Helene Becker, and she is the Managing Director and Senior Research Analyst over at Cowen. Great to have you here with us, Helene. This creates the fifth largest airline operator in the U.S. I want to get your reaction to the tie-up, and particularly if these airlines, either one of them, could have competed as standalone offerings.
Well, yes. So I think it's a great transaction. We're assuming it gets regulatory approvals and that it closes in the second half of this year. And so synergies will take 3 to 5 years to work through. Airline mergers always take a very long time. Could they have competed individually? Yes, but it wouldn't have been a very strong airline. The way we think about that is I look at it from a pilot perspective. Both airlines have quite a lot of aircraft on order. They're taking delivery of 210 aircraft in the next 5 years combined. And at about the rate of 14 or 15 pilots per aircraft. Well, we did 14 because obviously you can't have a number of pilots. So it's either 14 or 16. So 14 pilots per aircraft means they need to hire about 1,000 pilots a year for the next 5 years. And then you have American, Delta, and United, who are combined hiring about the same amount of pilots, 5,000 combined a year. They said earlier this year they were hiring between one and 200 pilots a month. So you kind of work through that math. And and then there's Southwest and the other airlines that are hiring because everybody is getting back to growth after as this pandemic dissipates. And
right.
you're looking at 7,000 pilots a year. It's going to be hard to attract that many people to the profession, given the rules and how hard it is to train a pilot these days.
Helene, and earlier in your answer, you mentioned that you do ultimately expect this deal will receive regulatory approval. But what kind of scrutiny do you expect this deal to come under out of Washington, especially as the Biden administration has cast some skepticism on tie-ups, especially in the airline industry?
Yeah, so, you think about that, and it's a great question. And the skepticism is across the board because the airline industry in general took a lot of money from the government to survive. But when you think about it, had they not taken that money and had the government not been supportive of the industry, we would have been in a position where we're not now. I mean, aviation is in order to have a robust economy, you need a robust aviation industry. In addition to FedEx and UPS, the US Airlines helped get vaccine around this country. It's part of the growth, right? People are traveling, especially leisure travelers we're back to, on a leisure perspective, pre-pandemic levels. It's business travel and international travel that's lagging. So that is not, that's really not part of the equation since Spirit and Frontier tend to be more leisure-focused airlines. But I think this is really pro-consumer, and in that, look, they're not even, think about it from a market share perspective. On a combined basis, you mentioned it's the 5th largest airline. That's about 7-8% market share. Right. American is the largest with 22% share. Then you have Southwest at 20, and then United at about 18, and Delta at about 17. So at 7.5, you're still not even close to the 4th largest airline. You still have a long way to go.
And Helene, just to jump in here, because when we think about the consumer, pricing is relative. So with one less competitor that both low-cost airlines are going up against now, what does that do for the consumer pricing, even if we are seeing a higher pace or cadence of leisure travel out there? Absent the business travel, which really accounts for the majority of the profits in this industry, what does that signal for where consumers may be paying at different price levels in the future as a result of a tie-up and one less competitor, and how these companies, quite frankly, may invest in that passenger experience too?
So these companies do not compete on very many overlap. I think when I look, they have 3 overlapping routes. And 2 of those overlapping routes are outside the country. I think the only market in which the 2 have service is Orlando. They might serve similar cities, but they don't serve them from the same hub locations, if you will. Frontier tends to be more Western focused, and Spirit tends to be more Eastern focused, and Eastern United States. And so I think from a consumer perspective, this will enable the 2 of them to expand their footprint and expand their networks in a way neither one could do before. I mean, I think, think about what happened earlier today when Frontier flights were grounded because of a network outage. There are a lot of markets in which they only have 1 or maybe 2 flights a day, and they fly very high load factors, 80, 85%, which means on an aircraft that seats 180 people, we'll say roughly 150, 160 of those seats are sold. Now you only have 2 flights a day. So what happens to all the people who got canceled off of an earlier flight during this morning's outage? Those people either have to buy a ticket on a more expensive airline, and at the last minute, it's going to be expensive, or they have to wait a day or 2 to fly. I'm sure they don't want to do that. So I think this is pro-consumer in a way that other airline mergers we've seen aren't. This is all about growth. And I think that's how it should be viewed, more than about eliminating a competitor, given that the 2 don't overlap.
And Helene, with this deal, there are still a few outstanding questions. And one of the big ones is who's ultimately going to be named as CEO and as part of the management team. Who do you think is ultimately a front runner to lead this newly combined company?
That's a good question. I don't know the answer. I thought it was really interesting that there's going to be a committee named to figure out who is going to be the CEO and where the headquarters are going to be. I'm sure the folks in Denver is a great city to live in, but so is Miramar, right? South Florida, it's warm all the time. So maybe people like that. So we'll have to see how it goes.
Certainly. Helene Becker, Cowen Senior Research Analyst, joining us here today. Thanks for helping us break down this deal and all of the tie-ups therein, Helene. We appreciate it. And everyone, we'll be right back on the other side of this short break as states are updating their COVID policies, ranging from downgrading their crisis plans to lifting school mask mandates. Much more on this on the other side.
With COVID cases across many parts of the U.S. retreating after peaking earlier this year, a number of states are now moving to ease mask mandates and other virus-related restrictions. Dr. Nada Fuddle is University of Nebraska Medical Center Associate Professor of Infectious Diseases and joins us now for more. Doctor, thank you so much for coming on this afternoon. Nebraska is one of those states now rolling back its crisis measures. The state had restricted some surgeries and procedures to prioritize care for those who needed it most during the Omicron wave, but now those measures have largely been expired. Is now the right time to be easing these measures based on how cases and hospitalizations have been evolving in your state?
Well, thank you for having me. I think the reality is that the healthcare system was quite overwhelmed with the number of cases that we have seen here in Nebraska, and the hospital had to declare the crisis operation standard in order to accommodate the rapidly increasing number of hospitalizations and patients needing emergency as well as intensive care in the hospital. Now, we have seen a decline in the number of cases, thank God, and we have seen a decline in the number of hospitalizations lately. That's why the crisis operation standards have been lifted. But that doesn't by no means mean we're out of the woods yet. The number of cases is still high. The test positivity rate in the community is still high, which makes us think that we need to be cautiously optimistic while rolling back these measures.
What is the lasting impact that the healthcare system is anticipating as a result of the stress levels that have been seen in hospitals at this time, even the engagement with the communities and trying to dampen any misinformation around and during a time of a health crisis and a global health crisis all the way to the point of being a pandemic?
Yeah, I mean, I think the reality is that everyone is tired. The public is tired, the teachers are tired, the healthcare workers are burned out. there is still high rates of inequity when it comes out to vaccination rates in the community, the global vaccination rates. And unless we treat this as a pandemic, a global crisis, I think we're going to continue to see these variants emerge in different parts of the globe and eventually, unfortunately, making their way here. Now, there is a good chance that the next variant is not going to be as aggressive or as contagious as the Omicron, but there is also a chance that it might be more dangerous and more deadly. So if anything we learned from this pandemic, we learned that we have to be agile, we have to be resilient in our response, and we have to be able to adjust very rapidly depending what we're seeing in the community. The response that we have today does not have to be the same response we have in 6 months from now. In the beginning of the pandemic, we had a state of lockdown. This is no longer applicable right now because we do have tools to prevent the disease. We have tools to treat it. But yet, when it comes to a situation when there is a massively transmissible variant like Omicron, that can overwhelm the healthcare system and can lead to rapid state of burnout and fatigue. So we have to adjust for those factors when we administer a strategy for COVID directive health measures in any state or any country around the globe.
And to that point, how are hospitals and healthcare providers where you are thinking about preparing for that potential of another variant or another wave of the virus, if at all?
I think the healthcare system has learned, unfortunately, the hard way how to cope with this pandemic. There is a lot of resources now available. There are a lot of knowledge and studies and things to refer to in terms of how to adjust to these types of crises. It does become overwhelming when there is a sense that this is preventable. We don't have to see these deaths happening. Majority of cases that we're seeing in the hospital right now, still unvaccinated adults, and these could be prevented if these people were able to access the vaccine or able to agree to taking the vaccine. So there is still a lot of work to be done in order to improve our uptake of the preventive tool that we have right now, because we don't really have to be dealing with this if the pandemic was approached the correct way. I think what hurt the most is the politicization that happened of this pandemic. The association of certain measures with certain political parties or certain movements is really what augmented this crisis and further the divided that we've seen in the country around mask, around vaccination, which unfortunately became the biggest barrier right now to preventing the massive toll of deaths that we have been seeing.
On the topic of masks, in the East Coast here, the New Jersey state is going to be ending some of their school mask mandates. And then additionally, just further down the coast, you've got Delaware. Their mask mandate is actually going to be lifted later in February, still going to be required in schools, though. And so what should states be considering as they are starting to pull back on some of their precautionary measures?
Yeah, that's a great question. And I think we all would like to go back to normal. Whatever that normal is now, we would like to go back to normal, but states have to be very careful in proceeding with a lot of caution. And it's very important to rely on science and to also consult with their public health officials, because there are certain scientific measures that we can use to tell us when is the time to relax these measures and when is the time to become alarmed again. We need to be prepared to become alarmed again and reinstate some of these measures if needed. Things like vaccination rate in the community, things like test positivity rate, all of these factors need to be put into account, as well as relying on science and relying on the local public health officials to help make those decisions.
All right, we thank you so much for your time. Dr. Nada Fadl, University of Nebraska Medical Center Associate Professor of Infectious Diseases. Thank you again. Coming up, we'll get a check of the cryptocurrency space with Fred Thiel, Marathon Digital Holdings Chairman and CEO. Stick with us.
Welcome back to Yahoo Finance, everyone. Bitcoin on the run over the past 5 days, attempting to having a lovely February in the face of a dismal January that it did have when it touched 33K. For more on Bitcoin and crypto price moves that we've been tracking, let's bring in Yahoo Finance's Rochelle Akufo. Welcome to the team. A hearty welcome, Rochelle. So put this crypto move in context for us.
Well, Brad, thank you for that warm welcome. Now, as you mentioned, that 5-day run has Bitcoin walking a little bit taller on Monday. It's posting its longest rally since September, and it's also jumped past its 50-day moving average for the first time in nearly 3 months. Now, throughout the day, Bitcoin has been hovering between 42 and 44,000 territory for most of Monday. It's currently above 44,000. It's up 6% for the day. Now, as is usually the case, altcoins, including Ethereum, the second largest cryptocurrency, also tracking at multi-week highs and tracking this bullishness. And then, of course, the meme tokens, including Shiba Inu, catching the wave, up 46% at one point today. Now, keep in mind that despite the positivity, Bitcoin is still a far cry from its record high of 69,000 that we saw back in November. Seems like forever ago with all the volatility. But then that was also followed by the so-called crypto winter, where Bitcoin lost as much as 50% of its value.
Rochelle, it's great to have you on with us. What factors are at play here driving this price action?
Well, so a couple of things in play. First of all, investors do seem to be willing to take on some of these riskier assets, hoping to capitalize on the dip and really play this long game with crypto, even in the face of volatility. You also have some economists looking at what we saw with the US job numbers, completely blowing expectations out of the water. And we also saw, of course, Amazon's earnings beat, which lifted some of that meta moodiness that we saw after Meta failed to deliver. Now, we also have some of these non-fungible tokens, or so-called NFTs, that continue to gain popularity. We saw them gain popularity first with artists and then with celebrities, and now increasingly with athletes, especially in the run-up to the Super Bowl. And since NFTs are secured by Ethereum's blockchain, that's also helped Ethereum soar higher. Now, it might also have helped that Tesla, in its SEC filing on Monday, announced that it was holding close to $2 billion in Bitcoin at the end of 2021. And that's even despite the volatility and some losses, but still holding there. Now, we do know that this kind of rally does tend to bring out the more optimistic side of people, some of these six-figure predictions for Bitcoin. And it has, along with some sort of varying predictions as to when that's actually going to happen. Some are saying 100,000 by the end of the year, others saying 200,000. We saw that in a note to investors, FS Insight told investors that Bitcoin could hit 200K in the second half of the year. We also saw that Sean Farrell at Fundstrat says by the end of 2022. Now, his argument is follow the money. He's looking at venture capital investors who've poured $30 billion into crypto and blockchain-related companies in 2021. Now, that is a record, and it's nearly 4 times the record that we saw of $8 billion back in 2018.
Yahoo Finance's own Rochelle Akufo, excellent breakdown there. We're going to continue to check in on some of the crypto price action, and we'll continue the conversation here with our next guest as well. Many miners out there trying to cash in, and has the process and the practice improved to be more environmentally sustainable? Joining us now, we've got Fred Thiel, who is the chairman and CEO of Marathon Digital Holdings. Fred, great to have you here with us on the day. Perhaps we lead off this conversation with mining. It's even caught the attention of Washington, D.C., given the climate impacts. Have changes regulators are looking for been determined just yet, though?
No, I don't think regulators have determined any changes. I think, the great thing with the U.S. Regulatory environment is there are lots and lots of people who are regulating the space or attempting to. The CFTC, the SEC, the Department of Treasury, and the group that seems to be focused on mining right now is more really a group of people concerned regarding the energy use of proof of work as a technology. Proof of work is what secures the Bitcoin blockchain and makes it the most secure blockchain out there. North American Bitcoin miners are predominantly using renewable energy. And I think there's a lot of misconceptions in the US today regarding energy use. Many people don't realize we actually generate about 14% more energy than is consumed in the US. And 10% of the time, for example, in Texas, energy is negatively priced, meaning the energy companies have to pay people to take it because they have excess energy. We've built out a lot of renewable energy in the US. and it produces power at a time of day when most consumers aren't using it, which is the middle of the day. And Bitcoin miners provide this great baseload customer for renewable energy providers. We are focused predominantly on attaching to the power grid behind the meter, so to say, at the point of power generation, which allows us to be curtailed or shut off whenever the grid needs the energy. So we act as a type of battery, you could say, a buffer, so that the energy companies are getting paid for energy when consumers don't want it and don't pay for it. And then when the consumers need it, we voluntarily shut off. And you can see most of the news regarding the recent cold weather in Texas. The vast majority of miners voluntarily said, hey, shut us down. We don't, we want to provide the energy to the grid so that people don't lose electricity. So the US energy market is very different from the European one. And I think it's a question of education. People really need to learn about energy, how it works, the fact you can't store it very easily, you can't ship it long distances. And the only reason the consumers would ever go without power is typically a grid-related issue, not a power generation or because a Bitcoin miner is operating issue.
Fred, this is Emily. Thanks so much for joining us. What specific regulatory action or oversight would you want to see come out of Washington to regulate this climate impact of Bitcoin mining for your company or for others in the industry, of course, as well?
Well, I think it all depends on what do you want the regulators to do. So if you want the regulator, if the goal is that the U.S. grow its renewable energy generation, then regulators should incentivize Bitcoin miners to focus on renewable energy sources. Why? We provide huge baseload consumption to the power generators, the renewable energy generators, which allows them to invest in more capacity. Here's the problem. In California, there is so much renewable energy capacity that the grid tells the operators to shut down to the tune of about 1.4 terawatt hours last year alone. Had that energy been used by Bitcoin miners when consumers don't need it because they were told to shut it off, it would have produced almost $700 million of revenue that could have gone to the energy producers. So there's a huge amount of incentive for renewable energy producers to work with Bitcoin miners. And I think if the regulators were to simply say, hey, there's an incentive for renewable energy to be used for Bitcoin mining versus fossil fuel, I think that could go a long way to additionally moving the transition. But you have to realize if the power generators don't have an incentive to build more energy generating capacity, they're not going to. And so if we want this country to move away from fossil fuels, which predominantly generate what's called baseload energy, then they're going to have to build out a lot of renewable energy, which today is not profitable for the energy providers to do. So you have to create an incentive. So we're very focused on becoming fully carbon neutral by the end of this year, much faster than most companies in the United States or in the world. And we're well on track to being that. And we look forward to being a very active proponent of deploying lots of renewable energy. And you'll see, announcements from us throughout this year on what we're doing in that area. And we're very happy to play our part in that.
Certainly. A big day in mining news as well, particularly as we were able to confirm earlier, the Valkyrie Bitcoin Miners ETF, that going to be listed on the Nasdaq, and particularly not directly Bitcoin touching, but it's really going to look at the companies that are leveraging mining or get the majority of their revenue or profits through mining. And so what is the significance of yet another type of exposure into the companies that are doing the most on the mining front being available to and via a traditional asset class, if you will?
It kind of gets back to Warren Buffett's famous quote that, I don't invest in gold, I invest in gold miners. Why? Well, the gold miner has a very large amount of gross margin in their production that you don't get when you buy spot gold as an investor. Same thing with spot Bitcoin. It costs Marathon a little over $6,000 to produce a Bitcoin when Bitcoin is trading today at around $44,000 a Bitcoin. That's a very profitable business. And we don't sell our Bitcoin, so we hold it. So we're constantly accumulating more and more Bitcoin. We're the 5th largest holder of Bitcoin of publicly traded US companies today. And we continue to hold. We're a very lean operator. We're very asset light. And with the profit margins that cost of production affords us, we become a very attractive stock as we grow our production capacity. And we're growing about 7-fold this year, our capacity from a perspective of the amount of exahash that we're producing, or think of it as our compute power. And so it becomes a very interesting proxy for Bitcoin, because you get the benefit of the profit margin of the producer as opposed to just the incremental value in the spot market price of the underlying commodity.
Fred, we got to have you back on to continue this conversation. Got to leave things there on the day, though. Fred Thiel, who's the Marathon Digital Holdings Chairman and CEO. We appreciate the time here, Fred. And coming up on the other side of this quick break, everyone, are you still watching the streaming wars? Disney set to report earnings this week. Investors, they're on the edge of their couch cushions, waiting for streaming figures from the House of Mouse. Were the decelerating growth forecasts from Netflix, were they a singular issue or a signal of an industry trend? We're going to discuss that next.
Welcome back, and it's time now for our 2 and 2. 2 stocks I'm watching and 2 stocks Brad is watching this Monday afternoon. And I'll kick things off today with Hasbro. Now, the toy maker stock has erased earlier gains from this morning despite posting fourth quarter sales and profit that topped expectations. Now, its commentary on the earnings call earlier that it sees cost pressures continuing through 2022 may be what's spooking investors right now. And Hasbro specifically said that it expects higher freight and product costs in the current quarter, but the company is implementing price increases to consumers that will take place in the second quarter to help offset some of these cost increases. Now, in terms of supply chain constraints, Hasbro executives also said that they've been seeing lead times for inventory from China tripling on average. So again, really underscoring the fact that these logistics concerns are continuing for a number of these consumer packaged goods and toy making companies here with Hasbro. But nonetheless, for the latest reported quarter, Hasbro did beat expectations. Again, earnings were $1.21 per share on revenue of $2.01 billion. Both of these were ahead of expectations. Still, Hasbro shares have fallen about 8% so far for the year to date to underperform the S&P 500. Meanwhile, I'm also watching shares of Bumble. Now, the dating app company announced its first ever acquisition earlier today, and it's making a move into Western Europe. Now, the company bought the French dating app Fruits, which launched in 2017 and serves France, the Netherlands, Belgium, and Spain. It's also popular with Gen Zers, so this also is potentially a move here to help Bumble branch out into that burgeoning audience with that demographic. Now, JP Morgan analyst Corey Carpenter had this to say about the acquisition in a note this morning, writing, quote, "We think Fruitz makes a strategic sense given Bumble app's planned international expansion this year and its focus on the important Gen Z audience. Fruitz also likely represents a mostly complementary user base, with France a fast-growing but still smaller market for Bumble app." Now, again, those shares have paired earlier gains from today, still down about 0.5% as we head into the final trade today. Brad?
All right, I'm going to check in on two stocks, and mine are Alibaba and Peloton. First up, BABA is the ticker symbol for the Chinese e-commerce company, and you're seeing them down by about 7% here on the day. They're about a touchdown off of their 52-week lows, at least at this point in time in trading on the day. And particularly what's of note here, on Friday, they had actually filed a Form F6 with the SEC, and Citi had actually seen this. They believed to be this filing signaling a potential selling action that could come forth from SoftBank. Now, let's remember, SoftBank, they have over 673 million American depository shares of Alibaba. That is owned by SoftBank. Back in 2014, Alibaba had registered about $2 billion in their IPO, of course. So when they went public, Citigroup particularly, they do know and calculate SoftBank to have about a 25% stake, just shy of that, in Alibaba. And so that is one of the major weights on today's activity for Alibaba. They're expected to be reporting their quarterly earnings. Many estimates had actually called for those to come as early as today. And so we will see when those come through. They're expected, though, to come through in the month of February. So we're watching closely for that. And then lastly here, I want to check in on shares of PTON, Peloton. Going into the close here, we've got about 13 minutes left in trade, and they are higher on the day by about 22%. And it's on the speculation. Yes, the speculation stationary wheels are a churning here and moving. And as those speculation wheels are spinning, it's the companies that are being involved in the discussion here. It's companies like Amazon, companies like Disney, even Nike, and Apple. A small company that you may have heard of there. And so with all of that in mind, as we think about Peloton and what that integration could look like with any of those companies, it comes down to whether or not, despite some of the demand and waning demand that has been present in the leaks of halting some of the production for specific connected devices, and what that means for anybody that would be acquiring this company, that's what investors are parsing through. However, investors are praising any type of acquisition news that would come forward, especially if it was one of those aforementioned behemoths that they are in all of their respective categories. And so some of them make more sense than others. We will see ultimately if there is a tie-up that is to come in this in-home fitness space right now, Emily.
Brad, as we enter another busy week of earnings results, Disney is one that we're keeping a close eye on, especially as we await updates on the growth of Disney+. John Christian, founding partner of On-Prem Solution Partners, joins us now with a preview and much more on the streaming landscape. John, thank you so much for your time this afternoon. We saw a disappointing quarterly subscriber addition for Netflix and weaker than expected guidance. Are you expecting a similarly tepid performance out of Disney+ this quarter?
Well, I think Disney will continue to perform. Obviously, coming out of COVID, there was a huge spike in subscriptions, right? So obviously that's going to plateau off. But again, streaming is the way that they're focusing on. They're putting all efforts there. So I'm interested to see what happens there.
John, do you believe that anything Netflix had mentioned with regard to the decelerating growth will be present with Disney?
Well, the one thing that's interesting about Disney is that they definitely have a diversified revenue set. So they're not just a pure streamer, right? So they get into theatrical release. They have a tremendous amount of revenue in their merchandise and consumer goods and retail on that side. And then they also have theme parks, right? So it's not just segmented to just obviously pure streaming, right? But with that, obviously Disney is going to be focused on data. Data is king, making sure that they understand the data around the users, which actually helps and informs them in terms of what content they produce. And they've been doing a great job in terms of the franchise model and creating basically content that creates stickiness with their users.
When we think about the theatrical releases versus the streaming platform releases for Disney, of course, that's something they've been experimenting with over the course of the pandemic. Where ultimately do you think the company is going to fall in terms of the proportion of the content that they put directly into theaters and the proportion that they put on streaming, either exclusively or in tandem with these theatrical releases?
Yeah, well, so the first thing is it's great that they actually have an ability to have a theatrical window, right? So that's adverse to what Netflix is in a pure streaming environment. And so I think, unfortunately, we've been a little bit bogged down with COVID. So the experimentation is not completely accurate, right? Not everyone's going to the theaters, right? But where I think it's going to fall, and this is not just for Disney, but for all of them that have the theatrical release component, is there's going to be a period of time, call it a month, 6 weeks, that they're actually going to put on theatrical release solely before they put it to the platform. Or maybe they have something on the platform where there's a pay-per-view that goes along with it, but they're going to get an uptick of revenue from that, and then they'll release it solely to the platform. And I think I'm excited to see where that experimentation happens, because I absolutely don't believe that theatrical is dead. And so I think they'll experiment there and continue to see where that takes them.
John, you also mentioned some of the differing elements of how Disney's revenue is made up. And as a part of that pie, parks and resorts, of course, and the experience economy, that plays a major role in how Disney is able to chart its own reopening story as well, which has been sputtering. And so with regard to that particular line of business, what are some of the expectations around how that will perhaps dovetail into, of course, what's become a focus on their streaming element of their business, how the parks and resorts will continue to hopefully try and rebuild itself post-pandemic as well?
Yeah, well, I think the good news for Disney is that they think about it as the combined ecosystem, right? All these things combined. So it's not just the content itself, but it's how they market it. It's the consumer goods and retail. It's the theme park experience, that fully immersed experience. And so what I see is basically these new franchises, these new series. You know, you have Marvel, you have Star Wars. That's all going to play a huge piece in basically how they update their parks and create that experience, right? And create that stickiness.
We've seen for streamers from Netflix to Disney that really building out a content library is an extremely expensive endeavor. Disney has said that Disney Plus should be profitable by fiscal 2024. How convinced are you of that timeline, and how much more do you think Disney will have to spend to keep being on the cutting edge of being a leader in the streaming space?
Yeah. Well, it's two things. So first is on the revenue side, right? You need to make sure you have the critical mass of subscribers, and you need to make sure you keep them. So stickiness is huge, right? So you need to keep filling that funnel full of content. And again, I keep saying this, but the concept of franchise, to have those repeating series and episodic that people are going to continue to come back for. I talk about the Game of Thrones content, right? So they're going to have to continue to produce that content to get those users there. And then the next thing is, you really got to think about the cost size, right? So the other important piece on the revenue is globalization, right? So hitting territories outside the US. The issue with the global market, though, is that the revenue that you're going to bring in is going to be less than a US market. So you need to be efficient. So it's all about the data, making sure that you have a very efficient data platform to understand what the users are consuming and how much they're consuming. You also really need to make sure that you have an efficient digital media supply chain. So the content and it being prepared and being sent to all the different distribution points, right? And then the localization around that. And there's cool technology that's coming out with AI in terms of dubbing technology and things like that. And so really those go hand in hand, right? And so these companies that are used to re-engineering their process to a new digital first environment, they're going to come out ahead, right? And so Disney, I imagine that they're going to become efficient as well as go with the revenue. So I think the timing of 2024 seems reasonable.
All right, John Christian, On-Prem Solution Partners founding partner, thank you so much, and we'll be looking forward to those earnings on Wednesday. Coming up, we've got the countdown to the closing bell. Stick with us.
Welcome back, everyone. Minutes left in today's trading session. Yahoo Finance's own Jared Blickery is standing by ahead of the market close. Jared.
Yeah, the market reversal I was noting earlier where the Nasdaq had switched place with the Dow. Well, the Nasdaq has delved into deeper territory right now. And we're also seeing the Dow in the red by about 16 basis points. Only the Russell 2000 up about, 65 basis points right there. Looking inside the market, some big losers today. We got Facebook down 5%, Alphabet down 3%, Tesla down 2%, and Microsoft also down 2%. In terms of the gainers, Nvidia is looking pretty good, as is AstraZeneca, but far and few between a lot of the green spaces and not a lot of green light on this particular heat map. Also checking out Simon Property Group. We got that coming to you after the bell, along with Take-Two earnings, so stay tuned.
All right, we're going to be keeping a close eye on that. The market close is up next. Everyone, stick around. Welcome back, everyone. You're watching Yahoo Finance Live. Markets officially closed on this Monday, February 7th, 2022. And taking a look at the major averages, we cut some of our gains going into the close. We closed mixed with Dow closing flat just barely to the upside there. The S&P 500 closes lower by about 0.4%. We'll round that off too. And the Nasdaq Composite closing lower by more than 0.5%, 82 points in negative territory. And so for a post-session breakdown, we've got George Ball, Chairman of Sanders Morris Harris, standing by, as well as Sam Stovall, CFRA Chief Investment Strategist. Great to have you both here with us today. And I'm Brad Smith, of course, alongside Emily McCormick. Let's dive right into it here, because we've been tracking some interesting activity going into the close. And Sam, I'll start with you. What do you believe kind of played into this late day selling activity that we saw going into the closing cross?
Well, I'm thinking a lot of it has to do with the 10-year yield climbing close to the 2% threshold. I think investors are still getting a bit worried about what the CPI numbers will show on Thursday. We're looking for a 7.3% year-on-year gain. And then also just listening to whatever trial balloons are going to be coming out of the Fed.
George, I want to get your take on this as well, especially with that CPI print coming out later this week. Now, as Sam was mentioning, we're looking for more than 7% annual rise in the CPI later this week. Is another multi-decade high print already priced into the markets and something we may not get a response to, or should we be expecting more volatility around this?
if the CPI print is around 7%, I think it will momentarily unnerve the market. A high degree of inflation is expected. Fed hikes are expected. They are priced into the market. Right now, the market is reacting almost in Delta lockstep. If T-bill rates go up, then the Nasdaq stocks, the tech stocks go down. But other than that, the market is seeking new leadership, which is not the Fed, it's not the CPI, it's something else more fundamental before a trend is reestablished.
And so, George, sticking with you for a hot second here, as we find ourselves within the throes of earnings season, for one thing that we've heard for companies that are trying to invest right now, investors have had to also themselves parse through what kind of money that might mean, what kind of capital that might mean that companies are willing to spend to invest in their own growth. And so from an investor's perspective, how should we be reading into that and how long it might take in some cases for that to ultimately pay off?
Companies have been buying back their own stock, but at a somewhat decreasing rate over the last 6 or 9 months. They're being capitalized for buying back their own stock rather than reinvesting in the businesses. I think your underlying point, though, is that all of a sudden companies see where they can get very high returns, particularly compared to the costs of borrowed money or just to any normal index by investing more money in their business. That's going to be very good for the economy. It's going to be a longer-term payback, but it's going to be a fundamentally sound payback. And it is one of the things I think that's going to prop up the market almost no matter what. Companies believe in their futures. They're willing to invest in the growth of their business, and that is going to be good ultimately for their stock prices.
Sam, I'm wondering, I know we're just in February now, but are you expecting the S&P 500 to end this year higher than we ended it last year? And if so, what are the catalysts in place to really underpin that next leg higher?
I do think we'll end up higher. My target is 5,024 on the S&P 500, which really is no better than a mid-single-digit advance. I think that 2022 is really going to be hallmarked by an awful lot of volatility. History basically says that we have a 40% increase in volatility in midterm election years as compared with the other years in the presidential cycle. Second and third quarters are traditionally negative, but then we have very strong performances in the final quarter of this year, first 2 quarters of next year. And I think the catalyst for this year will likely be concerns about inflation, higher interest rates, and the resetting of valuations because of these higher interest rates.
You mentioned something very critical, which we haven't discussed in a little bit, which is the reality of 2022 being a midterm election year, and perhaps with a changing in the House and the Senate, that could initiate even more of logjam in Washington, D.C. What does that essentially mean for how traders should look at this event and going into that event, particularly, I should say?
Sure. Well, if you look to first-term Democratic presidents, they end up losing an average of 26 seats in the House and 4 seats in the Senate, both of which would throw the majority to the Republicans. But history then says that the market really does pretty well whenever we have a gridlock environment because Congress, in a sense, cannot get in the way of Wall Street. So I think that we have the uncertainty leading up to the midterm election, but usually once the uncertainty has been lifted, then the market tends to do quite well in the coming 3 quarters.
George, we've had a number of strategists come on and say that 2022 is really going to be a stock picker's market, given the fact that we are moving away from this environment of very easy money. Where are you seeing opportunities right now at the stock or sector level?
Let me be positive by saying I think that the market broadly is a good opportunity along the lines that Sam just described. High single-digit gains during this year. There's an odd phenomenon today that I think is assuring or reassuring to investors. When you had the 2008, 2009 crash in the market, stocks were selling at 4.5 times EBITDA. In 2000, they were selling at 3.5 times EBITDA. So $3.50 of debt for every $1 worth of earnings. Today, the ratios are 1 to 1. Companies are earning $1, at least in EBITDA terms, for every dollar that they have borrowed. And that's a buffer that's going to lie under the market. So if you're worried about the market, I think that that's something that's going to cause you to probably continue the shift away from the big FANG stocks, probably out of tech to some degree, into the consumer disposables, into some of the more dependable energy earners like the master limited partnerships, and portfolio composition will shift. But the smart investor is going to keep the equity weightings up high as they are today. There's earnings underneath stock prices that's going to be a good buffer almost no matter what. It should be a fairly good year, not a great year, but a good year for the markets.
Banks over the course of this earnings season had continued to come out, George, and say exactly how many times they thought the Fed may raise rates over the course of this year. Even today, to kick off this new trading week, we got another estimate, and that's above the 4 that many of us had believed coming into the Fed's previous meeting and announcements that they made thereafter. Where do you believe that figure is set to come in at by the end of the year? And will we actually see a larger kind of rate of hiking, if you will, or size of the hikes than anticipated?
Well, the Fed may hike its leg on the markets, but not more than 5 times, I don't think, Brad, and at least 3. Anything between 3 and 5 is well priced into the market today, as is year-end inflation at around 4%. So those aren't the variables that are going to hurt the trader unless they prove to be wrong. To Sam's point, if there is not a change in the Congress, I think that would be a shock to the market. Traders and investors expect a Republican-led Congress. If that doesn't happen, that will unnerve both traders and longer-term investors substantially. Look out for the elections. An adverse surprise there for the Republicans would be a negative to the stock markets.
Sam, we're tracking towards a 29% year-over-year growth rate for the S&P 500 earnings in aggregate. We seem to be already past that peak growth rate, but do you think we're peaking now or will soon peak in terms of absolute earnings for the index this year?
I think we've pretty much already peaked in terms of year-on-year growth. We're looking at a 46% year-on-year gain in earnings for all of 2021, with the peak quarter being in the middle of last year. And for this year, expectations are for less than 7% growth. The average earnings increase annually since 1988, when Wall Street started looking at operating results, was a shade below 8%. This for 2022, we're looking for 6.7%. So we're certainly on the leeward side of this earnings mountain, if you will.
George, Sam, great to have you both here with us today. It's George Ball, Sanders Morris Harris Chairman, as well as Sam Stovall, who's the CFRA Chief Investment Strategist. Gentlemen, we appreciate the time here. And we want to go over to Jared Blickery. He is standing by with Take-Two Interactive's earnings, Take-Two shares, keeping tabs on them. And after hours, Jared, what do we need to know?
That's right. Stock's down about 1% right now. I've seen it both up and down, as much as 7% to the upside and a few percentage points to the downside. Missing a lot of the key numbers, or on a lot of the key numbers. Third quarter adjusted revenue coming in a little bit light, $866.1 million. The street was expecting $870.5 million. Adjusted EPS coming in at $1.32. The estimate was for lower, so a nice beat there. The Wall Street estimate was for 20 cents lower at $1.12. Digital online net bookings, $762.3 million. That's up 12% year over year, and that's also a beat of the street's number of $745.2 million. Now, physical, retail, and other net bookings, those were $103.8 million, pretty light of the Wall Street estimate of $120.4 million, also a decline of 23% year over year. And then finally, digital online net bookings percentage of the total is 88% versus the estimate of 85%. Now, we do have their forecast for the full year. They're seeing adjusted revenue of $3.37 billion to $3.42 billion. The estimate was for higher at $3.48 billion, so a bit of a miss there. Also seeing adjusted EPS of $4.75 to $4.85. Previously, they saw $4.20 to $4.45. all of that lower. Well, I'm going to call it the midpoint. The estimate is for 477, so that is kind of, I would say, I just meeting estimates. Now, for the fourth quarter, this forecast, they're saying adjusted revenue of 808 million to 858 million. The estimate was for quite a bit higher, 918.7 million. So all in all, kind of a mixed bag, but some misses on some of those key numbers. Now, I just want to take a one-year look of the stock, and you can see underwater here by about 15%. Most of this is trading sideways. We did get some news the other day, Grand Theft Auto, the new version, the new episode, whatever you want to call it, that's coming out soon. That is underway. I don't know how soon that's going to be. Also, they have that Zynga purchase they announced during the quarter. Not sure exactly when that's going to close, so there's going to be a lot of talk about that on the analyst and the earnings call. So all in all, the stock off, looks like it's down about 3%. Sorry about that, guys. Off 3% in after hours trading here. Take two.
Yeah, it's moving around quite a bit here in after hours trading, Jared. Thanks so much for breaking that down. Of course, the parent company of many of those popular franchises that you mentioned, GTA, of course, NBA 2K, and so forth as well. We'll continue to track them in after hours trading here. Appreciate the updates, Jared. And everyone, coming up on the other side of this short break, a conversation with Representative Ro Khanna. Plus, we've got Simon Property Group earnings for you coming up as well on the other side.
Welcome back. As the COVID-19 pandemic accelerated our society's already rapid shift towards digitalization, our next guest has a new take on promoting equality and security and combating disinformation in this tech-driven era. Representative Ro Khanna of California joins us now to discuss his new book, Dignity in a Digital Age, and much more out of Washington. Congressman, thank you so much for joining us. So first on your book and your views on tech, there are so many issues facing tech around, as I mentioned, equality, privacy, misinformation, and disinformation. But where do you think Congress should start? What do you think is that number one step that lawmakers should take that would start to make real progress on these issues?
Emily, the biggest thing we need to do is provide people left out with economic opportunity in the digital economy. There are going to be 25 million digital jobs in 2025. my district and the surrounding areas has $11 trillion of market cap. It went up 40% during the pandemic. There is no reason that these jobs shouldn't be available to rural America, to our heartland, to the South, to Black communities and Latino communities. And you see with Intel investing in Ohio, what's possible, 3,000 new manufacturing jobs and 7,000 construction jobs. And so the book really lays out a roadmap of how to do that.
As digitization continues to grow, as the opportunities within tech continue to grow, you sit within the House Oversight Committee as well. And so with regard to the oversight over top of the tech industry with that growth, what are some of the ways that you also have to prioritize the oversight and the monitoring within that segment and that sector as well?
Oversight is critical. I would suggest 3 areas. First is privacy. These companies shouldn't be able to take our data without our affirmative consent. We need a law saying we have to opt in to consent before the companies are allowed to use our data. Second is the issue of antitrust. We want to make sure that any mergers are reviewed so people aren't killing their competitors by acquiring them. And third, of course, is misinformation and incitement to violence. The speech that has specific threats of violence shouldn't be protected online. That doesn't pass the Brandenburg test.
On the topic of privacy and opting in, as you were mentioning, we've seen the impact that Apple's iOS privacy changes have had on Meta Platforms results and on other major technology companies. How would you want to engage the private sector on being on board with some of these changes so that they are able to continue with some of their business practices under some of these new regulatory frameworks?
Well, Emily, that's an excellent point. Apple and Tim Cook actually are leaders when it comes to privacy. They've done more than the United States Congress has, and it's influenced by Tim Cook's brilliant Stanford commencement address, where he said to be human, to think freely, we can't have our data collected and targeted. And we've seen the revenue decrease. I mean, one of the reasons I think that Facebook stock has taken a hit, multiple reasons, but one of the reasons is the compliance with these new privacy requirements on Apple. Now, my view is we have to go further and make sure that Congress passes what Apple has started to do.
Congressman, when we think about the amount of not just data, but the amount of content that is on many of these platforms as well, whether it be user-generated content or whether it be content that's created in partnership as a result of major contracts. In Spotify's case, the most recent controversy there, because of a creator that they work with and have on contract in Joe Rogan for its podcast division. What responsibility do major tech platforms, especially those who ingest content from creators, what responsibility do they have in not just advancing the civics in the US, but also ensuring that it is not harmful, the content that is going up in the platform, whether that be related to a global pandemic or whether that be related to equality in America?
They do have a responsibility. I think at the very least, they have a responsibility to make sure speech isn't inciting violence, that speech isn't inciting illegal conduct. But more than that, they have a moral responsibility. I mean, if there is speech that has blatant misinformation about COVID, or if there is speech that's engaged in racism, then they should take that speech down. That doesn't mean that they don't have a First Amendment right to have that speech, but they should have some moral obligation, just like Yahoo Finance on this show wouldn't air basic blatant racist statements. I think social media needs to have some responsibility.
Switching gears here, President Joe Biden has now suggested that Build Back Better may need to be split into separate bills for progress to be made in the near term on this. What do you think about this move, and what legislation from Build Back Better do you think should be prioritized?
I support the president, and we need climate. If we don't get the climate investment, we're going to be in a world of hurt. And that's why I have suggested let's prioritize the $400-500 billion in climate. Let's get some basic social investments, free preschool for 3- and 4-year-olds, some expansion of Medicaid, and let's pass that. That can pass today with the Senate. And then let's get the rest, paid family leave, child tax credit, $15 minimum wage, in one-on-one legislation, in single pieces of legislation.
Speaking of climate, you've also demanded that big oil companies come to testify in front of the Oversight Committee as well. For energy companies that have prioritized profits over environmentally sustainable production, what substantive changes do you believe will come from the board members of companies like Exxon, Chevron, BP, and Shell after some of the upcoming hearings that are slated?
Well, first, they need to be transparent, admit about the past misinformation where past CEOs have denied that human activity causes climate change. They should just come clean. Second, I'd like them to make some commitments. I mean, they've started that way. Exxon has said that for its own emissions and its own manufacturing plants and drilling operations, it will cut them by 50%. Now we need them to go further and say it's going to actually cut emissions of all the oil it sells 50%. So I'd like them to really talk about what they're going to do to hit the Paris Accords, which the companies say they're committed to hitting.
All right, we'll leave it there for now. Representative Ro Khanna of California, thank you again so much for your time this afternoon. The afternoon earnings reports keep rolling in, and Yahoo Finance's Jared Blickery is back with a breakdown of the numbers from Simon Property Group. Jared?
That's right. The mall operator hitting a number of key metrics here, beating the Wall Street estimates. Let's get straight to those. Funds from operations. Now, this is a key metric. You can akin it to earnings per share for other companies. This is a real estate company. So funds from operations per share came in at $3.09 versus the estimates of $2.90. Revenue was a nice beat as well, $1.33 billion, beating the estimate of $1.28 billion. And then when you break that down, leasing income, that was $1.22 billion, roughly coming in line with Wall Street expectations. Management fees and other revenue, $28.1 million. The estimate was for a little bit lower, $27.1 million. Finally, other income, $73.1 million. Estimate was for lower by about $10 million. Now, occupancy, here's another key stat coming in at 93.4%. Estimate was for a bit lower at 92.9%. Not quite up to that pre-pandemic level that they had experienced in 2019, but the base minimum rent per square foot coming in at $53.91. Now, we do have some commentary from the company, and this is from, let me just read this. In 2021, we generated record annual funds from operations of nearly $4.5 billion, returned approximately $2.7 billion to shareholders. We executed over 15 million square feet of leases, completed 5 significant domestic redevelopments, opened 2 new international shopping destinations, and substantially increased the profitability generated from other platform investments during the year. And we do have an outlook for the current year. The company currently estimates net income is going to be within a range of $5.90 to $6.10 per diluted share, and funds from operations will be in a range of $11.50 to $11.70 per diluted share for the year ending December 31st, 2022. You can see the stock's down about 3% in after-hours trading over the last year, holding on to gains of about 50%. And you can see since November, been flagging. You can consider this a bull flag, and within the context of its 2-year trend here, going all the way back to the beginning of the pandemic, a break to the upside, probably see some momentum, but maybe not off of this particular report. Guys?
Jared Blickery, thank you so much for that, and have a great evening. The first weekend of the Winter Olympics in China is behind us, and viewership so far has been on the decline. We'll discuss what this may mean for the media platforms streaming the games on the other side of this break.
Welcome back, everyone. Olympic ratings are on a slippery slope. Viewership is down for the Winter Games, impacting ratings for Comcast and its Peacock streaming service. To help break down the significance of this trend in declining ratings, we're joined by David Hager, Senior Equity Analyst over at Edward Jones, and Yahoo Finance's Josh Schaefer. Great to have you both here with us. So, David, first and foremost, let's start off with the broader impacts that these declining ratings could have for Comcast, particularly as it looks to further monetize the number of viewers that come to its platform at a time like this.
Well, certainly, the Olympics are an important way for Comcast to be able to highlight its new Peacock streaming service, which in the Summer Olympics, the company had a little bit of a slip up in terms of what was available on Peacock, and I think frustrated some users where at least this time around, it looks like they're offering pretty much all the Olympic content on Peacock. And we view it as important for gaining traction with the service. And certainly for the premium services, the $4.99 a month, $9.99 a month services. And we feel like especially $4.99 a month with the ad load, because we see strong opportunity for targeted advertising on streaming services such as Peacock.
And David, with the numbers that we saw from this weekend, obviously only one weekend, but down 43% from 4 years ago, you had cited previously that the Super Bowl and the Olympics could be potential tailwinds for increased earnings this quarter for Comcast. Do you think that this changes your outlook at all? Or are you waiting to see what happens with the rest of viewership for the rest of the Olympics? How does this kind of impact what we might see from Comcast overall?
Well, certainly, it's a slow start to Olympics, and obviously a lot to go yet in terms of Olympic programming. But I think combine that with the Super Bowl, which we have coming up here shortly as well. We still expect a strong quarter. Certainly the Super Bowl in particular always it does well in terms of generating ad revenue. And brings in large viewership numbers. But the Olympics, it may be a little bit trickier in terms of the impact on that front, depending how the ratings play out over the next couple of weeks. There might have to be some make goods in terms of if the viewership comes in lower than what was expected. Our understanding is the company had been preparing advertisers for potential weakness in ratings. I think somewhat with the experience they saw in the Summer Olympics. And so, but I don't think it will have a dramatic impact on the near-term outlook. And as I said, I think Super Bowl will offer some offset as that in recent history has tended to still generate relatively strong ratings.
But in terms of the investment that NBC has put into the Olympics, NBC is paying the International Olympic Committee $7.75 billion to broadcast this through 2032. Do you think this investment is still ultimately going to pay off for NBC over the next decade?
Well, certainly it's going to be more of a challenge. At the time the current contract was signed, the viewership levels for events like the Olympics had not dropped off as much as what we've seen more recently. And that's where I think NBC is going to have the challenge of making the migration onto the Peacock platform and trying to offset the lost subscribers that we may see on the traditional broadcast with a gain in subscribers on the Peacock platform. And part of that may mean trying to bring on more Peacock subscribers who are sticky after the Olympics and can add value for the service by remaining as Peacock subscribers, and potentially they get some return on the Olympic investment in that way, and perhaps it's somewhat of a promotional cost in a sense of getting subscribers on. The tricky part will be to keep them there after the next 2 weeks and the Olympics are over.
David, how do you evaluate where Peacock is overall in the streaming wars, and maybe specifically with sports streaming? Peacock has, Sunday Night Football, they'll have the Super Bowl, they have these Olympics, and they have English Premier League soccer, and those are kind of their big gets, but they don't have a lot of the other sports and kind of the day-to-day aspect of it, like say Disney does with ESPN Plus. I was just curious where you think Peacock sits in the grand scheme of sports streaming, and if they need to acquire more, or if the strategy they're doing thus far seems to be working to attract people to the service.
Well, certainly you could make the argument from a broad point of view, the subscriber levels on Peacock have ramped at a slower pace than some of the other streaming platforms. Certainly examples like a Disney Plus, ramped quite a bit faster than what we've seen so far on Peacock. Now the two services are aimed a little differently in terms of Disney Plus not offering sports type programming and not having an ad supported option, but we think that over time NBC may have to bring more sports rights on board for the streaming service to continue to expand availability of sports on the platform. Certainly to monetize that business from an ad point of view, certainly live sports would be one way to accomplish that, and would be a way to continue to differentiate the service from some of the other streaming services out there.
What kind of cash do they have on hand to help them acquire some of those licenses that are necessary? And how much of that would you expect them to put forward in trying to make sure that they do attract more attention, more eyeballs and consumption of the content, particularly sports content?
Well, Comcast has a strong balance sheet at its disposal to make investments in content. The company already has gotten back down to their target debt levels after acquiring Sky a few years ago, and as a result have been aggressively buying back shares and recently increased the dividend. So the company does have the cash available to make more investment. That they may walk somewhat of a fine line in balancing increased investment in sports content with continuing to show earnings growth on the bottom line. And that's one of the challenges the more established media companies have had. Investors have an expectation for strong profitability, strong free cash flow out of the business. But at the same time, companies are having to make big investments to get the content on board to grow their streaming services. And certainly investors are looking at streaming services as the future growth drivers for the businesses relative to the more mature cable TV channels and other parts of the broadcast business.
All right, we're going to continue to track shares of Comcast, especially over the course of the rest of the Olympics, plus going into the Super Bowl as well. We know that we're in the midst of the Super Bowl week. David Hager, Edward Jones, Senior Equity Analyst, joining us here on the day, as well as Yahoo Finance's own Josh Schaefer. We appreciate the time. And everyone, coming up on the other side of this short break, the NRF, National Retail Federation, they expect $23.9 billion to be spent by the U.S. consumers for Valentine's Day. $2.3 billion of that on flowers and arrangement. We speak with the founder and CEO of FarmCore Flowers to hear about the consumer demand ahead of Cupid's holiday next.
Welcome back. Valentine's Day is just around the corner, and what's a better way to say I love you than with a classic bouquet of flowers? We're welcoming in Christina Stembel, CEO and co-founder of the e-commerce flower company Farm Girl Flowers, for more on the lead up to the holiday. Christina, it's great to have you back on, and you pointed out something interesting in your notes to us, which is that Valentine's Day actually falls on a Monday this year, which has added additional challenges in terms of logistics and delivery times over that weekend ahead of time. How has this impacted your business and how you've planned for this year's Valentine's Day?
Thanks for having me back, Emily. It's a pleasure to be here. Monday is, like you said, it's just the worst day possible for a Valentine's Day to fall. It's definitely impacted our business in, trying to figure out how much risk we want to take. Monday, for a small business, we're not large enough to get a Sunday pickup for a Monday delivery, and that's when everybody wants their flowers. So we only have very few locations where we can ship flowers from to get them there on a Monday. And then those few locations have to carry all of the risk if there's any delivery issues with weather issues, things like that, which really adds a lot of complexity to the holiday for us.
The National Retail Federation expecting $23.9 billion to be spent by U.S. consumers for Valentine's Day, $2.3 billion of that on flowers and arrangements. So what type of order flow are you already seeing come through?
Yeah, unfortunately, you guys don't order with a lot of notice, Brad. Research has shown that men order flowers, 50% of them almost order the flowers on the 13th or 14th, which is too late for us to get you the flowers. So then you're left with the grocery store bouquets and things like that. So we really need people to get their orders in early, especially right now, as we know, the storms have already started on the East Coast. And so weather plays into this holiday as well. So the more notice you can give your flower delivery service, the better, because it gives them more of a chance to make it right if they get stuck at a sorting facility because of weather. Planning ahead is definitely the advice that I want to give everybody this holiday, is to plan ahead. Order a little bit early. You never get in trouble for delivering early to your loved one. And then if there's any issues, there's time for that company to make it right.
What has your supply chain looked like leading up to this holiday and in recent weeks and months? Have you been able to get enough of the quantity of the flowers that you've been looking for, or have you had to make adjustments because of some changes on that front?
Thankfully, we're large enough. We're still a small business, but we're large enough to get the flowers we need, but we're paying a lot more for them. Most of them are 100% or more for this holiday. Roses have more than doubled in price, where usually that's not the case. The supply chain is hitting everyone really, really hard. There's a ripple effect that people don't think about. I wouldn't have thought about had I not known flowers. I mean, even container prices and things like that, that's how they get the bulbs and tubers to grow the flowers. And so there's a shortage worldwide in flowers. And so you have to pay a premium to get anything right now. And so, it's been challenging. We're trying to think outside of the box of ways that we can not pass on 100% of that to our consumers, because we don't want to price ourselves out of the market. We're also the only unfunded large e-commerce flower company, also the only female owned, which I think is a big benefit for us with our product lineup. But not having funding, we have to be profitable, right? We have to run at a profit. So we have to pass those, costs on to our consumers, but we're trying to do it in ways that doesn't just gouge them in 1 week. We're trying to blend it over several weeks and things like that. But supply chain has definitely impacted us, just like it's impacted every other industry out there.
I think you raise an extremely good point in the fact that you've got some other large players out there, hard not to recognize the presence of a 1-800-Flowers, who's been in the flower arrangements industry for years and has that type of operating margin that can allow them to kind of navigate some of what the smaller players might be going through. And so how has Farm Girl Flowers been able to differentiate itself and see growth in the floral arrangements industry?
Yeah, so I'm really proud of our team. We've done a great job being unfunded. We are the only large-scale e-commerce flower company in the United States that's owned and mostly operated by women. And I think that gives us an advantage that really helps us a lot, because the average consumer is a woman buying for a woman. 81% of the time, it's women buying for women. And so we know what women want. We're not going to give you stale red roses and baby's breath ever. That's never going to be on our menu. We're going to give you things that we'd want to receive ourselves. And so we've been, really fortunate that our our supporters and our customers and our fans and social have, really rallied around us and allowed us to just compete with those players that you mentioned that are much larger than us, and also have that advantage of being able to get Sunday pickups for Monday deliveries because they're operating at a different scale than we are still. So, we really think that's something that differentiates us. We've launched the Luxe line this year. We really have focused on, looking at the runways for inspiration. We have other inspiration points, and we believe the product matters. We don't think it's just marketing and technology. We believe the product is what counts. And so we put everything into the flowers at Farm Girl.
You mentioned your new Luxe line, but what would you say is the next growth opportunity for Farm Girl Flowers, whether it's in a geographic expansion, product innovation, or something else?
All of the above, I would say. We're working on all of those things. We're looking at international expansion. We're looking at additional product lines. We're really fortunate. We did a survey recently, and for the first time ever, our customers told us that the reason that they buy from us, the number one reason they buy from us, is no longer the aesthetic of our product, which it always has been. It's because they like our company. And that was the best news I've ever gotten, personally or professionally, because that means that we can come up with additional product lines that I think will be welcomed by our customers. So we're working on a lot of things that I'm excited to share with you, hopefully this year as well.
All right, we'll leave it there for now. Christina Stembel, Farm Girl Flowers founder and CEO, thank you so much for taking the time. I'm sure you're very busy in this week leading up to Valentine's Day. Coming up, we will bring you a discussion with Transportation Secretary Pete Buttigieg. That's up next.
Welcome back to Yahoo Finance Live, everyone. The Biden administration is out with a new plan to make America's roads safer. Transportation Secretary Pete Buttigieg joined Yahoo Finance earlier today to discuss the agenda and the future of electric vehicle infrastructure. Take a listen.
It's very important for people to understand that any commercially available technology right now, no matter what the brand name is, no matter what people are calling about it, requires that you as a driver be paying attention. And you got to read the fine print on some of these things. Now, again, there's a lot of promise in these technologies for the long run, but we are reaching a point where the policies haven't always kept up with the technologies. I mean, so many of our regulations to keep cars safe are based on how cars always used to be. But we need to make sure that they're based on how cars are going to be. It makes no sense to continue to focus on I don't know, a regulation that says exactly where a steering wheel or a mirror needs to go in a car that doesn't even have a driver in the future. And these are exactly the issues that my department's working with as we look to the future, even as we try to address an issue, a crisis really, on our roads today, which is, again, yes, it has to do with cars, it has to do with drivers, it also has to do with roads. It matters how you design a road, how you design an intersection, how you design an interchange, and safer designs will save lives.
What I find so interesting, Mr. Secretary, is that the big automakers are so focused on making the best new cool looking navigation screen or the best cool new plug-in electric vehicle. But there are technologies out there, some of which you highlight in your report, like alcohol detection system for the ignition and eye tracking technology. Now, do you think these things should be mandated standard equipment inside of automobiles?
So we are going to be evaluating how these safety technologies could become standard because this is part of how you also address some equity issues here. You know, if having a car that's going to protect your safety, your life, your children is something that's only available as an expensive luxury item, then that raises some deep concerns about who is protected. We have taken steps as a country over the years, from seat belts to airbags, various things, not only to have things like the 5-star ratings that my department puts out to help people understand performance, but also just basic fundamental standards that we say, if you want to drive a car in this country, this is part of what goes into that car so that you know you're safe. And the answer is evolving as the technology is evolving. That's a good thing. We just got to make sure that we're keeping up. Now, also remember, technology cuts both ways. These safety technologies have enormous promise, but other technologies, smartphone technologies, some of the things that can go onto screens, run the risk of increasing distracted driving, which unfortunately it's taken its place right alongside impaired driving and drunk driving as a source of crashes and injuries.
Mr. Secretary, let's talk about where things stand with the administration's climate agenda as we see Build Back Better hit a bit of a wall here without support from Senator Manchin. The president has said he wants half of the cars sold in the U.S. to be EVs by 2030. He's also laid out a goal of 500,000 charging stations by the end of this decade. Can you get to those goals without the incentives in place from Build Back Better?
I think we can make enormous progress with the tools that we already have. Of course, we believe in the incentives in Build Back Better. We think they'll make a big difference in making electric vehicles more affordable. And some of the people who stand the most to gain from adopting electric vehicles, rural drivers, low-income drivers who could really use that gas money that you save because it's cheaper to fill up on electric than on gas and diesel. It would go a long way to buy down the sticker price for those cars and pickups, which is what those incentives would do. So we still believe in them. But I will say, with what we already have, the resources to create a national charging network of 500,000 chargers so that you never have to wonder if you're going to be able to get charged where you need to go. The partnerships that we have and the conversations we're having with industry. I mean, the automakers already working very quickly and effectively in this direction give me a very great degree of confidence that we're going to achieve this goal. We're going to try to beat it as a federal government, making sure that just when we buy our own cars, if you just think about the number of light-duty vehicles that the federal government buys, we can lead by example. We're working to do that, and that's another goal the president set that we're working hard to make sure that we meet or beat.
And that was U.S. Transportation Secretary Pete Buttigieg joining Yahoo Finance earlier today. Coming up on the other side of this short break, we've got what to watch for tomorrow, as this week has got a bevy of big earnings. We're going to bite into some of them as we get this week off into the races.
Welcome back. Before we say goodbye, we want to break down a couple of things you should keep on your radar tomorrow. Now, two stocks I'm watching in particular will be Peloton and Lyft. Both those companies are reporting earnings results after market close tomorrow afternoon. And zooming in really quickly on Peloton, of course, this earnings report is coming amid reports that the company is attracting potential buyers, including Amazon and Nike. So potentially more will be addressed in that earnings statement and potentially the earnings call tomorrow evening as well. Those reports had sent shares sharply higher today for Peloton, but still that stock has been under pressure recently and is still down about 80% over the past 52 weeks. Now, meanwhile, we'll also be getting results out from Lyft tomorrow afternoon. Pricing for the ride-hailing company is going to be closely in focus as ridership and drivers begin to come back online during this economic recovery. And specifically, revenue is expected to rise by 65% on a year-over-year basis to reach $940 million, though that would still be below the just over $1 billion in revenue seen in the same quarter in 2019. Brad?
Well, the company that I'm going to be watching here has a lot to do with many of our lunches and dinners, perhaps. Chipotle, ticker symbol CMG. The stock had actually closed lower here on the day, but tomorrow we're going to be getting earnings from that company. And there you're taking a look at CMG shares. And in the extended hours, they are up by about 0.2% on this broader 52-week range. The highs of about $1,900, a little bit more than that. The lows at about $1,200. So with all of that in mind, they're trading towards the lower end. What I'm going to be watching for in this particular earnings report is the amount of investment in the digital infrastructure and the way that they connect in everything from digital ordering through the Chipotle lanes, and then additionally on the menu innovation front where they made some strategic investments there as well. So all of those things certainly on the mindset as we go into some big earnings coming out this week. Very quickly, before we say goodbye to you here today, Meta Platforms, the parent company of Facebook, has just released a statement that Peter Thiel is going to be retiring from the Meta board of directors, and that is at the 2022 annual shareholder meeting. What's more about Peter Thiel, of course, one of the partners at the Founders Fund and one of the PayPal co-founders, deciding not to stand for re-election to the board of directors of the company's 2022 annual meeting of stockholders. And so we will continue to watch how Meta shares move on this news. The shares in extended hours are down by a little more than 0.1%. That's going to do it for today's show, everyone. Emily, been an enthusiastic and action-packed afternoon, but we've got to leave things there for today. We will see you 3 p.m. tomorrow with plenty of earnings.